stage, Luke the Wolf, author, Marco does something with ARC, and Mr. Podcaster, also author.
There is no too close. Put the mic on your chin and forget about it.
Too close, yes.
All right.
And I'm here to represent Libra Relay. No. We're talking about the
Of course you are.
Bitcoin, right? Oh, I didn't introduce Matt. Did I introduce Matt? Yeah, Matt. Hi, Matt.
This is officially the moderator.
I guess like nobody else wanted to do it. So you had a topic earlier, like does it make Bitcoin better money? That was your thesis.
No, it's something I urge everyone in Bitcoin to think about at all times. Like, does this make Bitcoin better money or not? Before deciding on the path forward.
I agree.
Good.
And that is the last time today. So, so what recent changes do you think made Bitcoin worth money?
I'm not sure I agree with the premise. I think Bitcoin is better money because the network reacts to stuff. So I think the recent debates and the recent developments and the responses to those developments is what makes Bitcoin good money, because at the end of the day, I think that Bitcoin's users are what makes up the network and what makes it work.
And it's not centrally planned, and it's not one user, it is users, node operators, it is developers, it is miners. It's like this Mexican standoff that decides what is consensus.
Yeah, and even no-coiners have an influence on Bitcoiners. Like if I buy something from the restaurant next door, I am affected by if they accept only fiat or if they accept Bitcoin too. So every single person on earth is an economic node in the Bitcoin network to a certain extent. Like, of course, to different extents, and some of these decisions have more impact on the network, but you can't really separate any single person from what money is and what money ought to be and all of this. So I think we're all connected.
Looping in the other part of the panel, do you agree that an economic node is a spectrum from somebody who doesn't accept Bitcoin to Coinbase?
Sure. I mean, it's true that everybody has an impact. There's this interesting, to riff off what you were talking about.
It's an honor to meet you, by the way. I am Knut.
To meet you. to riff on what you're talking about a little bit, there's this weird. So I was talking earlier about this like quantum discussion and like, you know, what does Bitcoin do in response to a quantum computer, and like ultimately it's decided by the market. And to your point, kind of all the nodes in Bitcoin, all the people involved speak about it, but there's this weird property where it's like the decision making and the like what makes Bitcoin better money is also this like recursive thing, where it's not just people deciding what makes Bitcoin better money, it's also the market voting with their money about what makes Bitcoin better money on a fork by fork on a daily basis, which I find really interesting. That it's actually this like, it's not just that it's incentivized by like people caring about it and making their own decisions. It's like actually the market enforcing, like the market decides what's better, and because the market is going to vote on what's better by putting their money behind it, that also makes it better, because the market should hopefully, I mean, if you believe in efficient markets, the market should hopefully pick the most better, and that one will have the most value, and that's the way Bitcoin will go.
So you think prediction markets are helpful in deciding fork futures?
Futures markets, maybe, but that's the.
What are the takes on futures markets at the end of this days?
No, I think just like to go back a little bit. I don't think only futures or finance is needed to make money, but definitely as a society we found these markets and like from token, stocks and all of this like to be helpful in a way. But at the same time, I think like the beautiful thing of Bitcoin is like, it's like doesn't matter. Like there will always be some miner that will include me in a block, and my money can be there. And that's, I think, is the important aspect of Bitcoin, that not other money will be found, especially in a digital controlled way. So I think that's what matters in the end for me.
Luke.
Okay, so the futures markets, to address kind of the last question, something like this, I think are a silly fad. They serve a purpose to indicate potential, the way people think it will go. But when we're talking about real money, I don't think it's useful. It's a useful use of funds to bet with futures markets if it's not something directly within your own control. But the economics of Bitcoin, what makes Bitcoin better money, I think there's a fundamental disconnect from a lot of communities that aren't necessarily attending a Bitcoin plus conference, and developers. It's one reason I'm happy to be here and talking to.
This is the greatest audience ever. No? All right.
You said that, not me.
He disagrees. Boo this man. Boo.
Glad both of you can make it here.
Yeah, but the conversations that I've had already at this conference have been fantastic. I've met people who I have banned from chat groups for trollish behavior, and people I've disagreed with strongly on Twitter, and we've all been able to get together and shake hands and chat. And the economics of Bitcoin, I do think everyone here believes that Bitcoin is money. And that's the point. We just had disagreements on what does Bitcoin as money look like, right? And one thing that from my bubble, to the extent that it is just something like it's people who aren't directly developers or who aren't contributors to Bitcoin Core or whatever it is, who still are trying to contribute to Bitcoin in the way that they are. And those voices matter to the extent that they represent nodes in the network who have monetary stake in the whole thing. And I would love to see the community be able to come together a little bit better and not have these Twitter disagreements be what shapes the narrative at the moment. That's what I think the economics of Bitcoin means, and us all moving together towards Bitcoin is better money in a decentralized way that has no coordination is something that I love to see.
Amen. So that's the panel, right? We should end it on that note.
Kumbaya. Yeah, great. I mean, we will find out come August, I think, and then afterwards we can hug it out.
Oh, this is about that?
What happens in August again? I'm not sure.
It's my birthday.
Oh, it's your birthday. Yeah.
Oh, happy birthday in advance.
I mean, I think most users of Bitcoin want to be able to send and receive and not have Bitcoin change in any real world capacity. We want send and receive and 21 million. And that's probably what most noob users want. And I'd say that's who you're mainly developing for. Like that's your customers.
But those
We
are
should
the people-
remove multi-sig, right?
Multi-sig, yeah. I mean,
I'm asking this. I can lock funds. I can send, receive, and lock, and stay there. And someone escrow and lock it. No, that's not good.
I wouldn't say it's good or bad. I'd say that most people would just like to take control of their own keys and then not use them for a while, and that to them is locking the key. So
Yeah, I was at an event the last few days actually, and had a number of really great conversations with people who are doing Bitcoin, actually using Bitcoin for things that people care about deeply in Africa, and not people who don't care about Bitcoin, care zero about Bitcoin, couldn't care less, but are still making meaningful contributions to people's financial health and ability to make financial transactions across different parts of the African subcontinent. And I found it really fascinating because it kind of goes to your point. It's just like people just, the vast majority of people just want to send and receive. It's great that Bitcoin has all these other features, and we should encourage people to use those as people get further into their Bitcoin journey. But the vast majority of people just want to send and receive, and often they don't even care about Bitcoin. They don't care about sending and receiving Bitcoin. But you have to give them like an introduction point. You have to give them a point where they can say, okay, I actually just want to send and receive maybe my local currency, and then I can, and then, oh, this actually uses Lightning on the back end because this happens to be the best way to move money, and what is that? Let me learn about that. And so it's interesting how different the adoption story is of Bitcoin in different parts of the world. In the US, it's people who start with screw the Fed or libertarian beliefs or whatever. And then, in Europe, it's often a little less libertarian, but it's kind of similarly like, I want
taxation.
Well, okay, some people. Hopefully not too many. But people often maybe a little more, I want self-control, self-sovereignty, and maybe it's a little less of this kind of like libertarian and then the Fed viewpoint. And then you look at like Africa, and it's much more day-to-day, like how do I move, a dollar from my wallet to, or from my funds to someone else, maybe across a border or whatever, in the most efficient way possible. And at the end of the day, all these people are coming into Bitcoin for some totally drastically different reason, and then optimizing for that. And like, I think your point is well made that like at the end of the day, it's just people who want to transact. But it's very interesting that like this ends up looking so different across different groups of people across the world.
And would you say that like Bitcoin is not available to everybody in this world? Like, we are very privileged in the Western world. We can do on-chain transactions. We have all the access. We can buy SSDs at 500 euro prices. And
Hardly
should we continue developing and improving on Bitcoin with in mind making it better money, so that it is more that's inclusive is such a word, but like to allow for more people to be onboarded?
I think that's the beauty of how Bitcoin has evolved, is that it's because it has evolved in this like layered approach, we've ended up being able to serve these drastically different communities with very different solutions, right? That like, if you're high net worth, or in this case, just privileged in the Western world, you have access to on-chain, you can do fairly advanced financial services with Bitcoin and multi-sig and all kinds of cool locking things, and think deeply about this, and you can afford that, and that's adding value to your life in that way. But then also there's like this Lightning thing, and now there's like Arc and Spark, and there's other things that are maybe a little more trustful, but that can serve different communities in drastically different ways, and that Bitcoin, uniquely in the cryptocurrency world, has just not made those compromises, right? Like every other cryptocurrency has kind of made that trade-off to say, I'm going to trade off this trustlessness in order to better serve people who have less money or want to do something weird or whatever. And Bitcoin has not made that trade-off and still ended up being able to serve those people by having this kind of layered approach in different schemes.
So where do you draw the line? What isn't financial transaction? What's too complicated, and what's just muddling the waters?
Do I have to answer that question?
I don't know. I don't know if I'm even allowed to ask a question.
Yeah,
I can take this hit. Cypherpunks don't ask for permission, and what is allowed, what you can do.
No, but I wasn't asking for what's allowed or not, but I'm just asking Matt a personal question. Where would you draw the line? What is an actual, what would you say is not a use case for Bitcoin?
Oh, man, you're going to just get everyone mad at me.
Yes, that is the purpose of the question, yes.
Great. Yeah, I mean, I don't know. Like, I live comfortably in a world where I know that I cannot restrict what other people do with Bitcoin. And that is the value that I put on it, is that, maybe I found a way to not have it. But like, for example, like, I mean, maybe to give an example that will get some people mad at me, like, if there was anything I could do that would prevent North Korea from stealing more Bitcoin and using more Bitcoin, I would. But the fact that I can't is why I work on Bitcoin. And the fact that there is nothing I can do about that is why I work on Bitcoin.
Yes.
But you can restrict a miner from paying themselves more than they're due. Like, you can, so you're restricting something. And is that the line then? Well, like, whatever consensus is right now is where the line is drawn?
Yeah, could I try to calibrate this ever so slightly? Are we ever allowed to restrict if we've upgraded? I'm sort of putting quotes, but more like if we've added features to Bitcoin, are we ever able to say this was a mistake and roll it back?
Yeah.
I mean, it's up to the market, right? Like,
I mean, we have done so in the past, right? Like with pay to multisig, like there's like a very small, like 6 million sats have been locked forever because we removed something.
Yeah, during the
like
Satoshi era, yeah.
Since then, like
Satoshi
we have never
dies.
done any change ever that has restricted anybody's coins.
It's worth pointing out that it is always possible, right? Like in every soft fork, someone can, like, especially after the soft fork is defined, like after the technical community is like, here's the soft fork we think we should do, and the Bitcoin community is like, yeah, we're great that we're gonna do that. Someone can always create a transaction and say, I'm going to like deliberately construct a transaction and mine it such that it will become invalid under the soft fork. It's always possible. Like I can go create a bunch of outputs today that use every op success in Taproot every op nop in Taproot and every op nop in the existing script, and I'm almost guaranteed that at some point Bitcoin will soft fork and will seize my funds.
Not if they put a block height limiter on it, though.
Yeah. I mean, you can always come up with examples. Like there are always, it's nuance, sure.
So would you agree that the more you fuck around, the higher the likelihood that you will eventually have to find out?
That is why we're moving so slowly. Yes, of course. Like if you were to move recklessly, if you would rush something, if you would vibe code a soft fork, that could lead to potential unforeseen, consequences. And that is why all of these, I mean, James O'Byrne or like Jeremy Rubin, they can like sing about how difficult it is to propose a change and to wait on your hands. And we've moved slowly for a reason, because this is like $1 trillion like thing that a lot of people depend on, and that's why we're not, recklessly changing consensus.
Yeah, I think it's, like, my point with this too was that, there's no such thing as black and white here. Like it is not absolute. It's not absolute, right? And so there is always some, okay, you're obviously, if you're going and using op nops all day long, like you are very explicitly opting in to like this. These funds are probably going to get locked. Like you're using something that explicitly exists to lock future funds in an unknown as of today way, and you can do that. You absolutely could do that, but it's still just like nothing is black and white here, and so there's always some risk. But it is the case that I think when there's a fork, the market has to pick which one to value more, and like I think that the market will always choose the value, the one that is the I hope that the market will always choose the one that's most like principally aligned with Bitcoin. That because like Bitcoin has the most value if it is aligned with the principles under which everyone is invested with Bitcoin, Bitcoin. And so if there's a fork that is against those principles, the market will say, screw you, that's not the reason I invested in Bitcoin, and so I'm going to not use that fork.
Yeah, I think we agree on that. We just have a different definition of it, maybe. And the reason it's not black and white is because orange is the new black. Yeah.
So to expand on this premise, like I, like putting on my conspirational tinfoil hat, see a future where like institutions that currently like custody millions upon millions of Bitcoin for people that do not give a flying fuck about the permissionless nature, the censorship-resistant nature of Bitcoin. And there might be a future where we have a BlackRock coin fork, and there might be even a future where they will take the ticker symbol BTC from us. And that is something like we can prepare for, or like we should expect, or do you agree that something like this is on the horizon?
I hope not. I think not. But this is a conversation a lot of us had very seriously during the SegWit2x debate. Is like I know a lot of developers who, including myself, who were looking at it and saying, if this goes through, like if this becomes the way we make decisions in Bitcoin, I will possibly continue working on Bitcoin, but it won't be that Bitcoin. I'll work on something else. And if everybody else doesn't refer to it as Bitcoin, maybe that's okay with me. And so I think that's something that everyone at the time had to answer for themselves, but I think it's something that every Bitcoiner should at some point think to themselves, like, if the market goes the other way, and I think that that's not the principled Bitcoin, like, will I still work on it? Will I still spend my time on it? Will I still invest in it, hold it, even if it's something that everybody else doesn't call Bitcoin?
Almost as if a prediction market where you would stake your entire net worth on a potential future hard fork, like, shows the conviction and telegraphs to the world.
I don't know why anyone would do that. That just sounds silly to me. Is the principle maximum permissionlessness, maximum censorship resistance? Because I think there was a Twitter poll at some point by Sam Samow, I think. Might have been someone else.
Production
or
ready.
maybe there were others, where it was like, if you had to pick one, the 21 million cap or censorship resistance, which is more important to you? And it's a hard question, right? I mean,
It's a stupid question because this is not binary. Like Bitcoin.
No, I think.
but you have to pick, Chris. I'm the moderator now.
No, you don't have to pick. Like gun to my head.
No, you can't have one without the other. Just as you can't have medium exchange if you're not a store of value, and vice versa.
I mean, there is possible, like, we can have deflationary Bitcoin, like, we losing, like, the 21 million cap does not exist, like, it's way, way less than that, so it still works. So essentially...
But that is the cap. Like, we will lose them. Like, are you arguing for Taylor?
No, I'm a pizza lady, and you can always subdivide a pizza, and you have, no. So, again...
I thought you were more of a bratwurst guy.
Bratwurst,
Yeah.
yes. Everything has an end, except...
The bratwurst.
Has two.
Yes.
I don't know how we ended up here.
You need a fork to eat a bratwurst, I think. Maybe not.
But to be serious here, though, I think this is the divide to the extent that it is that there's a disagreement on which principle in Bitcoin is most important. And even if we all agree that Bitcoin is money, and those of us who are here, there's no one here who's here just to shitcoin or just to put monkey JPEGs on the chain, I hope. But we still disagree on that, what exactly the best principles of Bitcoin as money actually look like.
Yeah, it's totally true, and that's. I have a feeling that's going to be a debate until the end of Bitcoin, which hopefully means the end of time. But you know, it's going to be a debate forever, and it's hard to like. The only thing I can come back to is like the market's going to decide, right? That like in the event of a fork, the market's going to decide, and hopefully, and I think empirically, it has been very, very clear. Like the market, there's much less value if there's two Bitcoins, and so the market's going to pick one and say this is the one.
So which would be the one that is more aligned to the principles of Bitcoin in your view?
I mean, there's the things I care about more, and then there's like, personally, I care the most about censorship resistance. Like the reason I got into Bitcoin is because I thought this thing was really cool, that I could move value on the internet without anyone being able to say no or whatever. Like the reason I got into Bitcoin wasn't necessarily some arbitrary cap. It wasn't that there was a cap. Now, it is true that like if you have no cap and like if if you had a board of governors, for example, that could arbitrarily change the cap, then all of a sudden you don't really have censorship resistance because they can inflate you out of the money supply and something the Fed. But personally, that's what I'm interested in more than most other use cases.
That's interesting because I come from the opposite perspective. What intrigued me was this promise of a number on the internet that couldn't be copied. More than the monetary, like I didn't even think of it as money in the first place. Like I thought of it as like, here's the promise of a number that cannot be copied. How can that exist? I thought that was like outrageous. And the more I looked into it, I couldn't debunk the theory, but I also came to the conclusion that this can only exist once. Like any copy of it, like you cannot replicate resistance to replicability because that's sort of shooting yourself in the foot. So either this works or nothing works. There can only be one sort of a Highlander thing there. And that's what intrigued me about it in the first place. And then when I learned about censorship resistance, that was, of course, awesome, but that's not how I came into this. And I think this might be why we're like approaching this particular problem slightly differently, because we come from different worlds in that sense. But to me, it was always this, there's something that cannot be copied, and it's just, how can that be?
There are many things, that are very, there is prime real estate, there is like amazing mansion that only, a king can own, but right now the state can seize you, if you're an enemy of the state, it can seize you. So like, I understand there's a huge value in having some digital artifact that looks like a prime real estate or some prime thing that only few people can have, and that's amazing, important property. But in the end, like, if you can be seized, like, what's different by fiat?
Yeah, but the thing is, if it's information, it cannot really be seized, because at the end of the day, it's a secret you keep from everyone else, and that's what makes
If you can't move it, like you said, it's a number that nobody can copy. What use is that number if you cannot move it?
But you can, by definition, move it if you can give other people that information.
Yeah, but in the event like with Bitcoin, like the censorship like would be, okay, you have this great number, it's your number, but we're not going to put it into a block. You're on an OFAC list, and we have the centrally planned coordinator that is always filtering Knut bucks.
So again, we get
So
back
we need
to
both. Again, it's a stupid false dichotomy.
It is a false
Samson Mo, this is like Samson Mo, I know you're watching. Stupid.
We do have two members of Nevermind, so of course Samson is watching.
Yeah, of course. Yes. So I also believe that it's a false dichotomy. Absolutely. You can't have one without the other. It cannot be absolutely scarce without the censorship resistant. But also, it cannot be censorship resistant without the absolute scarcity or absolute finiteness, which is why I don't believe in Monero, for instance, or any other shitcoin for that matter. Like, they're two sides of the same coin.
Yeah, but there's more. There's even like, we need also the transparency. We need like, it breaks down to more things that made Bitcoin what it is, that made it exciting. And again, like we have this thing, we have the cap, and now we need to defend not only the cap, but also the censorship resistance. We cannot have like some morals instead of incentives. We cannot have like some governance structure like Ethereum, where like there's a bunch of people that.
Do you think? Okay, I'm gonna play the role of the moderator since you're talking.
I'm just ranting.
Do you think it was pure luck that of all these overlapping properties that are so important to making Bitcoin what it is and giving it value and having us all be interested in it, do you think it was pure dumb luck that Satoshi like picked these, or do you think that there exists an alternative universe where Bitcoin has slightly different properties and is still equally interesting to as many people? Maybe not the exact same set of people, but equally interesting to as many people.
I would say so. There are some parameters that are like entirely arbitrary. Like, is it 21 million? Is it 42 million? Like, there's entirely arbitrary things.
It's not arbitrary.
Peter Todd did a great job,
but that's a separate issue.
Yeah.
there's computer science reasons for it, but this is a separate issue.
But this is another false octocotomy, like or multicotomy or whatever. Because we're living in the world on the timeline and the part of the multiverse that we're living in, and this is the Bitcoin we got. So why discuss the others? Like, this is the one shot we have at this thing.
Yeah, it's the anthropic principle. It's the one that has survived. Like the properties of the Earth are not exactly perfect for humanity to live in because it's the only one that's possible. It just happened to be the one that produced humans. Something like this.
So yeah, it was luck. He's standing on the shoulders of giants, in my opinion, and like he just put it together, and like everything worked, and we are happy for it. But I would believe, with some slight tweaks. There are in the multiverse theory, there are other Bitcoins, Bitcoin 2, that are equally great. And there's also a Knut in that universe that disagrees with me.
And wears a hat.
It's a different hat, though.
Yeah.
Definitely not the same hat.
And he has an eye patch.
I'm not wearing a Libre Relay hat in any universe, that's for sure.
So what's actually threatening censorship resistance?
Except this one.
One of us.
Good one.
So what's actually threatening censorship resistance at this point, though? Like what is a real threat to censorship resistance?
Mining centralization.
Private mempools.
Why?
Well, look in other ecosystem, in other chains where literally every block is running through an OFAC list, and that's not where we want to go.
Okay, to play this a little further, though, aren't private mempools unstoppable? Like they're a thing that there's some incentives that can be pushed against a private mempool, but Mara can always keep offering Slipstream, right?
Yeah, but I think there's the incentive for the market. Like, let's assume for a moment, and maybe again I'm going to get into something that's going to make people mad, but let's assume for a moment that policy and consensus were identical. Let's assume there's no differences, and then. Or maybe just that there's no material demand for any of the differences, like any of the things that are different. There's no material demand for those transactions. Then I think the incentive is to continue with the public mempool. So because every transactor wants to, like, a miner could offer you a discount, but why would they if there's a public mempool? Maybe it's just the Nash equilibrium. Maybe it's not necessarily optimal, but maybe it's just the Nash equilibrium that if there exists a public mempool. No one wants to necessarily break out of it, right? A pool could say, I'm going to give you a discount if you use my private mempool and you use my private API, and I'll give you a discount to get into the block. But why would I do that? I make less money versus just taking the transactions at the public mempool that are paying more by definition that I'm giving a discount. Now on the transactor side, if I'm transacting, I could send my transaction to the public mempool, or I could send it to the private mempool. On the public mempool, I'm going to get mined quicker. On the private mempool, the only reason I would ever do that is if I'm getting a discount, and I just said it doesn't make sense for a pool to offer a discount. So I think that it's actually like an economic equilibrium that the public mempool will exist as long as policy is the same as consensus.
Okay, get rid of policy then. Get rid of the entire policy layer. But you still have, say, 20% of the hash rate that says, we don't agree with these transactions, go ahead and submit them, but we're not going to mine them. What's the situation there? Is that different from private mempools? From a perspective of censorship resistance?
I mean, Bitcoin mining is playing roulette with a fixed amount of money that you're betting, and why would you leave money on the table if you're saying like, okay, I don't want these transactions, I have these miners running, like they're burning electricity. Like sooner or later, I'm at a disadvantage. And like people point to like Marathon and like all these other like slipstream adjacent products. Oh, they only increase their monetary revenue by like 1%, one measly percent. But you have to realize that 1% is 100% profit, and that buys a lot of ASICs, and that increases your hash rate, and that makes you much more competitive against miners that leave money on the table.
There's a false assumption there, and that is that the miner's incentive is only to make more fiat, and that's the only reason to mine. And I don't think that's true in the long run, at least. And also, like there's this notion of mining pools being the only actors here. Like there's nothing saying that mining couldn't be more decentralized in the future. We're seeing this hash renting thing, and people mining on whatever block they want more and more. It's small now, but it might grow into something else. And I think Bitcoin mining has a lot more incentive. You're incentivized to mine Bitcoin for a lot more reasons than just to make more fiat in the short term.
Yeah, maybe to highlight the out I gave myself, that I think that the important distinction is that there's no material demand for transactions that don't meet those miners' policy in this case. So yeah, I mean maybe 1% is material. Now we could debate like what is the threshold for material, and maybe there's miners that are willing to operate at a slightly lower profitability, and that makes the material the percentage at which materiality becomes true a little higher, but like there is obviously a threshold where 90% of transactions are doing this thing that somebody doesn't like and doesn't want to mine, and also most of the revenue is from fees and not block reward, and now that is clearly material, and you could choose to mine that at a loss, but eventually you're just going to straight up go out of business because you can't afford your power at that point.
That is the problem, and I think Bitcoin's game theory is at its strongest when everybody is greedy. When Michael Saylor is a greedy piggy, wants more Bitcoin, when every miner wants to. Like Bitcoin is governed by incentives and not morals, and I think that's good. And like the incentives are be greedy, and that makes it stronger.
So what does that include then? Like if I choose to run whatever software I choose to run on my node because of my own reasons, like what does greed even imply if it's not only greedy and fiat, short-term fiat gains?
I mean, if you're only a node operator, like you want to amass as much Bitcoin as you possibly can, and you only offer your goods and services for more Bitcoin, and you increase your stack. That is Knut's greediness. That is the extent.
Okay. But wouldn't that be true for miner too? That all I want is more sats and not necessarily more fiat. I want sats to
I don't understand how you arrive at fiat. Like a Bitcoin miner usually gets paid in Bitcoin.
Yeah, yeah.
To sell
no, but okay.
Keep it.
So let me flesh it out for you. If I, as the miner, am more careful with, like, if I include what Bitcoin may become in the future because I'm doing one thing rather than another, like that should be part of my calculation if I'm a miner that care about Bitcoin's longevity, because I can realize that Bitcoin's longevity is the most crucial thing for my business to be sustainable over a long period of time. And this is where I think the fiat incentives come in, that some of the miners, if not most, are not thinking about this because all they care about is a fast fiat profit so they can get as much dollars as possible in the short term, instead of thinking about generational wealth.
So what you're saying is like the incentive falls apart because they care more about short-term profits over the longevity.
I'm saying mining is designed to be a zero-sum game, basically. Like the electricity cost is supposed to be higher than the current cost of the sats they get out of it. But you want to do it anyway because you believe those sats will be worth more than your electricity bill in the long run.
Is that true, Matt?
Would you agree to that, Matt?
This feels wrong.
I mean, I think the only issue with that, and I think you're right in the sense that that's empirically what we've seen, is that most miners seem to invest on that thesis. But I think the problem is if you assume that it should actually be lower, that your revenue should be lower than the current value, then no one should mine because everyone should just buy Bitcoin.
No, I'm not saying like individual miners may or may not be profitable, but on the whole, mining will always cost more than the current value of the sats they get out from it.
I think you're right empirically. Like the reality is that you're right. Like because that's what we've seen.
That's all I want. The reality.
But nothing prevents like Bitcoin can absolutely become worth more than the electricity that is required.
But I think the problem with that is that it doesn't, like, economically it's weird, right? Because like the answer should be that you should never get into mining if you believe that it's going to cost more than the value generating, because you should just instead buy Bitcoin. Like, if you're gonna lose money compared to the cost, you should be buying Bitcoin and not buying ASICs.
Yeah, but this is where the whole hash renting thing comes in, because that's everyone who's into that knows that they're probably going to lose money on it. But they do it anyway because they believe it's the right thing to do for Bitcoin, because they believe in the long-term value of the Satoshi, but only if they can, help make Bitcoin what they think Bitcoin is and decentralize mining in the long run.
Can I latch onto a thing for a second here? The other point about that the miners will eventually go out of business if they're being slightly unprofitable assumes that that's their only line of business. If they have other revenue and they're willing to pay that, call it a fee, to put their will onto the network, then they can be sustainable for as long as they want, or it's at a loss rate that's acceptable to them.
Yeah, so this is the classic, like, this is also, you're making the same argument as this classic argument of how does Bitcoin survive in once the fee or once the subsidy is gone, is that people who are using Bitcoin will mine out of basically charity, because, or not necessarily charity, but like they'll mine because they derive other value from Bitcoin, and that they want to support the network.
They want to secure their stacks.
Right.
Like, that's why they mine.
Maybe. I mean, that's not what we've seen.
I'm very
I'm
bearish on renting hash rates, and here's my thesis. So again, I think Brains is great. I think Jan Čapek is one of the unsung heroes of Bitcoin, but it is utterly idiotic to mine at a loss. Like, what you're essentially doing, like, you're subsidizing whatever ant pool, whatever proxy pool, their energy bill. You're paying more Bitcoin than you're likely getting out. It's really, really unlikely that you, at the size that you're arbitraging, like you're buying hash rate at that size, you will not get a good deal. There is, at a certain size, you can buy like exahash, petahash, maybe you have an edge, but like with this difficulty adjustment looming, no miner will sell you hash rate for cheaper than they would make themselves. And then you're acting ideologically and not with the game theory incentives, and that is we are observing it is a really, really tiny minority share of the 1,000 exahash that we have in the network of people mining altruistically. That is great. I also have home miners. I also play the lottery, but it's not like what sustains the network.
Yeah, it's interesting because I agree with you, and it's true certainly for like the hash rate rental market. It's so tiny that it's. There's people like buying hash rate to test, like software engineers buying it to test software, right? There's other things people are doing at the hash rate market that might drive the price up. But it's also interesting that, like, empirically over time, it has basically always been a bad investment to buy hash rate, like depending on your model. So there are. I don't know if there's any miners here, but if you're a miner, I'm sure you have your own modeling, and I've seen some of the modeling that some miners have done that tells them it's a great investment to buy hash rate, and it's not. It's just not.
This I think is where Austrian economics comes in, because bad investments for whom and why? Like, this is only measuring in fiat gains, and this is not the only, like, we do things because we believe we will profit from it. Like all human beings, everything we do is because we believe we will get into a state of less uneasiness when we've done the thing. And this is true for mining too. So we don't know like the psychological profit of mining for certain people. And
virtue signaling or...
Yeah. Virtue signaling is actually not a... You may think it's useless, but other people can and do disagree.
How can I monetize this?
Yes.
But I think, so like, you're right, and I do wonder, I mean, you kind of have to make a second layer argument for that, because the miners who I've seen models from will very proudly claim that they're going to make money in fiat terms and sometimes in Bitcoin terms, but usually in fiat terms, and they're wrong. Versus compared to just buying Bitcoin, they're wrong. Like they're going to end up with less money than they would just buying Bitcoin. But it is interesting because they won't claim that, right? They're not going to make an argument saying, you know, I'm gonna support the network and this is the reason why I'm doing this. But I do wonder whether it's like also just a desire to do a thing in Bitcoin and that this is a thing to do, and so you come up with the model that shows you're going to make money and argue for it. So I think you can make that argument, but I find it interesting because it's just kind of this second, third layer argument of the psychology of someone getting into that business, at least today. And maybe in the long term it's different. But
maybe to break the knot on this, like you're also doing something if you just buy Bitcoin, because miners are down bad right now. Like the prices and like miners, they lose money, they pivot to AI, like they're sitting on those ASICs. If you subsidize them, those evil miners that used to like mine spam stay longer in the business because you attempt to virtue signal. You could just buy Bitcoin and let them go out of business. And that would probably be more effective, is my thesis.
Okay.
Yeah, some of this comes down to a little bit that, like, I think one of your earlier points, Chris, about that it would be ideal if everyone in Bitcoin was the most greedy. But I think this is where Knut's points come in the most. That not everyone is thinking the same way and has the same set of understanding of the incentive structures. And so what you get to at the end is a point where we can't engineer Bitcoin perfectly. We can't get to a system where everyone is going to behave in the optimal way. And therefore, my view is that the economics of Bitcoin and trying to engineer the economics of Bitcoin is only good enough to a point where, okay, we can maybe say policy defaults are technically optimized but we can't ever say to people that you can't make these decisions, right? So people are going to make the decisions, and then I think you're right, Matt, that the market is just going to decide, because at the end of the day, people are going to decide which version of software to run, which settings to run, which version of Bitcoin to buy, which shitcoins to buy, which fiat to buy. It all comes down to the market and behavior. So maybe that's where we can,
But wouldn't you say that, okay, subsidy will to end, maybe we won't be there, fine, but wouldn't be the goal for us to say, okay, the blocks are full because people are using Bitcoin? Because otherwise, like, it feels like I don't think we can just open. And I relay the question as well, because you also mentioned, oh no, people will just mine just out of their own security, but then also means then it will be a very, very small amount of people using Bitcoin, and means kind of Bitcoin is failing as well if nobody's going to use it.
Well, how do we actually get blocks to be full then? Is it
spam
through tech?
Spam.
Is it
Lots of JPEGs, biggest JPEGs possible?
No, disagree. Like, we have to onboard people. We have to go out, excite people about Bitcoin, and we have to realize that, again, like earlier I mentioned, only 13 million hardware signing devices have ever been sold. So people that really take Bitcoin in self-custody are like even more rare than people that have Bitcoin exposure. Like, we need to get more people excited, and we need to also maybe realize that it is not ready for mass adoption yet. Like, the UX of software is not there yet. I'm not talking about any proposals and consensus changes, but like, there are definitely ways to improve it, and there's like, you can do things, was your thesis, you can educate people with your podcast, you can build better infrastructure, and then naturally the demand for block space will price out all the uneconomic short-term fiat plays like spam or JPEGs or whatever.
But why do we have to be ready, though? This might actually be like the question I've wanted to ask this entire time. Why do we need to be ready versus just responding to when there are more people on the network? Why do we have to be thinking about 20 years from now in terms of development priorities versus simply onboarding people and then reacting to how the network is behaving?
I mean, we do. Like, I mean, that's what we have to do. Like, there's nothing else. But it takes 5 years these days, maybe more, to get a soft fork through. So, you know, I think we do have to. But ultimately, I think, you know, the development process ends up just being like so iterative, right? It ends up being very, you know, here's what we have today, here's the pain points people have, how do we fix those pain points? You know, oh, we can build this other complicated protocol to fix that small pain point. Okay, well, let's start doing that. All right, this can take a while, and then we do that, and then we fix some small pain point, and then we repeat ad nauseum. But yeah, I mean, I think it is helpful to at least think about how we might address future problems, because, you know, sometimes it takes a long time to get there. You know, one thing, maybe to throw out one specific thing, one thing that I've always thought we should do is do fee smoothing across blocks. Right, so if when we no longer have a subsidy, you know, if you mine a block that has 100 Bitcoin in fees, you shouldn't get that 100 Bitcoin. You should get, you know, one of those Bitcoin, and then the next guy should get, you know, maybe 0.9, and then you pay it out over many blocks. You know, you still want.
Sounds like some communist gobbledygook.
It does. But it fixes a lot of important attacks, right? So you know, there's things like this where we might want to consider doing it, where we need a lot of time to design that and think about that and talk about that, and that's a careful economics design. Like, we have to think about analyzing how to construct that, and it's hard.
So I'm against the whole narrative that anyone is to say how full blocks ought to be or not, because there are so many unseens here. For instance, like, what if Bitcoin leads to people trusting each other more, and then that leads to people that I know Adam Back made this comment like 8 years ago and got laughed out of the room, like the keeping a tab on one another. But if I trust you, I don't trust you, Chris. But if I did,
basically the Lightning Network, yeah.
Yeah, it's basically custodial Lightning is that, but isn't that scaling? Because custodial Lightning might be very flawed in comparison to the real deal, but it's still way fucking better than banking. It's harder to do fractional reserve on custodial Lightning than
and you can pick
banking.
Your counterparty. Like, a lot of bankings, you pick your counterparty because you pick a bank, but oh, by the way, their counterparty is all the other banks, so it doesn't really matter.
And the fiat system in general. So like, still, like, who am I to say if blocks ought to be full or not? Like, maybe adoption looks like we're not just using money as much anymore because we trust each other more, because the second best, quote unquote, is our reputations, because we know that reputation over a long time counts in Bitcoin. If you can trust another person more, ironically because of this whole don't trust verify thing, then maybe that's the silver lining here and the brighter future. And maybe that is what adoption looks like. Just people using money, not in the Keynesian notion of velocity of money is what I'm trying to get away from here. Nobody knows what deflationary money actually means in terms of how we interact with each other. At the end of the day, money is just a language for expressing value to one another. Like, I want this much for that. So who am I to say what that looks like? I don't think anyone is entitled to say that blocks ought to be this or ought to be that. And I definitely don't think it's a good idea to have them full when the system seems to work without them being full.
I would sleep more soundly if we had more than 200,000 Satoshi in fees right now. So like, there is a gradient of, you know, how empty a block or how full a block should be. But to your earlier point, like, we trust each other. That is great. I trust you to a certain extent. I trust Matt. But like most other people, I don't. And like Bitcoin, we strive for trust minimization, and like don't trust verify is a trope, and every single person in this room trusts to some extent. Even you, like, you know the Bitcoin core code very, very well, but even you trust, I don't know, some other galaxy brain because you don't understand that. And like, you're not, every time you I don't know, there's always trust. We should aspire to reduce and minimize it, and that's why we have Bitcoin, because it's like a bearer token, peer-to-peer cash.
I mean, I do think it is true. Like, both of you are right. Like, I think the great thing is you can build a trustful system on top of a trustless system, and you just can't go the other way. And that's what's so important about Bitcoin making this like very hard no compromises decision compared to every other cryptocurrency is like, you know, everybody else is like making these compromises, and great, but that's now set the floor. Like you can't have less trust than that because you have to trust the underlying system. And with Bitcoin, we have this underlying system where I don't have to trust anyone, and then I can choose to trust more. I could choose to opt into protocols that are more trustful. Maybe I use a full bank, a Lightning, you know, custodial Lightning, whatever. But it's you can't go the other way. And so I think that's what's so important about the way Bitcoin is growing.
I love debating people who just agree with everything everyone says. Like,
Well, I'm pretty sure when we have 8 billion people onboarded to Bitcoin, there will be full blocks.
So here's my, to disagree with you just out of spite. We will never get to 8 billion people, and that is okay. And even if just 21% of people use Bitcoin, that is such an improvement over where we are right now. Because like with the Pareto principle, like 20% of people are like net taxpayers are like productive, and like the rest is usually not. Like, and at that point, like you will only require Bitcoin as payment. Like you're not gonna use fiat because you don't want this ice cube. But there will always be fiat currencies. There will always be other currencies because people want convenience. People want more. They don't want to have the, you know, responsibility, and that is fine. Like Bitcoin is for anybody, but it's optional, and 8 billion people is some hippie gobbledygook. But you know,
you didn't actually disagree with my premise, though. If there are 8 billion people on Bitcoin, there will probably be full blocks. Agree or disagree?
No, we will have a block size increase through Mark Friedenbach's hack, through the time warp attack.
This guy, everyone, come on.
BIP 54, right? That's
BIP 54. BIP 54 would close that loop.
Right.
But Mark came out of retirement and said, hey.
Well, clearly we just need to rush BIP 54 through so that we can close the door to...
Let's just do BIP 54, like to prove that we can still do it. You know, we all agree that we need, like BIP 54, closes 4 existing actual critical bugs. Highly unlikely, but they're actual defined bugs. And like you proposed it, right?
Yeah, originally. Antoine is now gone and rewritten good chunks of it. So
it's French BIP 54 now, and it is now sort of final or like complete.
Yeah, but he's now marked it complete, and next step is to actually get the community to say yes and time to activate. But, whew, boy, getting the community to do anything now is
I mean, there's a great post on Delving. Read about it, learn about it. It's an important thing, and we should do it and prove to like the haters, the ossifiers, that we can never, you know, improve it.
No, that I agree with. We can't ever ossify. I completely believe that. There's always going to be something in the world to react to, and we can't have a point where Bitcoin is never going to change. I believe that 100%.
Well, this is a terrible panel composition if we can all agree on that. That seems to be like a fundamental thing everyone should disagree on, right?
Security is a moving goalpost.
I want
to. Thanks, Chris.
The only thing I want to ossify is the notion that Bitcoin is money. If we could ossify that in people's brains, that would be a good ossification. I don't think that's possible either, by the way. But
it is a peer-to-peer cash system.
Yes.
Electronic
money.
Electronic cash system.
Did we leave anything unanswered? How can there possibly be questions?
1 hour.
So we're saying that we want it to be money, but wouldn't programmable money be closer to what Bitcoin currently is?
Let's just say an electronic peer-to-peer cash system.
No, I mean, is it programmable money, not electronic cash?
Programmable money to me sounds a bit too much like programmable people, but yeah, programmable to a certain extent.
And why do Satoshi then did a script? Why he decided to have a scripting?
Yeah, but programmable also, it's also sort of in the eye of the beholder, right? We don't want CBDCs, do we, to program whether you can go by.
But the question is not about what we want. The question is like why Bitcoin has a scripting engine.
Okay. We can call.
We got him. Another one. All right. Next question.
I don't care if Bitcoin is programmable money. I just want to overthrow the fiat system and get us out of the shackles of oppression, everyone.
Yes, so stop slavery.
What if you need programmable money to do that?
Yeah, that's what I just said. I don't care if it's programmable
or not. What if you need non-programmable money to do that, though?
Well, then that's a...
This is like the Monty Python's argument sketch. Like, it's exactly that. Like,
are we saying programmable money? No. That's a question. That's like
I mean, it's basically that question, like, do you need, if you want to overthrow the fiat system, do you need something like inheritance schemes? How far do you go? Do you need DEXs? What do you need enshrined in the base money for it to make sense. So you cannot draw the line, I feel. And so this kind of clashes with the pristine narrative of Bitcoin being this perfect thing in a way, which you cannot change, like where somehow you need to at some point make those forks and kind of find for every use case whatever people need, right, for it to suit their use case and break their shackles.
Yeah, I mean, I hope that we can build as much as possible in layers, right? So like you look at other blockchains and you know, you look at DEXs, so you threw out the example of DEXs, where you have other assets that, you know, maybe, let's ignore shitcoins for a moment, maybe, you know, it shares in a productive company that's doing good work. And do you want that to be something natively on Bitcoin and tradable for some directly via some DEX on Bitcoin, or can that exist in some other layer, or is that better on some other blockchain? And I really do hope that I think because every other asset has more counterparty trust somehow, that it is perfectly reasonable for those assets to exist on a platform that has more counterparty trust. And maybe that's a layer on top of Bitcoin. Maybe it's a centralized exchange. I don't know, but or maybe it's. I mean, okay, now I'm going to actually piss people off. Maybe it's even like, I don't know, Ethereum and someone's trading with wrapped Bitcoin, right? But like because they all require some other, every other asset requires more counterparty trust. It makes sense for them to be on another layer, and that allows us to square the circle of your point that we can keep Bitcoin to be this kind of more pristine thing that's really just for the money, for Bitcoin, and still have, you know, other assets, you know, like say stock in some productive company, tradable natively for Bitcoin.
Yeah, I'd say that Bitcoin, the way I personally want it to evolve is just to adapt to the world around it, but like still be money throughout whatever external threats it needs to adapt to. But still this notion of, like, most users just want send, receive, and don't change. Like the notion of Bitcoin is money is the thing I don't want to change. And I agree with Matt to some extent that, like, the full extent that we have to scale in layers, and even if that means like people doing other stuff with other shit, then that's fine, as long as Bitcoin stays being money. That's my personal opinion.
If it's only money, then there's still use cases, like you said, like there are counterparty trust, we still have that somewhere else. This will like then again justify decentralized institutions and stuff, right? So if we
okay, so the thing about decentralization, this word I hear a lot, but I view that as in Bitcoin as an unfortunate means to a greater end, which is absolutely finite money. So the reason we need it in Bitcoin is because we can't trust, for instance, Chris to run the money printer and trust him to not ever use it. That's why we need decentralization in Bitcoin, to make sure that no one ever presses the print more money button. That's the main reason that decentralization is important.
No, we also need decentralization because if like 20% of nodes don't relay my transaction, I rely on other nodes that they relay my transaction so that I can.
But you're still.
Yeah, but that's part of that, though. Like it's part of. Yeah, sure. You need send and receive and absolute finite. That's what you're saying, right?
We need decentralization for a multitude of reasons, and it's a good thing that we have it, and it's the only blockchain that has it.
Yes, I agree.
Yeah, I think Peter Wille always says that blockchains are the worst possible protocol invented to synchronize databases. It just so happens to be the only one that has the properties we want here.
Sounds like what Churchill said about democracy.
What is your take on DAOs, decentralized autonomous organizations, and currently the narrative of the governments moving towards decentralized money, proposing their own coins, and also targeting this market of decentralized Bitcoin or Ethereum or their own coins or with their own currency against fiat? So what is your take on that? Is that a way for the governments to control the communities or people or nations through their own policies from a decentralized way? How do you see that?
So if I understand the question correctly, do we think that a government-issued shitcoin is a threat to Bitcoin? Or is that like, because if you have an exposure to fiat currency, that does not excite me. It will come, we will have a digital Swiss franc, we will have a digital euro. The premise is the same. There will be a central emitting party, and there will be a value to that that is ever diluted, and that does not interest me. It will come. People might use it. There will be some, forced use, like you have to use it to pay your taxes, whatever.
Yeah.
But, yeah.
And to play on the earlier, I think there was an earlier point somewhere that you can't ever really have another Bitcoin. Like it just doesn't. Bitcoin has this finite limit, and like if you try to create another Bitcoin that also has a finite limit, then I mean this was like early in Bitcoin, 2011, whatever. This was always the argument people had. Like someone's like, oh, Bitcoin is great, it has a fixed 21 million limit, and then someone would respond like, oh, but I'm just going to create my own Bitcoin with a fixed 21 million limit. Haha, now you don't have a fixed one. But the solution to that is, well, screw you, all right, we're just going to value the first one, and that's going to be the one, right? And so you can't ever really if you accept that there can be more than one, then you must also then accept that none of them have any value because there can just be infinite. And so there's other things that can exist and have other value because they're productive assets or whatever, but you can't have another Bitcoin or another asset like Bitcoin because that would defeat the whole point.
Yeah, and to the point about the DAO, decentralized autonomous, or is it autonomous or automatic? I don't know, organizations. Like, I don't think there's anything inherently good with an organization being decentralized just for the sake of being decentralized. Meritocracies and hierarchies, there's nothing wrong with them as long as they're consensual. Like, there's nothing. An organization is 99 times of 100 it functions much better if there is a hierarchy and a boss on top and stuff. And sound money fixes that so that we all have the correct incentives and it can't be politically influenced. So like, I don't think decentralization in itself is a goal to strive for most things in society. They function better if they're actually meritocratic and hierarchical. So I don't know why anyone would. It sounds to me like workers control factories, and it doesn't work. If you know how capitalism works and why communism doesn't work, you don't really see the point in the workers controlling the factories.
So yeah, I think a DAO is a solution to a problem that does not exist. And as to your earlier point, there will not be another Bitcoin. So you're saying you will sell your Paul Stort's eCash fork futures?
If they have any value.
Oh, not the futures, the actual thing.
But you could sell them now.
Can we sell pasts instead of futures?
You can. People will not understand you.
No. I'm used to it.
Is there any other question?
You previously said that to accommodate for more use cases on Bitcoin, we have to scale in layers. But what if the base layer needs changes? And what could be the rationale to make those changes to accommodate for those new layers?
Yeah. I think it's true that we do occasionally, like that happens, right? We've done that in the past. I think we should continue to do that into the future. Apparently this panel does too, and we need to pull somebody up here who disagrees so that we can have a more representative view. But like I think it's a question of finding, and this is kind of the role of the technical community in this process, right? Is like finding the most narrow change which accomplishes the goal and doesn't have any other side effects, ideally, right? Like I think a change to Bitcoin, a fork of Bitcoin, fundamentally is everybody getting together, entire Bitcoin community, and saying, the system defined by these consensus rules is no longer what we're going to consider Bitcoin and is no longer what we're going to value. Now, it's the system defined by these consensus rules that we're going to call Bitcoin and value. And okay, soft forks have nice properties because it kind of enforces that the other one can no longer exist either. But fundamentally, that's what we're doing. We're all agreeing that something new is Bitcoin. And so for that to make sense, you really have to have something where there's no sustained disagreement. You know, maybe some people disagree on the nuance. There's always going to be technical people who are like, but we could do it that way or we could do it that way. But there's no sustained disagreement. There's no one saying like, that breaks my use case of Bitcoin and I can no longer use Bitcoin or I will no longer use Bitcoin as a result of that change. And so, yeah, I think like that's our threshold, and that allows us to make those kinds of changes where, you know, we add CTV or CSV, potentially CTV, but I was thinking of CSV or CLTV or whatever, or Taproot to enable certain things that, and I think CSV and CLTV are really great examples where they're just really narrow things that like make Lightning better. I mean, SegWit was a broader thing to enable Lightning, but like, you know, CSV is like, we can't, you know, ignoring SegWit, like we couldn't have done Lightning without CSV, right? And it's just this really narrow thing that enables a broad set of use cases. So I think that's really
including inheritance.
Potentially.
I mean, CSV, CLTV with Miniscript, we have like a really a way. The first time we can have inheritance in a trustless way.
Yeah, we need to extend the time limit of CSV.
Did you see my slide pro that use case this morning?
Was I encouraging in that slides creation?
Sounds like you're fishing for something here.
I'm not sure. Well, we're all in agreement here.
There's another soft fork. If someone wants to propose a soft fork and get a soft fork under the belt, 4x the CSV time limit. So just propose it. I almost guarantee you it'll activate. So if somebody wants to be the guy with the next soft fork after BIP 54 and whatever else comes after that, CSV 4x the limit.
From 65,535 blocks to how many?
I don't know. Is it currently like a year or something, right? No.
15 months.
15 months. So I don't know. Make it a few years.
Yeah. I agree to that. But yeah, so the question was probably how do we get another soft fork? And I think, somebody needs to come up with a really, really hacky way, like Binohash, and annoy people and prove that we can do it already. So let's at least do it properly because the MEV is already there.
Thank you, guys.
Final words.
It was really good.
Thank you.
Thank you.
And thank you all for hanging out. I know it's pretty warm in here. Very excited about ending our first day of the first ever Bitcoin++ Economics Edition. Another round of applause for all of our speakers, sponsors, everyone who came. Thank you.
Okay, thanks everyone. Thanks for joining us for this afternoon session. We'll get started. So, my name is Merrick. Online, I'm usually known as Regular Merrick. I'll be giving this talk, Bitcoin Yield, Lessons from the DeFi Space. Lost screen. Are you still getting it there? Yeah, show it here. Oh, maybe I tripped the cable. I literally just, did I touch the cable? Yeah, it's okay. Okay, we'll pick up there. So yeah, a little bit about me. I'll try to avoid that spot on the floor. Okay. Should I keep going? Okay, wonderful. So I'm kind of a former professor. I used to be Professor Merrick online. I don't teach anymore, so that's how I became Regular Merrick. I co-founded Canada's first academic blockchain research lab back in 2015. Since then, for, I would say, the last couple of years, I've been doing sort of like a gonzo-style deep dive, very, very deep in that space, into decentralized finance. It's also called finance. So, I think that if anyone's familiar with that movie, Fear and Loathing in Las Vegas, I highly recommend watching it. Great film. Also, in terms of vibes, I think it kind of captured a lot of the vibes of that DeFi era over the last couple of years, which has been a lot of fun. These days, I run my own, I call full stack consultancy. If you think I can help you out with anything you're working on, feel free to reach out. My contact info is there, also be at the end. So my perspectives on DeFi, and I guess giving some, positioning this talk a little bit, is that, DeFi, decentralized finance, experienced a Cambrian explosion, I would say like back in 2020 through 2021 sort of era, complete with all the innovation and chaos and ultimately extinction that one might expect from the Cambrian explosion. So, I mean, I could spend a lot of time, and I guess we as, Bitcoiners do spend a lot of time criticizing DeFi and other blockchain networks and stuff, but instead I'll focus on kind of like maybe some of the lessons that are learned, and how those can potentially be applied towards Bitcoin finance in the future. So what I will do is, explore some concepts and terminology from DeFi that I think are applicable, that are relevant. Discuss some frameworks for thinking about risk and rewards, and also, as I mentioned, implications for Bitcoin. What I won't be doing too much is focusing too much on like, TradFi kind of funds where people, invested with their stock portfolio or whatnot. We won't talk a lot about macroeconomics. This will certainly be more kind of microeconomic kind of discussion, and we won't get too deep into technical implementations or exploit details or anything of that nature. So first I'd just like to open this up and maybe frame it. This is I'm not involved with this website, bitcoinyield.com. Great website, and the founders like really passionate about this stuff, and it's early days for them. To give them a follow on Twitter as well. They have been talking about Bitcoin yield for a while, and they have this wonderful website where they sort of have like a dashboard where you can quickly at a glance check up on all the Bitcoin yield opportunities. I know this is kind of a lot to take in, but I guess the reason I'm presenting this and showing this is because it's hard to get a talk level right for everyone. For some people will know all this stuff and be kind of bored. Other people, this was kind of way out of left field for others. My hope is that with some of the concepts that we talk about today, this Bitcoin yield dashboard will be legible for everyone, and they'll be able to kind of make sense of it, and if they choose to participate in Bitcoin yield. So yeah, just some general concepts to begin with. I often, I've been accused of being a Bitcoin maximalist on more than one occasion. I do talk to a lot of like the laser eye kind of folks, right? And when I sort of present these ideas or talk about DeFi, they're like, oh, nothing kind of useful or interesting kind of came out of there. I usually sort of trot this example out, right, where this nomenclature or term like MEV or miner or maximum extractable value sort of come into the Bitcoin discourse over the last couple of years, and my observation is that actually came out of some activity on on another network back in DeFi summer. So what is MEV? It's this notion that transactions that are initiated by like a market taker, right? Someone who initiates a blockchain transaction, whether on any blockchain network. Also, at the same time, when they generate that transaction, if it's a financial transaction, generates a corresponding opportunity for others to make money by reordering that transaction in some way, right? So example of this could be, miners auctioning off the ability, or anyone auctioning off the ability to stake in a lucrative but capped opportunity, meaning only the first 5 Bitcoin can participate in this, and then there's like a race created by that, right, for those spots to be taken. Another one, which is another example, which is called sandwich attacking, right? When there's like an on-chain, some sort of market, right, where people are buying or selling things. There's the when someone's buying something in one of those, an automatic market maker, or even a central limit order book system, right? There's a possibility for someone to front run that, right? Let's say they're buying a token, right? Someone could come in before them, buy the token, raising the price, right? And then they would basically sell that person the token that they're trying to buy at a higher price, right? That's a classic example of sandwiching. So in DeFi summer, back in 2020, it kind of happened on the Ethereum network. There was a slow realization actually there that miners don't need to order transactions by fee, right? Or include transactions by the fees that are paid, right? Similar fee mechanism to what we see on Bitcoin. And in sort of stage one, early on in the summer, people started realizing, hey, if I pay a higher fee, I can get higher priority than these other market participants, right? Then what that soon turned into is sophisticated actors started paying miners directly through like sort of side channel payments to reorder or front run transactions, right? And I would say like that's probably where we are with Bitcoin today, right? In terms of like transactions and things that are going on. And then stage 3, which I think some people sort of talk about as potentially like happening to Bitcoin one day, and would be probably a bad thing, is where miners become integrated market makers and arbitrageurs to them. They themselves, like an integrated stack where they themselves extract that MEV. So this has actually already sort of been observed on Bitcoin in a way. Back in 2024, Babylon Protocol launched a capped staking opportunity where people would have to execute these Bitcoin transactions to participate, and fees at that day spiked up to like 600 sats per VByte, whereas sort of like the background fee rate now is, I would say, around or less than one sat per VByte. So it can actually increase activity there. And then that was just showing that people were willing to pay that much to get their transactions in, right? And therefore, like miners could, that sort of quantifies the value that MEV created. Now I want to talk a little bit about automatic market makers or AMMs. Drink of water. And basically the idea is that in an AMM or automatic market maker, you can basically create an automated protocol using code that sets the price of two tokens against each other using a constant product, meaning that if you have what the protocol does or the software does is it keeps a constant product of token A. The amount of token A times the amount of token B is always a constant product. And Uniswap V2 was one of the first key protocols that actually rolled this out. Not the first, but it was the first one to actually get real traction. And that sort of kicked off this DeFi summer back in 2020. And in an AMM, there's two classes of users, right? There's liquidity providers, which who usually have tokens or have money, right? And they put their tokens into what's called a liquidity pool. And then trades, when other people want to trade on the AMM, the trades are executed within this liquidity pool. So what liquidity providers get in exchange for providing like these liquid tokens into the pool is they often get an LP token, which represents their position, and the ratio of the tokens that the LPs have in these positions can be derived from the current price of the tokens based on the equation above there. So when traders trade, they place market orders buying or selling into the pool. And these trades, right, incur fees, could potentially incur fees depending on the settings of the pool. And these fees are paid to the liquidity providers proportional to the amount that they've deposited into the pool, right? So interestingly, though, I guess what we found, though, or what was found in DeFi Summer, was that the liquidity providers take on a lot of risk and they're subject to real losses, such as if you're talking about volatile tokens, right, in this LP, and the prices of the tokens start dropping, right, obviously the value of the LP's position also can drop very rapidly. Then in addition to that, right, in addition to price depreciation or price decreasing, there's also this concept called impermanent loss, which is a terrible name, by the way. A lot of this stuff has just absolute terrible naming conventions and is going to cause confusion for years to come. But anyway, let's go with that name, impermanent loss. And what impermanent loss is this idea that the liquidity provider, right, would have had more value, made more money if they counterfactually had not participated in this LP position. Instead, they magically knew which side of that pair would go up the most, right? And so impermanent loss is the difference between the maximum they could have counterfactually made versus what they really made by participating, right? So it's sort of a conceptual thing. And again, it's a terrible name. So the fees I mentioned on the previous slide were generally insufficient to compensate liquidity providers for the impermanent loss and the real loss that they take participating. So the solution was for protocols and projects to heavily incentivize LP deposits, and we're going to talk about this a little bit more when we talk about staking. I do want to make kind of interesting kind of point here that I think has a direct parallel to Bitcoin and Lightning as it is today. At some point, I can't remember the exact year, I probably should have written that down, Uniswap v2 moved on to Uniswap v3, and the reasoning for that is that Uniswap v3 was meant to solve this problem of impermanent loss, right? So what LPs were now able to do would be to specify within which price ranges their liquidity would be active and inactive, right? So they were basically able to selectively choose, how to avoid their impermanent loss, essentially, right? They were still subject to the price volatility, though, right? If the tokens that they were, had in this pool went to zero, this zero still had zero, right? So the realization here, though, is that doing this, actively managing this liquidity, required a lot more sophistication and risk management and things of this nature by the LPs to keep their positions profitable, right? It was a lot more involved than V2, which was just sort of, you fire tokens in there and forget it. So what the consequences are, I guess, for Lightning Network, in a bit of a way, in analogy, right? I'm not going to attempt to explain optimal Bitcoin routing, Lightning routing and Lightning, channel deployment, things like that. Other speakers are going to do that way better than me. The only point I want to make here is that, the optimal deployment is based on expected flows through this directed graph of transactions, right? But with in the future, there's some proposals right now, and some things are being rolled out right now, in fact, right? Using Taproot assets to issue stable coins and other assets onto Lightning. So that, again, this is a little bit forward-looking, right? That these protocols aren't finalized, and so forth. But it seems that these channels could be thought of as being like analogous to these AMM liquidity pools, right? With two tokens, right? Essentially in the channel. And that implies that Lightning Network providers will also have to manage liquidity of the token pairs that they have, like BTC being one of them, and whatever volatile token is there, right? So they're going to have to manage that liquidity in addition to the graph optimization challenge that other speakers have discussed, and I just sort of alluded to, right? Again, it's really not known how this stuff will be implemented. They may use a constant product mechanism, like the AMM mechanism I presented earlier. It may be some different mechanism, right? But I think in any case, right, they're still going to have to manage that liquidity, right, of the multiple tokens in addition to managing the routing. I got 5 minutes left. Okay, we're zooming through here. So yeah, that's so Lightning operators are going to have to get more sophisticated and less hobbyist. This is already kind of happening, and it is what it is. I think other speakers have mentioned this as well. Some quick reward concepts. I'll try to stick to the high-level concepts. I'm informed we're running late, and I'll just try to zoom through the high-level stuff, I guess, at this point. So, sources of yield and rewards, I guess, in general in DeFi, and this definitely applies to Bitcoin ecosystem as well, come from two places: transaction fees from economic activity, so-called real yield, I suppose, and then also printed tokens, right? Essentially, creating tokens out of thin air, and hopefully those tokens have some value, and sort of paying the yield that way. That's sort of another very common way. So we'll zoom through staking because we have very little time, but generally this concept of staking, I won't cover restaking, but staking is this idea of voluntarily subjecting coins or tokens you own to some encumbrances in exchange for rewards, potentially including yield, voting rights, consensus participation, and things like this, right? These encumbrances could include locking for some time, potential losses from slashing, which are rules around the staking, which are usually made clear beforehand, and also delays when unstaking tokens as well. Those are some of the things around staking. So, so I mentioned earlier why sort of, rewards were introduced, and staking is usually the mechanism through which rewards end up being distributed, right? Why staking? Mostly for signaling purposes, right? Like protocols want to signal that they are like valuable, useful protocols. The vanity metric used in DeFi is TVL, total value locked, which is analogous in traditional finance, assets under management, AUM, right? Oftentimes, big funds and banks will tout, oh, we've got this huge AUM, right? So it's sort of a signaling thing. Yeah, I think we'll probably leave that there. I think, yeah, we'll leave that there for now. Reward vaults, I think we can skip. Maybe just point out a bit of confusion, right? When you talk about vaults in DeFi, right, or like Bitcoin vaults, usually, like, yeah, if on, for example, a Bitcoin yield.com site, right, that's got no relation to OpVault, BIP 345, right? It's really more of a user experience sort of term, right? A vault is sort of where you deposit your funds, some things happen in the background, and hopefully you earn a yield and don't lose your funds, right? That's the bottom line. Yeah, one thing about APR versus APY, I want to point out, the previous speaker definitely mentioned APR, right? APR is the annual rate of return without compounding. APY, on the other hand, is the annual rate of return with compounding. And why this is misleading often in DeFi, or was misleading in DeFi, is because of short market cycles, right? And also combined with in a APY compounding yield scenario, right? Most of the gains are made at the end, right? So you actually have to make it to the end, right? So a lot of these protocols fail or go to zero or whatever before those large numbers are realized, right? So that's something to maybe be aware of. Kind of like if you see APY out there, right, on some protocol, you scratch your head and be like, why is this number so high, right? Oops, I'm going backwards. Okay. I think we'll skip that one. Let's talk a little bit about risk. I think I want to get to the interesting bits. So risks, right? When you're thinking about risk, I know I got to wrap this up. Risks can apply to the user's initial capital that they put into the yield opportunity, right? Risks can also apply to realizing the yield itself, right? So there's sort of risks to the initial capital. There's also risks to the money you think you're going to make, right? So that's something important to keep in mind, right? As I mentioned earlier about sophistication, to really participate in these things, right, requires sophistication on parts of the participants, right? Risk management, things of this nature. And I think this was mentioned earlier as well. The higher the risk, the higher the reward, right? The inverse is often also true, right? That's important to think about when considering yield opportunities. There's a few broad categories of risk. You can just go to bitcoinyield.com. This isn't straight off their website, but they talk about a lot of the similar stuff. So if you're interested in what kinds of risk your Bitcoin could face in yield scenarios, take a look there. We'll skip through there. This is something I do want to mention. I know we're running on time here. Some high-level thoughts on risk frameworks. I've been thinking about this stuff for several years now. Many risk frameworks have been proposed in the past and will be proposed in the future, right? It's kind of, I would say it's kind of like a very difficult problem because there's a tendency to either make the risk framework too simple and just oversimplify things, or make it so complicated and have so many moving parts that it's intractable for someone to actually use the framework, if that makes sense. There's also an expectation of unknowns in these protocols, right? Like black swans that come up. And so, I think that a good way of framing or looking at risk, right, is starting with an enumeration of the possible risks that you face, right? Like how many ways can I get wrecked, right? And actually, bitcoinyield.com is kind of going in that direction as well, which is really great to see. So I think there's going to be more work done there in the future. And yeah, last thing I want to point out, possibly the last thing I want to point out before I wrap it up here, is in terms of like a risk matrix, right? A way, if you're thinking about participating in some of these things, or maybe to answer the question of who participates or who are these yield earning opportunities really for, right? So I created this table, right? Along the left side is sort of different levels of yield that people can expect, different reward levels, right? So on the high side, right, back in DeFi summer, we saw APYs and APRs in the thousands of %, right? Which should have your risk alarm going off. Why is it so high, right? So I kind of call that the gamble zone, right? High risk, high reward gamble zone. The medium risk and medium and low risk for high yield rewards like don't exist. That's why they're blank. Someone's telling you that it's a lie. Then in the medium rewards category, around like 20%, right? I call this the catnip zone, right? Is because like traditional finance players, retail users, degens, everybody like it's sort of plausible, right? It's plausible that you can earn 20% on something. Why? Because people pay around 20% on credit card interest, right? So mentally, it kind of makes sense, right? That's why I call it the catnip zone, right? So it's of interest not only to so-called DeFi degens, right, which are the sort of gambler persona. They're also this level of rewards also kind of appeals to high net worth individuals and funds. A lot of the time, this high net worth individuals and funds, because they have large pools of money, right? They're also interested potentially in low risk, low reward. Sorry, I should say low APY, low APR opportunities of all kinds, right? And so that's sort of the passive income zone, yeah. And then there's this whole other group of folks, right, that aren't gamblers and they don't have a lot of funds, right? And I'm in this bucket, right? And that's sort of the work to earn category, right? Where you probably get higher EV from just earning money the old-fashioned way and just stacking sats, right? So that's something to sort of take into account when considering these. I had a case study, but I think I'll just go to like the last few takeaways. Expect more hacks, right? Generative AI, LLMs are getting a lot better at finding exploits, so just be aware of that. And lastly, another observation, maybe I guess my last point or last observation was that what we saw sort of, I would say, towards the end of DeFi summer was a lot of different layer 2s emerging, and liquidity was sort of fragmented among those things, among those L2s. And then there was sort of like this game of musical chairs. Is like, where's the hot ball of money going to go to now, right? So we're seeing this sort of proliferation of L2s on Bitcoin now. So maybe that's something that we will see happening as well. And I guess we're out of time, and so probably no time for questions. So I'll just wrap it there. Okay, well, then let's take some questions. I already zoomed through, a lot of material there. I'm not going to rewind it. Yeah.
So you showed the dashboard before, and I know it's not live data, but it had some yields like 4.5%, and I'm assuming that you know the protocols quite well. So
there are always new ones coming up. To be honest, this is from today, actually, this morning. I took the snapshot this morning. Yeah.
Probably it's still accurate, and I'm wondering, do you know it well enough to explain to us where is 4.5% actually coming from Bitcoin?
On that one, so this one's saying that the reward asset that they're getting is some sort of like wrap BTC. Yeah, I took this off the cuff just to show the dashboard. I wouldn't be able to go through these. What you can do actually is I suggest you go to bitcoin.com, bitcoinyield.com, and you can it has all the info on the protocols, and you can research there. That'd be what I advise.
Some of that is lending. A bunch of it's lending. People do DeFi lending in Bitcoin for USDC and then pay relatively high yield.
Yeah, so they actually tell you the category of yield, right? So Zest protocol is a lending protocol, for example. Oh, but I guess your comment is at the back there, right? Is that these vault strategies, right, deploy Bitcoin into a number of different I would say like strategies, including lending, right? So it's sort of like a mixed bag, right, in terms of the vault. Yeah, so I would have to look into, in this case, what SBTC is, right? If it's some sort of wrap BTC, that implies it's being paid in Bitcoin or some sort of, maybe it's a, yeah, okay, Stacks. So Stacks BTC, I think, is backed by real BTC, so. Yeah, it's like a big, right, I know. It's a mixed bag for sure. Yes.
For the Morpho vault, I know this is what they do. You get Morpho token as part of this 1%.
Yeah.
Yeah. Like so again, I kind of really skipped through that slide really quickly, right? I mentioned that yield rewards can come from like real economic activity, including things like Lightning Network, right? Potentially interest paid through lending and so forth. But the majority, right, is inflationary printed tokens, right? Which these again these protocols use a number of different mechanisms to sort of give those inflationary tokens value. I skipped over there's a whole thing on Olympus now, but it's just as well we didn't really go through that. Oh yeah, impermanent loss, yeah. Yeah. Look, I might have like glossed over that one bit, but that was the intention, right? Is that when you have the tokens in an LP position, the relative balance of those is going to change over time, right? According to the constant product equation. Yeah. Right. See, you're. Yeah. I mean, we could I didn't really want to give the super long explanation of it, right? For time, right? But essentially you're correct, absolutely. Yeah.
Just a really quick question. So we see all these palisades embedded BTC, right? Or wrap BTC. What's your favorite?
None of them. Actually, me personally, I don't see the point of holding a wrap Bitcoin, right? I suppose like people can make money, right, doing that, right, given the right opportunities. But again, I'm in that work to earn zone, so. Okay. Yeah. Where is it, or why is it? Yeah, it's. Oh yeah. There's more to this list actually. This is cut off just for So Babylon is like way down there.
This is sorted by year.
It is, yeah. It's APR. Sort of. Yeah, good question. Yeah. I don't know any. I know it went down a lot. It went down a lot since. Okay, well, thanks everyone. It was kind of like a run and then go slow kind of talk. And now we got back on time. Everybody's happy. Let's have a good afternoon.
Cool. So I wanted to talk briefly about quantum stuff, which is, of course, the topic du jour, but is surprisingly an economic question, so we'll get into that. So many of us obviously work on the tech side of Bitcoin, but Bitcoin is obviously fundamentally also an economic system. It is both a technical one and very much an economic one. Obviously quantum is the topic du jour. Lots of discussion about what to do about quantum. In the short term, there's obviously this question about enabling migration, adding a new address type, and whatever. But this isn't a technical conference, and those are pure technical questions. So instead, I want to focus on the actual economic question, which is how does Bitcoin react when a CRQC is built? And I have no idea how to make this. Okay, there we go. So this is the singular interesting question, of course, about quantum. Will spends with elliptic curves be disabled or not? Of course, those who migrate their coins immediately to whatever comes first will be fine. That's not really a question. But making them fully safe will require another fork to disable EC in some Taproot v2 or Peta-Merkle root nonsense, whatever. But what I really mean here, and the real question is what happens to Potoshi's coins? Will the probably 2 million or so Bitcoin that has exposed public keys at the time be readily stolen by a quantum computer? And then maybe the next million or so Bitcoin on top that has to expose their public key to spend, will those be stolen by a public computer, quantum computer, or will Bitcoin do something about it? Obviously there will be a soft fork proposed. There already have been variants of it. The soft fork would presumably disable elliptic curve for any spends that need to use it, but they will also, of course, allow HD wallets or seed phrase-based wallets to reclaim their funds, probably also some kind of op return pre-commitment so that Satoshi could retain their funds without moving their coins. But of course, in the process of that, you have to also burn all the rest of the coins. So anything else that hasn't upgraded, that doesn't have a seed phrase or do some kind of pre-commitment. It's a package, right? There's all or nothing. And so there's this fork, right, that will presumably be proposed. There'll be a soft fork that is an option there. And will Bitcoin take it? Will Bitcoin disable elliptic curve cryptography or not? So this is, of course, an economic question. This is not a technical one. You can't give a technical answer to this. Lots of people have philosophical viewpoints on it, so there's kind of a philosophical question here too. But that's great that people have philosophical viewpoints, but that doesn't mean anything. It's an economic question. The whole concept of Bitcoin isn't a fixed thing. There is not a thing that we can refer to that is clearly Bitcoin. There's a set of consensus rules. And we colloquially refer to the system that is defined by those consensus rules as Bitcoin. And that set of consensus rules changes occasionally, right? We do forks, including soft forks. What really happens is we're all agreeing to call some system defined by a different set of rules Bitcoin and stop calling the old thing Bitcoin. That's what we're doing when we fork Bitcoin. But of course, what happens if people disagree? Which one is Bitcoin? If there's a fork that disables EC and a fork that doesn't, which one is Bitcoin? How do we figure that out? And in the absence of clarity on this and what defines Bitcoin, the market will speak, and I think people will follow. I would submit to you that it doesn't entirely matter what Bitcoin is. What really matters is what has economic value. Who wants to use the token that has almost no value, whether it's called Bitcoin or not? Now, it's important to note that Bitcoin has very little value, if any, if there are two Bitcoins, right? If there's both this fork and that fork, and some people refer to that as Bitcoin, some people refer to this as Bitcoin, Bitcoin has no value. The whole value proposition was this 21 million coins, et cetera, et cetera. The market will presumably not value both of those coins at anywhere close to par of the previous Bitcoin. So then the market is very strongly incentivized to pick one and stick to it. In fact, we saw this with SegWit2x. In fact, not even did the market pick one and stick to it, the market picked one before the fork was even supposed to happen, right? So Bitfinex created a futures market, and what exchange doesn't want free money to create a futures market and let people trade on this? And what people don't want free money? Market participants, by getting extra yield by selling the thing that won't be Bitcoin in their view and buying more of the thing that will be Bitcoin after the fork. So of course this market had pretty decent volume, and it did make very clear that the market wanted not SegWit2x, and that is part of what killed SegWit2x. So in the case of these kinds of disagreements, based on empirical evidence and probably realistically, the market will speak and will make the decision before the fork even becomes a concern. Okay, so great. The market's going to decide this, and that's how Bitcoin decides in the face of a fork. But what is the market going to decide, right? I'm going to take a brief detour before I get to the slide here. For the purposes of discussion here, I want to focus on a specific scenario. I'll get into other scenarios a little later, but I want to focus on a specific scenario that I think is the most realistic. And that is, let's say, for the sake of argument, in 10 years, I don't know, Google announces publicly, we've got a quantum computer. It has calculated elliptic curve discrete log up to 64 bits or something, and we have this demonstrated growth trajectory, and we're really confident we're going to get to a full, cryptographically relevant quantum computer in 6 months. They're very confident, and it's very believable. Not this current wishy-washy, there's a 10% chance that we get really lucky and we build something by 2030. No, actually something in hand that is demonstratable. Maybe for the sake of argument, they have one, but they haven't started stealing any Bitcoin yet, but maybe the night janitor will start stealing Bitcoin soon. But it's very close, it's very demonstrable, and everyone in the Bitcoin community can realistically agree that it's going to happen and it's going to happen soon, right? This is the scenario we really want to talk about. I'll talk briefly about other scenarios in the end, but I think this is the most likely outcome. This is kind of the trajectory that these things are going on, and maybe quantum ends up being impossible, but if it does get built, this seems to be the most likely scenario, at least based on where we currently are, because that's kind of the way we're trending. So to the slide, the narrative around what to do in the face of a quantum computer has evolved a little bit, but the very first reaction everyone has is, of course, the knee-jerk economic reaction of supply and demand, right? If we have this fork, one where a quantum computer is stealing a bunch of Bitcoin, and one where they're not, then one is presumably going to have a whole lot more supply, and the other one is not. And so, of course, the other one's going to be more valuable because, you know, supply and demand. So it's important, though, to be clear about what we mean here, right? So today, you know, there's X Bitcoin being traded every day. But we really want to talk about Bitcoin changing hands for really long-term ownership. What we don't want to talk about is, you know, someone selling Bitcoin to buy Bitcoin ETFs, which happens. We don't want to talk about necessarily momentum traders because that's not some kind of long-term supply difference that's going to materially impact the long-term price trajectory of these two forks, right? We don't want to talk about people selling their Bitcoin to buy shares on Strategy, which also happens. We really want to just focus on the people selling Bitcoin from, you know, someone selling Bitcoin and someone buying Bitcoin for actual ownership. They actually want to own Bitcoin for, you know, more than an hour or something. So yeah, you know, there's going to be, you know, there's X Bitcoin being sold on this fork. There's presumably X plus Y being sold on this fork because they haven't disabled EC, and that's a lot of money. So this Y, you know, it's unclear. There's debate as to whether this person who owns a quantum computer and is stealing Bitcoin is going to like dump it all immediately or dump it slowly over time. But suffice to say, it's a lot of Bitcoin. So, you know, either way, it's going to add up to a lot. Probably also, Y here includes people selling Bitcoin because they're worried about the damage to Bitcoin's reputation, and also they're worried that this other guy is selling a ton of Bitcoin, so they're presumably also going to exit their position and selling Bitcoin. You know, one way or another, this is going to result in the supply curve of that fork of Bitcoin shifting substantially, right? The supply overhang of 1 or 2 million Bitcoin isn't something that we can trivially deal with. There have been some naive, I would call them naive, efforts to kind of estimate how much damage this would do, like how quickly can Bitcoin absorb a huge supply shock like that. But yeah, I would say they're very naive. They largely have used market value as a market volume as a proxy for this, which I would argue isn't very interesting. You know, there are, again, I mentioned these examples. I think there really are people that you can point to who have been selling Bitcoin to buy Strategy and they've gotten wrecked, or just selling Bitcoin to buy paper Bitcoin and ETFs because it's more convenient for them for one reason or another. And so unless you're kind of an exchange, it's hard to break out those market segments of who's selling Bitcoin Y and who's buying Bitcoin Y. As a naive proxy, we can look at Cash App, which is it's a brokerage, right? It's not an exchange. It's fairly consumer focused. In their, according to my agent, so who knows if it's true, their regulatory filings say they sell about $1 billion in Bitcoin per quarter. So it's something like 10,000 Bitcoin, depending on the price. So assuming, which I think this is a wrong assumption, but assuming that they were to continue selling something like that many Bitcoin in the face of a quantum computer stealing a bunch of Bitcoin, then it's not that much Bitcoin, right? That's something like 1%, maybe 0.5% of the amount of Bitcoin that the quantum computer operator would be able to steal. And so that's not something that you can get rid of quickly, right? So a quarter times 100 adds up to quite a few years. So suffice to say, I think the current discussion where people are claiming that actually Bitcoin will just buy a few million Bitcoin, the market will just buy a few million Bitcoin quickly and a quantum computer won't be a big deal is highly naive. So yeah, so you know, in this discussion, kind of the immediate thing people come to is, well, the supply only exists on one side of the fork, and so the other side of the fork will obviously win because it has way less supply, and I mean a lot less supply. But, of course, if the field of economics were just a simple, naive study of supply and demand and we never went any deeper, the field would have been done sometime in the 1800s and we would never have any new economics papers. That's obviously not the case. So the philosophy of Bitcoin does matter too, right? So the next conclusion that everyone came with after the first narrative got kind of popular is everyone looked around and said, well, wait a second now. If Bitcoin were just naive supply and demand, the 99% of the coins would always vote, and they would always seize the other 1% of the coins, and this would be better because they would have less supply, and so we would just be doing this all the time. Now, obviously, that doesn't happen, so clearly that's not it. And like, yeah, duh, both sides of the supply and demand curve do matter, and they're driven by the philosophy of why people value Bitcoin. Why people think that Bitcoin should have value matters because more than just supply and demand, it matters because of the philosophy of what Bitcoin is and what Bitcoin means to people. So yeah, I mean, there's like this, digital gold, but also that's driven by this concept of seizure resistance, right? Like no one can take your Bitcoin from you except by breaking into your house and stealing it, or maybe you screwing up your digital security, but no one can steal your Bitcoin. That's the value proposition of Bitcoin, and that is a big part of why it has value to begin with. So then people say, well, my first conclusion was nonsense. I was just thinking about supply and demand. That's too naive. I should have been thinking about the philosophy, so I must have been wrong. And maybe actually the answer is the other side, where Bitcoin just is clearly not going to disable elliptic curve because that was just, the first one was wrong, so I'm going to pick the other one. I would also say this is naive, right? And because the problem is you can phrase this Bitcoin philosophy very different ways that are all equivalent today, but are totally different in the face of a quantum computer, right? So maybe today you might say, well, no one can seize your Bitcoin, or you might say that no one can steal your Bitcoin. But in the face of a quantum computer, these are lead you to two totally different directions, but today these phrasings are totally equivalent, right? What if you say no one can seize your Bitcoin? It's now ambiguous, what it should mean. It's worth pointing out that disabling EC has other philosophical implications, right? So I've seen some OG Bitcoiners arguing that, one thing that really matters is that Satoshi, or whoever owns lots of coins, shouldn't be forced to reveal themselves in order to retain ownership. They shouldn't be forced to make on-chain transactions in order to retain ownership. Well, this is only possible if you disable EC and give them an option to do some kind of pre-commitment scheme. So all that to say, the philosophy is maybe more ambiguous than the current narrative is giving it credit for. It's really hard to say, even ignoring the current narrative, it's really hard to say what the Bitcoin market is actually going to think on this point, right? There's loud people on social media who have very strong opinions about this, but Bitcoin market participants is a lot more than just social media. What does Saylor think, right? Maybe it doesn't matter what BlackRock thinks. They probably won't be taking customer funds and trading them on a futures exchange, but Saylor, MicroStrategy, has no such restriction. What about billionaires who invested in Bitcoin in 2014? I'm not aware of any of them shitposting on social media about this topic. Personally, I think it's ambiguous which one is more aligned with Bitcoin's philosophy, and so the supply overhang might have a bigger impact on the decision market participants make than the current discourse gives it credit for. But of course, it's hard to know for sure. It's probably worth pointing out that market participants' decision to how to value and how to resolve these philosophical questions depends a lot on the exact scenarios. I threw out a scenario earlier, where it's been kind of a decade since the rollout of pay to Taproot v2, pay to Merkle root, whatever, some kind of scheme to upgrade, and the timeline there makes a huge difference. Right? Because are market participants going to be so philosophically concerned with the risk of seizing this tiny majority of coins that hasn't upgraded yet by the time this soft fork is being discussed and being rolled out, but would upgrade before the quantum computer starts stealing money? Or are they going to be more concerned with all the coins that haven't upgraded yet and still won't upgrade by the time the quantum computer starts stealing money? So if it's been a decade and the vast majority of wallets have upgraded, and so kind of anyone transacting, paying attention to Bitcoin has upgraded, probably this philosophical question of stealing coins isn't all that relevant because the fork isn't going to steal any other coins that weren't going to be stolen by the quantum computer to begin with. But on the other hand, if it hasn't been very long, or wallets are rushing to ship these kind of upgrades right at the last minute, now all of a sudden that portion of coins is pretty substantial. And then that philosophical question becomes much more practical. And now the market's probably going to value that much more. So yeah, so it depends a lot on these very, very exact scenarios. And I really want to drive that point home, that like a lot of the narrative today ends up being focused on different scenarios, and so it just, they talk past each other. So on to the current discourse a little more. Obviously there's a lot of social media influencers who've taken very strong positions now that is different than 3 months ago on not disabling EC. But for the most part, when you really dig into their views, they're talking about a different scenario than what I just threw out. Right? So less necessarily disagreement on philosophy and more disagreement on the philosophy that is downstream of the very specific scenario they're viewing. Now, after all, BIP 361 is actually proposing that we ignore all publicly known progress on quantum computers and we actually just disable EC spend paths 2 years after migration time, after migration starts. Empirically, this hasn't even been enough for wallets to roll out new address type support, sending to new addresses, let alone get people to start using them and migrating to them. So yeah, of course, that becomes a much more real example, and you're actually going to end up seizing quite a few coins if you were to do something that aggressive on that timeline. And so, naturally, a lot of the current discourse has been, hell no, that's crazy, which, fair. But further underlying this view has been this view that quantum computing, or often underlying this view, has been that quantum computing isn't going to continue growing as it has, right? With this very public, large companies, many labs working on quantum computers and being very public about their progress, mostly because of their investors, right? They need to be public in their progress in order to continue getting money. But that instead, at some point in the future, surreptitiously and forcibly, the US government or some other government will acquire all of these startups and large companies and whatever, and keep the progress secret. Now, personally, I find this view a little weird, right? The US government suddenly acquiring every quantum lab would probably make pretty clear what's going on, giving away the game, which would also then defeat the point of them surreptitiously acquiring all the quantum labs to begin with. But also, the US government is currently running around telling everyone that they have to have made good progress on the quantum migration by 2030, which would undercut a lot of the value of them going and surreptitiously acquiring all the quantum labs to begin with. This also, of course, misses the entire revenue model for all of these labs and their incentive structure, which is in order to keep getting investor money, they have to be public about how great their results are. You could argue the US government's going to go acquire them all for billions and billions and billions in order to pay back their investors, et cetera, and give them good returns. But we just haven't seen that kind of example in recent US government policy. And also all of them would have to agree and no one would have to leak this information. So personally, I find this scenario a little unlikely. But again, this underlies a lot of the current discussion when you talk to people about their views on quantum and seizing coins. Their views have been informed by a view that this is the most likely scenario. Of course, then there's also the question of if the US government actually were to be the ones to surreptitiously acquire all the quantum computers, would they actually start stealing the Bitcoin, right? In a startup that has built a quantum computer, a cryptographically relevant quantum computer, maybe the night janitor has access to the machine when it's not running their biomedical simulations or whatever, or maybe the poor grad student who is running the lab for them and just living on ramen decides to spend a few extra cycles and steal some Bitcoin, but the NSA might very well have slightly better corporate controls than some startup. So even there, is it as relevant if the quantum computer is not public? But all that to say, I think we probably can't take the current influencer views on Twitter and X and whatever as serious indication, specifically of future market participants, right? Whether the influencers change their view by then or not, is the market going to follow it? And I think that their scenario they're basing their views on is unrealistic. So when we get to a real scenario that we get to, and a quantum computer is actually staring us down, are they going to have the same views or are they going to shift because it's a different scenario than what they imagined? Now, we almost certainly got years before market participants need to make a decision, right? And so it's, are people's views final, and then, are they representative of the actual market? So where does this leave us? All this to say, it's kind of hard to know what Bitcoin will do. It depends a lot on the scenario, but in my view, the most likely scenario, right, where we've activated some migration scheme, hopefully soon, and people have had a decade or whatever to migrate, and then Google is very public about their progress, strongly favors the market overriding some of these philosophical concerns for the practical concerns, because the philosophical concerns will look very, very much more theoretical based on the amount of time that people have had to migrate. But, ultimately, this is up to the market, and the futures market specifically, and not us today. I think it's worth pointing out that somewhat sadly, we probably won't be able to get a good signal until that time. Right? If someone were to start a futures market for this theoretical fork today, they wouldn't end up measuring what the market is actually going to pick in a real-world scenario. They're going to end up measuring the people betting on directionality of social sentiment. Right? Now, I'm going to bet that the influencers are going to start saying something else in 6 months' time, and so I'm going to bet on this futures market on that. That's not really a useful signal as to will Bitcoin actually make that decision or the other decision come time, especially if it ends up being a decade or 2 decades down the road. So until then, it's kind of hard to add all that much more to the conversation than what has already been said. There's some value probably in figuring out how much Bitcoin supply actually changes hands every day, maybe to better understand the size of the impact on a large supply overhang of 2 to 3 million Bitcoin, call it. But the market participants' fear of damage to Bitcoin's reputation from a quantum computer is really hard to value. How do we evaluate that today, especially 10 years down the road, 20 years down the road, however long it takes for a quantum computer to be built? Until then, yeah, we kind of have to wait. We have shorter-term things for developers to build and allow migration to start, but until a quantum computer is actually staring us down, this is kind of the only thing we can do. So thank you, and I think we might have time for 1 or 2 questions. We also don't have to have any questions, but Ben, sure.
Do you want the microphone?
Just yell it out, I can repeat it.
So something you didn't talk about that I worry about is if we don't freeze, it could screw up mining incentives. If we don't freeze, it could screw up mining incentives where, today there's no reason really to 51% attack and rewrite blocks because you just get the same block reward you otherwise would get today. Yeah. But if you don't freeze coins, then there's now like 1 to 2 million Bitcoin you could steal by rewriting blocks. Yeah. And that was kind of a huge incentive to always 51% attack until there's like a shit ton of blocks on top of that.
I think, so first of all, that's probably not a huge concern immediately, right? Like if Google or some startup builds the first quantum computer, there's not 3 quantum computers competing to steal the Bitcoin quickly. So it's less of a concern in the immediate term, like after the first cryptographically relevant quantum computer is built. It is a concern, but I think, ultimately, like the market's going to decide in a futures market before the fork even happens. Like basically, once the quantum computer, once someone is like, I'm going to have a quantum computer in 6 months, and everyone actually believes them, then the fork is going to be proposed and it's going to activate in 3 months or whatever, and then you're going to have a futures market, and the market's going to decide before it even gets there. And so yeah, if the market decides no, and they steal the Bitcoin but not fast enough, there's definitely some concern, and that's something that market participants will presumably evaluate, and I think might also favor market participants voting for stealing the coins and preferring to use that Bitcoin rather than the other Bitcoin. But yeah.
Cool. We have time for one more question, if there is one.
There's one in the front here.
Oh, sorry.
Hey, thanks for your talk. That was very interesting. I acknowledge this is like kind of a crazy idea and also very slippery, slopey. But as long as there's a proposal out there to like seize or freeze Bitcoin or whatever, right? Have you heard of anyone like propose to take those seize Satoshi coins or whatever, and like backload emissions for another 100 years or so?
Yeah, I mean, there's certainly people throwing out ideas like that. There's also other ideas that are more around ways to reduce the impact, but not necessarily seize the coins. I personally find those unlikely, so I think it'll be binary. So part of the reason is that if your goal is to blunt the philosophical concerns by allowing the maximum number of people possible to retain ownership, then one thing you have to do is you have to say, you can still spend with a proof that you know the seed phrase or a proof that you know a BIP32 derivation or maybe some kind of pre-commitment scheme. And what that implies is that no one actually knows which coins are frozen, permanently lost. And so it is very hard to then take those coins and add more emission because no one is sure ever, right? Especially if you do pre-commitment, no one can ever, like if you only do BIP32, fine, okay, you know that coins before the existence of BIP32 are frozen. No one could have used BIP32 before it was created, or probably not. But if you allow pre-commitment, so if you allow Satoshi or Patoshi to say, I'm going to commit to this future public key, I'm going to commit to it on-chain in like an op return hidden thing, hash, to this public key before the quantum computer exists, and Bitcoin is going to choose to honor that commitment, then you never know, no one will ever know for sure, did Patoshi's coins get burned, or does Patoshi still have access to it via some op return commitment? I guess in theory, if no one does an op return commitment, you could see it, but like, someone will just put some hashes in op return so that it's ambiguous. And I think that because like if market participants are going to choose the fork that has burned the coins, my assumption is that they will prefer a fork that potentially burns coins that is maximally philosophically aligned, which would include things like the pre-commitment. You could skip the pre-commitment. You could say, actually, we're going to do this fork and only do BIP32 derivations. I think that's a little less likely because it has more philosophical implications, and my assumption is that the market will, even if it prefers to burn, it will still want the maximally less philosophical implication burn. Or at least I hope it does, but maybe that's just hopium. I don't know. All right, thank you.
I really hate podiums. I hate this whole format. I want to kind of stand in front, but I'm sure the cameras are set up for me standing here. So apologies in advance. Cool. I assume you can see my presentation? Great, excellent. Okay, this is very retro. I picked this up because I didn't have one. It's a laser pointer. I haven't used one of these for ages. There are no cats, but, and I can't even point at the displays, so it's completely useless. But if you see me distracted, it's because I'm distracting myself with my laser pointer. Okay, and I do want to apologize. There are some very, very cool slides that I've seen. Everyone's using LLMs to produce theirs. You can tell I did not. This is monochrome. Okay, so that's unfortunate. If I try, I'll try to remember to add sound effects or something as we change slides to make it a little bit more interesting for you. Okay, so my name is Rusty Russell. I'm going to talk about my new project, and this is it in a sentence. So we're just going to break the sentence down, and that's my talk, and then we'll have questions. Okay, so Sentry Metadata is a service to store and retrieve auxiliary data. And I'm trying to explain what this is. I'm going to give you an example, right? So this will describe kind of the problem I'm trying to solve. Okay, so your cool aunt, age 83, in tragic bungee jumping accident, died recently. But before that, she gave you the treasure map that showed you where to find her 12 words and all that stuff, right? And so after the wake, you go and you dig up the tree stump and do the thing and pull out the 12 words, and you get your favorite wallet and your cold card, and you put in your 12 words and everything else, and then you sync everything up and you discover nothing. There's actually no coins attached. And that's kind of weird because she was like the crazy Bitcoin aunt, and you were pretty sure there was supposed to be something there, and there isn't. So, you double check the 12 words, and you look for other things, and maybe you read the map upside down, but it was definitely all there, and you've missed something. In fact, it was, her husband, Uncle Bob, they did everything together, and it was in fact a one of two wallet. And you've only got one of the seeds. If only you had this tiny, tiny bit of extra data, you wouldn't go through life thinking that shit stiffed you and it was an elaborate joke. because you couldn't find the funds. This is the power of auxiliary data. Okay, so for this vision to work, for something that keeps this auxiliary data around, you want it to be long-term. And in the century metadata sense, we think about, will this be accessible in 100 years? And that's actually a pretty hard question to answer. The obvious things you go to are obviously like cryptography, quantum. And quantum's bullshit, but over 100 years, it's probably not. So you've got to take that into account, right? So you think cryptography. But actually, there's a bigger problem, and a problem that's really close to my heart, and that is the actual format itself of this data, right? The standards, the simplicity involved in pulling this stuff apart, assuming that you get it back and everything else is solved. This is, I think, the kind of really interesting work. And it's happening slowly. As an industry, generally, computing is terrible with the idea of anything that requires forethought. But we are getting better with standards and things like that, and it's something that I think is really, really important. Because, you know, that hardware wallet you bought from that company that went bankrupt in 2030 after the third time that they leaked all the customer data, that proprietary blob is going to be completely useless in 30 years. No one's going to know what to do with it. So standards, formats are actually really important. Okay. Storage. Okay, well, this is a technical audience, so let's talk about what the actual mechanism that we have at the moment looks like. It's a web API, and there are 3 steps. The first step is you register your payment. You say, cool, I want to buy 8K of storage. It's a very small amount of data for 100 years attached to this key pair, a writer key and a reader key. And you pay once. And when I say pay once, I'm thinking $2 to $5, right? Sort of not trivial amount, but certainly something you could probably stomach. If you're going to buy a hardware wallet, you could probably shell out a little bit extra and get this. So you do that once. So Aunt Alice, if only she'd done that sometime in her life. And then whenever you want, you provide this encrypted blob, signed by that writer key that you registered. There's a generation counter in there. The new ones replace the old ones. Very, very simple storage system. Okay. Of course, backup is important. Restore is even more important. And this is the part that makes it work. It's public data. Anyone can retrieve it, right? This simplifies the problem vastly, right? Interestingly, this is only really possible because the only people currently who have an incentive to keep a secret from which they can derive an encryption key are Bitcoiners. Everyone else wants a very different service. But if you're a Bitcoiner, you're presumably incentivized to keep your 12, 24 words, whatever, secret somewhere. And if you have that, we can leverage that and the power of cryptography to create what is effectively a public service. Right? Now, while the data is public, of course, the contents need to be private. Pretty straightforwardly, you're thinking, okay, well, that's what cryptography is for, and that is true. That kind of makes the whole thing work. But it's not sufficient, right? You not only need to protect the contents of the data, but the access patterns, right? You don't want the service or anyone else to know that this is your particular blob of data. Now, this is something that will evolve over time, but for the moment, the solution is we use eCash. So you basically make your payment, however, to the mint, you get a bearer token, and that is what you use that first time when you register your keys. That's how you pay. So we've at least somewhat detached the payment from the registration steps. Right? Plus, it allowed me to set up an eCash mint, which was kind of fun. Send, of course, you're all going to use Tor. Let's be serious, you're not all going to use Tor. So at the very least, we don't want to know which one you're writing to. The very simplest way to do this is just to allow you to bounce through our multiple independent servers. So at least the server doing the writing doesn't know what IP address you're coming from. On the receive side, it's actually, you can be a little bit more sophisticated and still get a long way. Again, you should be using Tor. But even if you're not, there are 2 things that we do. Firstly, when you fetch your data, you actually specify a bitmap of like 1,000 random blocks to XOR together. and you fetch this from multiple different servers, you're the only one that can XOR them back together and extract the actual block that you're interested in. As long as they don't collude, they're not going to know what you're actually after. And even if they do, we bundle these tiny blocks into bundles of 1,000. So worst case, we know you're interested in something in this 1,000 bundles, but we still won't know which one is yours. I anticipate over the next 100 years, these methods will become more sophisticated. The current state of the art of PIR, which this is basically, is usually computationally quite intensive. So that rules out a lot of the other methods of doing this. Of course, this is all great, Rusty. Like, you've got this thing, you've got this service, you've got like this, API. It kind of has to be reliable, right? It's supposed to stay around. And this is the data availability problem, right? This is, how do you make sure it's there when I need it? And we talked about 100 years. Like, that's a pretty big ask. It's a big reliability problem. Our industry's not all that great at reliability. Okay, so when I've talked to people casually about this, and a couple of times people have said, oh, no, we are not using a blockchain for storage. I'm sure you can all think of good reasons not to do it, but I'm going to spell them out here for you. 3 reasons why you do not want to do this. And I feel a little bit resentful that I have to spell this out, but yes. Here's why we won't be spamming the blockchain. The first is that if you do have a successful long-term blockchain that is broadly distributed and thus somewhat constrained, it will almost by definition have to be expensive, right? And anybody who builds an organization that assumes that it will not be expensive and yet will somehow survive the test of time is probably being extremely foolish. And businesses in the past that have assumed that Bitcoin blocks will be extremely cheap have generally not done that well. So I can't recommend that. There's a more subtle problem, though, and that is that this is not what the Bitcoin blockchain is for. It's very clearly for financial data, not this weird backup shit, right? This puts you in the problem of being a free rider. This is where the purpose of something and the meaning that everyone gives to it is a certain thing, and you're doing something else and kind of like coasting along for free. The problem with that is the incentive problem. As things change, as things develop, there will be decisions made about the way things should go. And there are 2 things that happen. One is they may deliberately decide to screw you because they don't like you very much, because you're kind of using up stuff and just free riding along. So they may decide to do things that make your life harder. Or it may just be that technical concerns simply don't take you into account and things change in the future. Either way, it's not a comfortable position to be in if you're looking at long-term stability. And of course, the final one is actually you want updates. You don't want every single one of these to be kept forever. You really only need the latest iteration of your data to be kept. So it seems to overkill to use this kind of thing. But really, when we talk about the data availability problem, or this reliable long-term retention, it's not really a technical problem, it's an incentive problem, right? So this is why I'm proposing Sentry metadata as a foundation. A purpose-driven organization with long-term funding, right? So these things are important. This is actually one of the few cases I can think of where a Bitcoin treasury makes sense. I said before that Bitcoiners are the obvious people to use this service because they have some important cryptographic information that they are motivated to keep. So offering them a service that provides retention of encrypted blobs makes sense for them in a way it doesn't for other people who will just lose their seed phrase because they won't care, right? In that case, if Bitcoin goes to 0 and Sentry metadata fails, that's not the worst outcome. So there is an incentive alignment, and there is a reason that an organization like Sentry metadata would want to hold its long-term-ish funding in something like Bitcoin. So I think that actually makes sense. And I see something like this foundation as providing common infrastructure. There are all kinds of services that you could build on top of this. In particular, if you're offering something similar, you could use this as a backstop. This is your insurance. This is your last resort. If all else fails, at least your data will be there in Sentry metadata and retrievable and useful to somebody who has the encryption key. And there are a number of models that people build on top of this, whether they're custodian, whether they're assistant services, all these things, that could benefit from having a reliable uniform layer that they can build on top of. However, if the history of the modern tech world has taught us anything, that is that when you get an ecosystem that is reliant upon a product that is shipped by a for-profit company, you inevitably get the lovely term enshittification. Once they have locked you in, they now try to maximize the juice that they can squeeze from you. In the case of Sentry metadata, that's pretty straightforward to plot, right? The model is you pay once up front, you get 100 years of storage. Well, paying once isn't very cool. What if you could then extract more value from your customers by charging them to retrieve the data and breaking that contract? Just making it more and more difficult for you to get your data back when you need it. That, frankly, is not a product that I'm interested in contributing to or breaking if I see it cross the street. I don't want to do that. And so I think while Sentry metadata will certainly take people's money, having a for-purpose organization that has to do one thing and one thing well is more incentive compatible with what people actually want in practice. So, I've talked about Sentry metadata and I've kind of said, you know, hey, it's all these things. Well, let's actually talk about the status. What do we actually have? Well, this is my last week at Blockstream, so next week I will change into Sentry metadata mode. But I do have some pieces. I have a provisional format specification that specifies what the format looks like, how it's contained, what encryption formats it uses, all those things. Hybrid quantum encryption, we could definitely go deep dive on that. It's pretty cool. But I have 20 minutes, so I'm not going to. I have a tech demo. I have a test server that does all the things. It does the XOR fetching. It does the authorization as well. Okay. It accepts all zeros as the authorization string, but you get the idea, right? You can upload, you can download all those things. I have a couple of client libraries. I have a Python one. I have a Java one, of all things, that do this. You can do the authentication. You can send the encrypted blob off. You can retrieve the encrypted blob, unpack it, get your data back, all that stuff. And the reason it's in Java is actually that I hacked, well, Claude hacked Sparrow Wallet to put Sentry metadata support into Sparrow as an example. So it's a pretty nifty demo that would have saved my Bitcoins that I would have inherited from poor Aunt Alice if only I'd used that version of Sparrow. So that's where it is. So I guess the summary of this is that you will be able to reach me at hello@sentrymetadata.org. I'm going to be raising for the rest of the year, trying to get some foundational funds if I can convince people this is a good idea, that's something that we want to have. And then taking long-term pledges from larger donors, hopefully to build up the treasury. And if everything works and we get product market fit and people think this is great and we can get some traction, then we will be off. So I guess that is, well, 16 minutes, I went fast. Do we have questions?
Thank you. Great idea. Definitely an issue, or an issue to solve. My question is a bit with the motivation you gave basically not to actually challenge it, because I think it's a valid concern. But with Alice, Aunt Alice, this multisig example you gave, or same thing if you use a single sig with passphrase,
yeah.
The plausible deniability there is also a feature that prevents you from a range attack. Just wondering if you have any thoughts on range attack versus discoverability. How do you solve that?
Yeah, so that's an interesting question. I veer more on the side of losing my coins from just my experiences with other people than the whole range attack scenario. I think I would rather have two wallets. I would have like a give up to attackers wallet and a locked in, you can't get it wallet. But interestingly, the two play into the same kind of things. If you want to have a wallet with a vault that was locked and everything else, or you want to have time locks or everything else, you lose this power of having a 12-word seed phrase. You need metadata. You need some auxiliary information. You use Liana, use any of those. They're really cool, but you lose something that I think is really critical, and that is that simplicity of backup. And so I'm trying to square that circle. What do you need? So I think in future, when we have covenants and the world's a wonderful place, and you can do whatever you want with your Bitcoin, you'll really want a service like this that will back up the metadata. So you can return to that at least if you have these 12 words, you can get everything else back and you can recover. I think, in fact, people should always keep their own backups and everything else, but this is the ultimate fallback if everything else fails. And I think that's important to have. The individual setups, however, I think will absolutely vary. And I think they will only get more complicated over time. But from my point of view, I don't think it's a trade-off you should have to make. You should be able to have some sophisticated setup and still have a simple backup. Yeah. Yeah, Stephen?
Yeah, so I hear and understand that you're being very worried and being very careful about the format, because format standards might change over 100 years, so you want it to be very simple or at least understandable by future technology. Mm-hmm. How does that balance with the complexity you seem to have added to retrieve the data with the XOR and all that stuff? Like, doesn't simplifying that also make it more future-proof?
Right, so this is, okay, there's two things. There is the format itself and there's the method by which you receive it. For example, the format itself uses a hybrid encryption scheme, but the retrieval and the update do not use quantum encryption at all, because they can be changed. That's easy to update later, right? If you have more sophisticated retrieval schemes, whatever else. If you, I mean, there's just not that much data, right? The first million users is 8 terabytes, right? You could back it up on archive.org, right? You could have a version there. This is trying to prevent me from knowing stuff that I don't want to know. But that's a transient problem. How do I retrieve that today securely? The bigger problem is, how do I make sure the data is preserved for this period of time? So I see the access method to be something that will absolutely change as we progress things. So I'm not as concerned about access. I mean, it shouldn't be really stupid, but we can definitely riff on future ways of doing that. You know, telepathic access via whatever is definitely in the plan.
Call me stupid, but I still don't understand the core problem. If your aunt, who's bungee jumping, is able to give you the 12 words, why couldn't she also give you the 8 kilobyte of metadata?
Yes, why couldn't she? Well, because the SD card was in her pocket during the tragic accident. I mean, the 12 words is... Yeah, I wonder where she put that sheet of paper.
The 12 words, where did she put them?
No, because the 12 words are much easier. You know, at some point, you do not understand how powerful the BIP39, as sucks as a standard as it does, it really did enable a very powerful way of intuitively and understandably backing something up. Once you add some digital data to that you also have to preserve, you have not just quantitatively, but qualitatively change the backup game. Now you need some media. You can't just write it down by hand. I mean, in theory you could, but you're not going to, right? You're going to print it out somewhere, you put it on an SD card that'll rot, or USB key or something like that. That is a very different problem, and we've already seen problems with this, right? And so it herd's people into this single sig, easy backup. Anything more sophisticated, no simple backup. And I think that's a terrible choice to drive people into. Because I love some of the inheritance schemes and multi-sig schemes people have come up with, except they fall down on this test. So I am passionate about, and by the way, 12, not 24 words, I think this is actually a real innovation and something that Bitcoin actually brought to the table in a very practical sense. So from my point of view, that really just reduces the hurdle to kind of self-sovereignty and your ability to actually retain your coins in a way that very few other things that we've done in the Bitcoin world, perhaps with the exception of hardware wallets as an industry, have really moved the needle. So in my mind, this keeps that, what I consider incredibly important attribute of making things easy to back up.
Why would I use this compared to Google Drive, Apple Drive?
You would use both. You would absolutely use Google Drive, because they have never killed a product or jerked it out from users. And you know, given you're paying them so much to preserve it.
Here I'm trusting a company that doesn't even exist and that I have no clue will exist in 100 years. I think there is certainly a better chance that Google will be around in 100 years than this non-existent company will be there, right?
Perhaps.
So,
and
also like the money I pay at Google to store the data is nothing, and here you were talking about like a few dollars. I mean, yeah, it's not a big amount, but like, you know, I'm getting probably a better chance of the data still being there in 100 years. I'm paying less for it. Why would I use this service?
You absolutely shouldn't use this service. Go do it. I mean, this is the problem with anything, right? This is the trust issue of data retention. Part of it is that you form a Swiss foundation with a constitution that is well funded and has one purpose. The second is you get serious people, and I consider myself to be a serious person, someone who is giving up their career to do this. I mean, I can't get much more serious than this. I don't know what else I can do to convince you that I'm trying really hard to do this. I've been in this space for a while. I've been a full-time open source contributor for like 25 years as a job. Like, that's one of the reasons I feel I have to do this, because I think I do bring credibility. And if I can get this to the point where I feel it has a real shot, then I will absolutely try to convince you that this is going to be around in 100 years.
Yeah, but you will not be here in 100 years.
That is true. That's why I'm setting up a foundation that will be funded and have a single purpose, and that is to ensure the availability of your data for 100 years. And that will be its only reason for existing, right? And that's about as good as you can do. In fact, it's interesting, there's a whole legal question on where you domicile this, because in most places you can't really do this. Your board will actually get to control it, and if they change directions, you're screwed. Switzerland and Liechtenstein being the exceptions.
And were you also thinking about like maybe more technical approaches to the same problem?
The technical approaches, while I find them interesting because I'm a geek, are actually not really the hard problem. It is the data availability. It's the why would you give me my data back in 100 years question. It's not really a technical question. I mean, you've got to solve the technical things too, but you really have to solve this incentive problem.
Yeah,
and
but I mean technical. I mean with incentives, of course, to have like you know, decentralized nodes. You know, like Bitcoin, right? Like you have a nodes all around the world who store the same kind of blockchain, and there are solutions where you can, you know, shard the data and make some of the nodes store some of the data.
Yes, I don't believe you'll get it for the kind of cost that you're interested in. Right?
Even with
Centralized
sharding.
systems like that are extremely expensive to run. Bitcoin is incredibly expensive to run.
Yeah, because Bitcoin doesn't do any kind of sharding, but if you can shard, then that gets...
Okay, you're wrong. I mean, in the sense that you can shard, but then you've got less reliability. You've got to make a trade-off.
Yeah, of course. But you maybe don't need like 20,000 nodes all around the world storing the data. I mean, here we are talking about like one company storing the data, right? So maybe you want like 200 nodes around the world storing the data, right? So you can basically shard into what, like 10,000 divided by 200, right? So that it gets that much cheaper, even if you just compare it to Bitcoin, right?
Okay, so run the numbers and figure out how much you're going to pay for that storage, and you'll realize why this is actually a really hard problem for 100 years.
Okay, but you were mentioning, what, 8 terabytes, if I'm not mistaken?
For the first million users, yeah.
First million?
Yeah.
Okay.
Yeah. Cool.
Thanks. I think this is a very fascinating idea to think about the fact to have data available in 100 years. And as I understand you, you're shifting the technical question to a more, let's call it, political or organizational question, because the foundation of your project is, I mean, literally your foundation, and you need to have this foundation up and running in 100 years from now. So you mentioned you're planning to do this in Switzerland or Liechtenstein, but what's your probability? Because jurisdictions change, people change. You have to think about succession. You have to do proper funding. What if the Bitcoin gets lost? All the things. So, in your view, is this a thing that you're sure of that it will be working, or it is more like an experiment where you say, yeah, would be nice, but we can't be sure about this?
Yes, it is an experiment, because all things, like if I haven't done it before, it's definitely an experiment. I think we have a good shot at making this work. And I think we have a good shot at making a strong case that you will look at this and go, that is actually worth me giving over my $3, whatever it is. Because I actually think they have a convincing case that this will last. Now, nuclear war, all these kind of things, you could, you know, there are all kinds of failure scenarios that are definitely would reduce this probability. But taking a place that is as stable as possible, that you've given it enough flexibility, not too much flexibility, they can't steal the Bitcoin, yes. Can they, long-term storage, all these things. They're going to need some good backup, Sentry metadata, all that stuff. I think we can overcome these. I really do. And I want this product to exist. And I know that if I don't build it, I don't think anyone else is ready to step up. Because it's incredibly ambitious. As you said, I'm not going to be around 100 years. Why would I do this? And the answer is because I really want someone to do it. I think this is important. And so this is, I think, the best way I know of to produce this. And I'm going to be spending the rest of the year soliciting feedback from people and seeing if there are ways we can refine this and find out how good a shot we have.
All right, thanks.
Yeah, I think it's a really interesting and ambitious experiment. I think I like the idea, basically. I think I'm more optimistic on the thing that it can work than rather than it won't. I think probably you thought about making the storage always available or available for the long time. So on a technical level, at the moment, what's the intuition you have? Is it going to have multiple zones to store the data? Is it going to have data availability sampling or stuff like that?
So, I mean, there's actually not that much data. So you can spray it pretty widely. I mean, given a reasonable amount of funding, you can use missions, including self-hosting, all the things, right? High redundancy for this level of data, which is one of the reasons that it's so small, is actually a pretty easy technical problem. The more problems are on the political side, right? The control side and everything else. But actually storing in multiple places and making it widely available, as long as you've got active maintenance, is certainly something that I think is pretty straightforward. I know everyone wants like the giant vault with USB keys in it or something, but you don't actually need that.
Do you think that this Sentry metadata could be like a centralization point that could be in some way taken by a nation state or something?
On the one hand, that's a sign of success, right? Secondly, there's nothing magical about Sentry. I mean, yes, it'll hold some Bitcoin, and potentially, they seize the Bitcoin because they want the, maybe Bitcoin moons, right? And it turns out that's worth way more money than whatever else. The data itself, though, like some rando in this room could replicate it and keep serving it. Like, it's actually not that hard. Obviously, then you've got looser guarantees because probably you're not all going to be around 100 years. But seizing it for the data itself would be weird because it's public data. Like, why would you do that? So I think this comes under a subset of like political threat. Like, what about stability? What about over this time period? How do you know this organization will survive? And there are things you can try to do that people have tried to do, but there are no guarantees over that period of time. I will probably be running it for the next 25 years, but even then, that's a long time. Things can change.
So do you plan to have like guides for people to actually actively replicate all the data just in case Switzerland decides to kill you or something? I mean, kill the company, not you. so that like people can come
What do you
back
know
up.
that I don't?
Kind of like the Pirate Bay model where like people just keep up spinning copies in case stuff goes bad.
Yeah, I mean, my intention was to fund a distributed network of people who will replicate this. Because they're not going to charge very much because it's pretty cheap, right? I think anyone who runs a Lightning node, here, take some sats, store the data for me. As many different ways that we can store the data, as long as we don't use a blockchain, is fine.
Cool. If there's still more time for questions, a small technical detail question. You talk about the 12 words. Most more complex multi-sig wallet that need this kind of stuff usually have a bunch of keys that all kind of have the same descriptor. Do you think about duplication? Because if you have 12 keys that have different hierarchies of time locks and stuff, they're all kind of storing for the different 12-word phrases for each of the keys the same metadata. Yep. Could there be some kind of deduplication identifier that points to some other one or something like that?
Pay your $3 each. I don't think we need to deduplicate on that level. I mean, to some extent, just all. I mean, it will be duplicated, but we wouldn't be able to tell. It will be encrypted. In my example, this one of two example, I have that live. So it's you basically restore your Sparrow wallet with your 12 words, and back comes, it's actually the wallet descriptor covers the fact that it's a 2 of 2, and here's the XPub of Bob, and all your funds are available, including the labels as well. It backs those up. So I don't think we need to go as far as deduplication. But yeah, I think because we've got these great standards now for wallet descriptors, miniscript descriptors, PSBTs, we can leverage all that to describe almost arbitrary hierarchies that people want to build, which I hope will enable them to do it without fear. Because now they know, well, if all else fails, I can still back up without these extra attachments. I mean, you should still back up yourself, of course, but it's nice to have this insurance if something goes wrong.
Yeah, I was just thinking, if most use cases are going to store the same data at least 3 times, you could just like have your entire data by 3.
Yeah, but profit.
Hey, Rusty. Yeah, I just had a general comment. Like, really enjoyed this. I love this idea. Yeah, when you're speaking to normies, like the likes of my family, like, it scares the shit out of them that there is complexity beyond the 12 words. So, you know, that's why, even though I don't work for Unchained or whatever, but I see the merits in Unchained, and that their whole business, you know, ultimately they're banking on holding on to your descriptor for you as well, you know? So like, it's like I can do the backups for normies and family and friends, but the fact that Unchained can hold that descriptor for them too is also peace of mind for me if I have to trust the normie that I know could well fuck things up. So
this is actually very interesting. There are 2 things here. One is that for the normies, they won't know this even exists, right? Because when they restore their wallet, it will automatically look on Sentry metadata and grab their data back, right? So it has to be integrated at the wallet level. So you and I might know it exists, but as infrastructure, it should just be everywhere and ubiquitous. But the second one is a company that does this should logically sign their client up for like $5 to Sentry metadata so that they've got a backup as well, right? So that the customer may not even know, but if, you know, Unchained gets hit by a meteorite or something, the data's still there. And this is what I talked about, having like there are a lot of businesses who could benefit from having this, at least as an insurance or a backstop to what they're already doing. Even if their ultimate customer doesn't have direct access. I worry that a lot of these companies are spinning these up and they're not all gonna survive. And it would be great if the data at least did in some sense.
Thank you, everyone. Great topic. The next holy book, I guess, that we're trying to create. But we're gonna have a coffee/bagel break until 15:45, and I think we have one more talk, right? 1 or 2 more talks. Okay. Oh, okay. So thank you.
Anyway, thank you everyone for showing up. I'm just gonna touch on P2Pool V2, which we've been working on for a while, and talk about how it, in our bid to kind of make a scalable payout system, we basically ended up having a hash rate market. And because this is all about economics, we want to kind of touch upon how the market might look like, what the market design might look like, and then basically call for help. If there's any economists out here or, you know, fintech gurus who might want to kind of contribute to the design of this market. So to get to that, I'll give a quick and very brisk background of why P2Pool V2 we are building it, what is its payout mechanism, and then get into the market details, okay? So, of course, we know there is a big centralization pressure. This is a cursory slide to put in to say, look, there's a lot of pools out there, it seems, but there's a lot of proxy pools out there. So a lot of mining pools are getting more and more centralized, especially as FPPS is becoming more adopted across the mining space. So this is the customary slide to do that. So SV2 and Datum do a big job in helping decentralization of template production, which is super awesome. What that basically means is, for those who don't know, is that the miners themselves build the block template and then ship the shares back to this pool. And the pool then makes the payouts, depending on whatever it thinks is the right thing to do. So the question becomes, how do we decentralize payouts as well, if we can do that? I mean, another thing to note is with the centralization pressure of the payouts, this is a bit of a risk for Bitcoin, which is what we really believe, which is like, you know, they could be forced to censor some transactions. Not that those mining pools are bad operators, but it's just that because they have a centralized point of contact, they could be forced to kind of censor stuff, right? And, you know, they do provide a centralized point of failure. The other thing is, if you look around the mining pool setups right now, it seems there's a lot of trusted setups. People just trust the pool to do the right thing. There's very little auditing of what's happening on the pool itself. Do the shares make sense? Some pools have made an effort to kind of say, number one being Brains, who've kind of published something in the past, which is like, here, you can download all the data and verify that we are paying out correctly. But that is another concern in the mining pool ecosystem. So now I'm going to talk about the original P2 pool and why and how we are trying to do P2 pool v2. So the original P2 pool basically had the right ideas. You just look around everywhere, and the ideas were right? They had a share chain, which is basically a blockchain of weak Bitcoin blocks, right? Which, if they don't meet the Bitcoin difficulty, but they meet the share chain difficulty, they become part of the blockchain, right? The payouts were from the Coinbase. So it was a decentralized ledger, you could say, of share chain data, of share data, right? Whatever miners have, the shares they've generated, they would be replicated across this blockchain, across all the P2 pool nodes. And the payouts from Coinbase would basically look at the state of the share chain, do the accounting on it, and decide, OK, this, based on this PPLNS, on this data, this should be the distribution of the reward, right? And every other node on the network was validating it. So it was really trust minimized, you might say it. And there was no centralized operator because it was a blockchain, right? And to me, this basically vibes very strongly with what Satoshi said, which is that P2P networks, P2P networks seem to be holding their own, right? So for me, it's like, if you want to build a solution which is resisting censorship, you have to go P2P, right? So from that perspective, extending P2 pool makes a lot of sense, or rebooting P2 pool makes a lot of sense. So if P2 pool was such a good idea, why did it fail, right? That's the question. So the number one, there was a few reasons, right? Some of the reasons were because it was a linear chain, it didn't have an ability to kind of scale as more miners joined, right? As there were more miners joining, there was the probability of orphans increased, right? That two nodes, two miners produced a share at more or less the same time. One won the race, and the other one became an orphan. So the orphan would not get a reward. That was in the P2 pool design. And that kind of, sometimes in worst case situations when the latency was going up and down, could be as high as 10% orphan rate, right? And that kind of annoyed miners a little bit, but that's not the biggest reason for the failure, right? The other thing annoying for the miners was the hash rate reporting on P2 pool was a bit iffy. And the reason for this is, just take a moment here, right? That you have a P2 pool node, and a lot of ASICs machines are connected to it. And they were all mining to the difficulty of the pool, not their individual difficulty, right? They were not being told, here, work on this difficulty so that on an average you produce a share every 10 seconds, right? Instead, they were going, OK, P2 pool says the difficulty is this much for a 30-second block time, right? So smaller machines, which were, say, smaller miners, would produce shares very infrequently, once an hour, once a day, right? And that led to very small sample data to correctly estimate their hash rate, right? So basically, a miner would connect to, say, Antpool and say, this machine reports 1 terahash, but when I connect to P2 pool, the pool reports my machine's hash rate as, say, half a terahash. So that was a bit of an annoyance too, source of confusion and all this thing. We kind of solved this problem, and we can touch upon that later. The biggest problem was that payouts couldn't scale economically, right? In the sense that if you had 500 miners working on the pool, you would have 500 outputs in the Coinbase, right? And that meant if there was 1,000, there would be 1,000 outputs in the Coinbase. That means you're eating up the block space, which could be used for earning fees, right? So in the high fees environment, you're leaving a lot of money on the table. And then some firmware started to ship with updates which limited the size of the Coinbase. And this was a real killer as well. That meant a bunch of the latest hardware at that time could not support P2 pool. And that was kind of one of the straw that broke the camel's back as well. So all of these two things together slowly led to P2 pool going out of favor with the miners. Because I think Coinbase and the scaling problem for Coinbase is important, I wanted to throw this number up, that if you have, in today's systems, if you have 1,000 outputs Coinbase, you end up taking about 3 to 4% of block space just for the Coinbase. So just to kind of put things in perspective. So how do we solve all these problems, right? So the number one is the orphan rate issue. What we do is instead of a linear chain, we kind of build a DAG instead, which is we just allow uncle blocks, right? So that if there are orphans, they are still included in the chain, and they are given a reward, slightly discounted, but they still get a reward, right? And the blocks, the shares that include the uncles, so the black blocks there, they basically get an extra bonus for including a reference to the uncle block. So this is a system which is well understood in the space by now. There's a lot of chains who've been playing around with uncle blocks and DAGs. So, and there's been lots of academic research on what are the best parameters to choose. So we kind of lean on that and say, OK, let's make, instead of a linear chain, a DAG of shares. So that kind of solves the orphan rate issue. The other thing we do is the original P2 pool didn't have support for transactions. So we basically say, all right, we have full UTXO transaction script-based system available on the P2 pool share chain as well. So it becomes a fully valid UTXO chain, a blockchain, right? The Coinbases of all of the shares basically go reward one coin to the miner that mined the block. So when I'm mining a block, when I'm mining a share, I basically put my own Coinbase into that, so that if it ends up in the share chain, I will have that Coinbase owned to me. And by the way, we do some commitment stuff so that this share header stuff is committed into the Bitcoin block Coinbase as well. So that's a small detail there. But then the other things is the box with the TXs is like the transactions of the P2 pool share chain, right? So now these Coinbases can be bought and sold, just like you basically buy and sell Bitcoin on the Bitcoin blockchain as well. So this is the second thing we do. Now, why we do this, I'll get to it in a second. So what ends up happening is, this is the Coinbase kind of looks like when, for a Bitcoin block, when the P2 pool miners build the Bitcoin block, right? Essentially, there is a list of miners or market makers who get payouts directly from the Coinbase. And the other miners basically still have the access to their Coinbase, which they can buy and sell later, to be honest, right? So this is what we are able to do. What we are able to do now is that smaller miners are able to sell their UTXO outputs from the P2 pool share chain, bear with me a second, in return for Bitcoin, okay? And then we have a constant size Bitcoin Coinbase, right? Independent of the pool size, the top 20, the top 50, whatever it is, they go into the Coinbase of the Bitcoin block, and the other miners are just sitting outside and trade it later. I'm gonna get into the details of this a bit later, but I just wanted to touch on this for now. So in the end, we basically end up with a share chain with transaction with UTXO and script support. And at the moment, we're live on testnet in a kind of stealth way. We kind of just have 4 nodes running and mining away just to see if things are working, trying to test it out. So we end up with a situation. I get this question asked a lot. That's why I wanted to say it here, that miners definitely build their own templates, right? Because people ask me, oh, are we still building our templates? Because this is top of mind right now. Then the largest miners get paid from the Coinbases of Bitcoin. And the smaller miners, they have hash rate now, an instrument which represents their hash rate which they can sell, which is their UTXOs on the Coinbase, on the P2 pool Coinbase. So I know it's kind of, I'm going very fast, deep into it, but I'll keep revisiting some of the topics, so things hopefully will become clearer later on as we progress. So this is what I just said, that the shared chain Coinbases are instruments that basically are a reflection of the hash rate. They're basically representing proof of work that has happened. And now these UTXOs that exist on the P2 pool chain probabilistically yield a Bitcoin, right? So if the pool hash rate is 1%, there is a certain probability that my UTXO on the P2 pool chain will give me a Bitcoin in the next 20 days, right? So this is what kind of enables some kind of market on top, right? This is what we want to get to later on. But I just wanted to highlight this point that essentially you have an instrument reflecting your hash rate that you can now sell, right, or swap for Bitcoin. So I think that's very interesting. So I just wanted to kind of revisit this, how this happens, and please be patient with my Excalibur diagrams, right? So imagine we have a situation where the current state of affairs is miner A has one Coinbase, and the market maker or any other larger miner has no other Coinbases at all. So the bottom layer shows what the accounting would look like at that point. At that point, if you were to build a block, you would give 100% of the reward to the miner A and no reward to anybody else, right? So now let's say a miner A mines another share, which has generated another Coinbase for miner A. So now the situation looks like miner A has 2 shares, and the market maker has none. Still, 100% of the rewards go to the miner. Now, let's say, for example, that miner A decides to sell one of the Coinbases to the market maker for whatever reason, right? But they do that. And in the share chain, we can see that the accounting should result in miner A and market maker A both have equal weight of 1 for the reward. So they would get 50% of the rewards, right? So basically, what you've done is miner A has sold his UTXO, or the hash rate instrument, to another market maker, to another somebody else, whoever that might be. And they basically, the other party, the party that bought the share, will now have a probability of earning some Bitcoin depending on the pool hash rate and the market conditions and all that stuff, right? But at this point, miner A got Bitcoin from the market maker. Now, of course, this will be discounted, but this is what we want to get into the economics of. Does that make sense till now? Was it all mad? OK. So basically, we just traded hash rate in a decentralized market. This is what we think is pretty exciting. So there is a bunch of questions at this point, right? What does this market look like? How is this hash rate priced? And what are the constraints of this market, right? Is there an expiry? Is there a maturity? And so on and so forth. And I thought this was a good forum to kind of bring these questions to. So stepping back, let's just again repeating how this whole trade happens, right? Given that we have a UTXO script-based transaction system, and we have 2 UTXO chains, right, which basically opens us to the possibility of leaning onto yet another development in Bitcoin, which has been very well understood by now. And there's a lot of solutions out there, which is atomic swaps and maybe even submarine swaps, right? So to kind of highlight this fact, there's actually very robust products out there in production, as we saw earlier Michael talk about, which let you swap Lightning to Bitcoin or Liquid to Bitcoin, and hopefully the hash rates to Bitcoin in the future. So we can lean into the existing mature ecosystem of atomic swaps to kind of help us do this. So we're not reinventing any new wheels, right? Also, we could go, the swaps could be either on-chain, which is basically the atomic swaps are happening between the 2 chains on-chain, or we could use Lightning, or even maybe Arc can help us here. But all these things are well understood, and we can do this stuff, right? So this sounds very promising. Suddenly, we have a hash rate market which is transparent, decentralized, and open, right? There's no one party kind of controlling the market. So I wanted to talk about, just to give you an example, what would the dynamics of trading this hash rate looks like, right? So I have a little diagram here, right? The top layer is the P2 bull blocks. You can see they're small because they are frequent and they are much smaller work done on them. Then we have the Bitcoin blocks, right, at the bottom. And the lines are what I'll talk about is happening here is that suppose in the first, I think the leftmost for you guys, no, rightmost red blocks is basically, suppose you're building the Coinbase for Bitcoin block B0, right? At this point, you don't want to consider the shares that are in this first window here because these could be reorged out, right? So you wait for 100 blocks Bitcoin or 1 day or whatever it is to say, OK, let these shared chain blocks be mature so that they don't get reorged. So let's avoid this mess. So there is a maturity window before you can start to sell these shares, okay? So you have to wait for a day, more or less, before you can sell your share that you just mined. Then on the other hand, afterwards, there is a PPLNS window, right? Let's say it's 2 weeks. In this diagram, I've kind of chosen to show the window as 2 weeks, where the blocks are green, you can actually start to sell them. So for these 2 weeks, you take your UTXO outputs and sell them to a market maker or to one of the bigger miners, right? So you have this window where whenever you are building the Coinbase for Bitcoin block B0, these are the shares on the P2 pool chain that you're looking at to do your PPLNS accounting, right? Because before that, they could have been reorged out. And after that, you can't sell them because they're no longer used for determining the B0's Coinbase. So if you don't sell your shares in this window, you are keeping the risk that if you don't find a block, you will never get a reward for that share, right? If that share goes to the other end of the red blocks, and you didn't get a Bitcoin block in that time period, you're not going to get a reward, right? So this is what we call the share has expired. It is no longer tradable. So essentially, in trading world, in the options world, this is basically the maturity of that instrument, and then you have an expiry. So we have a window here, and now we have a loose definition of how we can start to price these shares over that green window. So we essentially have a time-bounded permissionless market for hash rate-backed claims, right? Which is basically, this is my share. It shows that I mined a certain share on the P2 pool chain when the share chain difficulty was this much, the Bitcoin difficulty was this much, and now I want to sell this. And I mined it today, or I mined it 25 days ago. That's another set of data you have. So you can basically say, OK, this share has 30 days before it expires, or this share has 5 days before it expires. So you can kind of price it. You can say, OK, if it has only 1 day to expire, I'm just going to pay nothing for it, because the probability that now it results in a Bitcoin block is very low. So given all this data, we feel that we can design a market that can actually be used to trade hash rate. So just to contrast it with existing hash rate markets, at the moment, the most popular are Wrigley and HashPower, and they are a very different take on this problem, right? Essentially, you are just buying hash rate for Bitcoin. You give them Bitcoin, you get access to hash rate from miners, and you can point it to a certain pool. I mean, these services are great. They do a great job. In fact, we use them a lot to test our pool software as well. So we can take, say, from HashPower, a few petahash for like 10 minutes. It costs nothing. It costs like less than €1. And you can point it to your pool and see how it performs. So these are very different from what we are trying to do. This is basically taking hash rate from somebody and pointing it to a pool. Whereas what we are trying to do is miners have hash rate, and they sell it at a discount so that they get the payment immediately now. In fact, you could say we kind of decentralize FPPS, right? Any party could come along with some liquidity, buy the shares, take the risk if they have deep enough pockets, and say, OK, I'm going to get the virgin coins whenever P2 pool hits a block, or I take the risk, right? And the beauty is that most of the information is transparent, it's available, it's there, right? So the question in our mind for this forum is largely, how do we price these shares, right? So I kind of touched on what data is available. First of all, is like if you know the share difficulty and the pool difficulty and the current Bitcoin difficulty, you get a face value of the share. Like this is what it should be worth, right, given hash price. Then we know pool's hash rate. Then we know share's age, whether it was mined today or whether it was mined 10 days ago, etc. And then, of course, coming back to, we know that Bitcoin difficulty might go up and down based on certain news or the other things. So you have all this information to try to price the Bitcoin market. So this is a call for help, largely. How do we work out the share pricing? And more importantly, how do we build in the decay? Now, this is, as far as I understand, is well understood in the options world, where basically the rate of change of price has an impact, the maturity of the option or the expiry date of the option has an impact. So all these are well understood, but I am not a fintech guy, so I'm hoping that some people can come forward and try to help us here. So can we design a market where TradFi would find it fascinating enough to come and use? That's it. It was pretty quick. Mm-hmm.
So if you have the maturity window, I'm not the options trader, sadly, because that would be interesting. But if I'm a small miner and I can see the window is closing, then I can also see the price. The price is also in the chain. So if I'm like a small miner, how do I see, like before I even have the share, does it make sense to wait for the small window or to wait for the next?
Yeah, that's an interesting question.
Do I then have small miners jumping in and out?
That's an interesting question.
So they
No.
jump back in?
So the windows are not fixed. That's an interesting question. If the window was fixed, the window is per share, okay? So if you mine a share today, yeah, it's a sliding window. Yeah. So your share mined today has 30 days before it is no longer tradable. Yeah, okay.
Any other question?
Thanks for the talk. Maybe I missed the part for the, but yes. So when a P2Pool miner would mine a block, I didn't get. Maybe you said how does the payout work? Like, I have so many shares. How do I get actual Bitcoin? Is that trustless in any way?
How do I get extra Bitcoin, or how do I get the Bitcoin?
Yeah, so P2Pool miner mines the block.
Mm-hmm.
That's the Coinbase and actual Bitcoin.
No, it's not actual Bitcoin. It's the share chain UTXO, right?
But someone would mine a block, right, in the pool.
Yeah.
Actual Bitcoin block.
Yeah.
So who gets the?
Yeah. So that's a good question, right? It's kind of going back to the very basics of the original P2Pool as well, and I'm really happy to clarify that. Basically, when a miner starts mining, they build a local Bitcoin block. They talk to their local Bitcoin node. They get the block template, right? Then, based on their local P2Pool nodes database status, right, as to how many shares exist, they kind of determine the distribution, right? Okay, Alex should get 10%, Bob should get 20%, Carol should get another 50%, whatever. Then based on that, they basically build the Coinbase in proportion, paying the miners the rewards, right? So that's what goes into the Bitcoin block Coinbase, right? So there's two things now. Once we hit a lucky block, which is good enough to be a Bitcoin block, that Coinbase already is there. So immediately Alice, Bob, and Carol will get their Bitcoin. The other thing is when I build a share and I broadcast the share on the P2Pool network, the other miners see this, right? And before accepting this to go into the chain, they look at their local database, local nodes database, and see if the proportion is correct, right? So I think that Alice should have had 15%, and you said your block is only paying 10% to it. I will reject that block. Does that make sense? I would reject that share, sorry.
But me as a winning miner, is there any way for me to achieve there? Like
No, basically because you put the commitment of the Coinbase of your, no, because you've already built the Bitcoin block, right? And you started mining to that Bitcoin block, so all your shares are going there. If it's a lucky share, it'll have to match that Coinbase. It is that Coinbase, right? Otherwise, it won't validate, right? Does that make sense? Yeah. Okay, well, we can talk more in detail. I'm happy to tell you all about this. Oh.
So you mentioned you're using PPLNS. Have you done any simulations or analysis on, like, there's variants in PPLNS, like Ocean has this weird thing where they
Mm-hmm.
and then I'm going to refuse to buy anybody else, right? So I'm
Yeah.
going to try to screw the last 4% of hash rate on the pool.
Mm-mm.
I'm going to buy 95%, and then the last, or 96%, and then the last 4% is just never going to see a payout. And so
Yeah.
it's only 4% maybe, but I was wondering if there's any like alternative payout scheme that might,
Resist that.
by adding randomness to payouts,
Ah.
instead of being like very fixed the top 95% of hash power, you add a little bit of noise, and then you could totally like break that attack.
Well, that's a fascinating idea. I mean, thank you for pointing that out as well. The first question about the PPLNS and tides, as I think what Ocean calls it, right? It's basically they have a dynamic N in the PPLNS, right? They don't look at the last 2-week window. They don't look at last 1-month window. What they do is they collect up to, they keep looking at share history till the total work adds up to 8 Bitcoin blocks worth of work. So on today's date, how much work would you need to mine 8 Bitcoin blocks? They keep aggregating the shares historically till you reach that much amount of work. And there you find what is the distribution amongst different miners, right? So this becomes dynamic, as in if suddenly the Bitcoin network has low difficulty, they have to go further back in history, which they haven't been stress tested yet, I think, because if it happens, it'll be interesting to see how much data they can pull from the database that quickly. But hopefully that doesn't happen anyway. So the reason I'm kind of leaning towards PPLNS is largely because of Manny's paper, the seminal paper that came out ages ago, that say like pool hopping is going to happen, and PPLNS is our best thing that we can do, right? Mathematically, kind of proved it out. So that's why I'm kind of leaning on, okay, let's just play safe. But if some new ideas develop, we can obviously replace it and do a fork of the chain. The second question is very interesting, because this has been our concern, that what happens if, say, some bad actor with a lot of hash rate comes along and wants to destroy P2Pool, right? They might just mine a lot of blocks, right, and refuse to buy anybody else's share of the long tail. And I think you yourself proposed a solution, which is like we should have 1 or 2 slots out of those 20 or 50 where a random peer is selected. So we make sure that we actually pay that. But it is worth modeling it out to see that what is the probability if an attack happens like this, how many slots should we randomly allocate to keep fairness high enough. But that's an interesting thing to model. We haven't done that yet. Short answer, no, we haven't. Thank you. Thanks a lot.
Hi guys, welcome to the first morning talk. Hope you have a great time yesterday. So today we're going to do a review of Bitcoin, native Bitcoin hash rate derivatives, and what's the design space here, what people have been working on so far, what are like the design challenge, what is the project space, and how you can make practical that kind of stuff. So why Bitcoin hash rate derivatives matters? It's a huge question, and in my view, like it's very interesting stuff, because if it's possible, if they are like practically possible, they might be one of the most fundamental tech for Bitcoin, because they do offer other solutions to solve the high variance of solo mining. As such, it can be a sort of income coverage for doing solo mining. Who am I? Very quickly, I'm Antoine Weird. I've been working on Bitcoin protocol since 2018, based here on Lightning, and I work on the main pool, transaction relay, a bunch of Lightning stuff, payment pool, and chain factory. Thanks to not take photo of me or get captions. I will appreciate, so thanks by advance. And also, like, if you're aware about the Chatham House rule, I like to follow it, because that way people have like more freedom of tongue. So let's do it in Socratic mode. If you do have any questions during the talk, just raise a hand and ask the questions. Don't wait for the hands. And if you would like to have explanations, like being weird, like saying just raise a hand and ask, or like I would try to explain the concepts. So first, we are going to go through like what's a contract protocol, what is the class of protocol in Bitcoin that we do call generally contract protocol among experts. Second, we're going to like dig into like the problem space and the real change of hash rate derivatives. And third, we're going to go through the status of research on practical hash rate derivatives. So contract protocol in Bitcoin definitions. So a contract protocol is a coin C shared by at least two participants. So let's say Alice and Bob. And the idea is you are going to encode the step of the contract with like pre-signed transactions, which might be a graph, it might be a tree. It's more generally something that you can represent as a graph, but idea is like you should be able like to play the whole contract as a chain of pre-signed transactions between the two parties. The contract can be agreed on interactively off-chain, so once it's signed, let's say it's a payment channel, on it's signed, like you broadcast it, you confirm on-chain, and Alice and Bob are just going to update the contract state between them, and there is no systematic need to go on-chain for that. So in case of disagreement, after time point t, the blockchain as the judge model settles. So for that kind of protocol, that's the main idea to remind you. Or like to remember is the blockchain is the judge of the contract. Examples, one that I guess people all know about is like Lightning payment channel. And in these payment channels, you might have like conditional transfer, what we call HTLC, hash time locked contract. And on the presentation of the PE provided secret, the payment is transferred from Alice to Bob. Other class of contract protocol is a discrete block contract, a pre-signed transaction, including a conditional transfer. And here, the transfer is conditional on an oracle releasing the secret. And this oracle is a third party from the viewpoint of Alice and Bob. Both examples are secure. The blockchain judge security model. So, very quickly, what's a security model? And key barriers when you're trying to design your protocol, like be able to think about like what are going to be the security bounds and the security risk and what you're trying to achieve. But a simple definition can be a model computation capturing the properties of protocol primitives and allowing to prove their security or at least measure against the common referentials. So primitives relies on assumptions. Lighter they are, better it is. And when I say lighter, it's like more you are aware about them, better it is. And for example, if you take Lightning, you should be able to confirm transactions before the safety time lock expires. So for the punishment pass, for example, like the default is like 2016, but that means you should be able to confirm transactions in less than 2016 block. And the value of the security proof is a heuristic choice of the protocol designer. For example, like if you take the discrete lock problem, is like, what's your like own opinion about like the soundness or the hardness of like computing discrete logs, and that can be like applied to when you're designing Bitcoin protocols. So the blockchain judge as a security model. It's based on some assumptions, and those assumptions are common among all like different contract protocols, be it TLC, be it payment channels, be it swaps, things like atomic swaps. And you should be able to include transaction at any time, and you should see the honest blockchain at any time. And this model can be used as a paradigm to design novel class of protocols, and that's what we're going to like dig more. As long as the contract express can be reduced under this security model, it should be possible to encode it as a set of pre-signed transactions. And if necessary, with those additional assumptions, if the contract expression requires it, so if you have to think about, like, for example, DLC, what are the instances of oracles, or the oracles can commute among themselves, at which moment they can, like, reveal the scalar for the points looking at the DLC. Query is what the blockchain can measure is explicitly bound to design the contract protocol. So, the rough art of designing contract protocols. So, how do you translate a contract, for example, the trade options, as a set of logical steps? How do you maximize the enumeration of the condition of validity of a contract? And that's, in my experience, when you're designing novel stuff in Bitcoin, the second step, like enumerating in an exhaustive fashion all the condition of validity of a contract is a really hard steps. Because most of the time you're going to forget, like, for a long time, for example, for Lightning, we didn't have like dynamic fee bumping being done well, and it was like kind of easy to wait when pre-sign fees were not matching the mempool fees ones to start to like try to steal funds from a counterparty or stuff like that. But really, like, more exhaustive you are this step, stronger is going your design and more robust it's going to be. So, who knows that guy? Here, any idea? Okay. So it's John von Neumann, the father of game theory, and he is coming from Austria, so that's kind of reasoning with where we are today. So game theory, it's a formal tool to reason on the equilibrium of strategic games. One of the main papers, like das zur Theorie der Gesellschaftsspiele from John von Neumann in 1928. Basically, it's like you do have an n number of players doing some game of strategy, and the example like taken by John von Neumann in his paper is like card games, but it can be applied to like a lot of like real life situations. And the idea is like when you go through the steps and action that can do each players, and for each participant you're trying to determine what is the best strategy and what is going to achieve them the most advantageous result. So game theory to design contract protocol. For contract protocol there should be a saddle points. So concretely a game design where no company can make a game at the cost of the other. And the goal of designing a contract protocol is translating the game as transaction steps. So in my viewpoint and experience, game theory is a really useful tool to like capture all the elements of the games and the pattern of information of the different counterparties, so what you mean and what's your the knowledge you do have access to. And for example, for actual derivatives, like whether if you are worried about like more energy, getting into the mining process, or people like acquiring new ships, like what can you do with this additional information, and does it change like any outcome for the contract protocol executions, and how you should like correct this potentially as a designer. So, quick conclusion of part one: a rational derivative designed to be secure must be expressive under the blockchain as a judge model. What cannot be expressed cannot be secure. And I mean, can it because in practice in the last few years in Bitcoin, people have been more and more inventive on how you can design things and how you can express things. I'm thinking about things like BVM. And step two, int number two, the execution of environments at large of the actual DBT design must be analyzed. And that's where game theory is a very powerful tool to do so. So, let's design an actual derivative, a very dumb strawman. You do have Alice and Bob. I would like to bet on the actual table during the n future period. The n future period, it's a number of blocks. Alice and Bob commit input in a shared TXO time located for the period n. If actual goes up, Alice wins. If actual goes down, Bob wins. What can be the actual fluctuation judge? And easy solutions would be to use specialized DLC. So DLC is like, you just, as I was explaining before, you have an oracle, like releasing scalar, and those scalar are like a representation of real world events. For example, like is the weather sunny today, or is the weather rainy today, and stuff like that. It can be used to implement a derivative. Problem is, it starts to be like a different security model than the pure blockchain as a judge model. And the mining market in itself is like start to be really huge in terms of economic impact. and it might not be balanced for Oracle in the sense of at some point people might just like bribe or pay the oracles just to get a specific outcome. And for something as fundamental as Azure derivative, ideally you would like something more robust. So the idea of post-swap, it's an old idea which was proposed by Jeremy Rollin in 2020 or 21, something like that, maybe late 2019. So post-swap is an indirect measures of block rate. Alice and Bob use the two modes of lock time, block height encoded lock time, epoch encoded lock time. So basic idea, Alice has a height encoded transaction, Bob has a time encoded transaction. The first one to become valid wins the bet. For example, Alice has a time locked side where it say if the chain reach 100, Alice wins, and Bob is the other side, which is encoded based on the block time epoch, and it's going to be, for example, encoded to Monday. So if the chain has not reached 100 blocks by Monday, that means Bob wins. And the diff between like the expected time under like current level of hash rates and the real one after the period you measure is somehow an indirect measure of the block rate fluctuations. And with this model, what is really interesting is the blockchain itself becomes a oracle. So post-swap transaction phase, we quickly do have Alice and Bob agrees on height and time for bets and commit funds in the pots. They exchange signatures for each transaction and time transaction. The pot transaction is confirmed to start the contract. And then when you reach either the height finality or the time finality, when the transaction can be confirmed. Main problem, there is like one fundamental problem with this approach is the metastability or contention problem. Is what if both height locked transactions and the time locked transaction become valid simultaneously? Well, you do enter into a kind of fee rate race where both Bob and Alice do have incentives to like compete in fees and try to get their side first into the blockchain. And the problem is made worse if one of the parties is a miner and can like just like mine block faster, add more energy, and if the cost of doing so is inferior to the gain they will like get from like confirming their side of the bet first. So in fact, and that was like a bunch of research of mine over the last year, contention in itself is a sub-problem of miners tampering. Contention, we did publish on post-swap, we did publish a paper back into mid-2023, something like that, which was a formalization of the protocol. And after that, we have been with other researchers, we have been researching more the issues with contentions. So contention is a sub-problem of miners tampering. Contentions or metastability can arise under spontaneous conditions. It can be also hints of conditions where miners tamper the timestamp. And you can think and find like multiple scenarios of miner timestamping, like assuming there is 5% of the miners with 5% of the hash rates, like trying to manipulate the timestamp to get like a more favorable conditions for each side of the bet, or like bigger operations, and yeah, and you can also analyze like dynamic conditions where Alice or Bob doesn't know who the miners are going to favor first, and miners might change their strategy like during the attacks, just like to back the other sides because it's more advantageous to them. So one of things to like be aware of or like understand when you're designing Azure derivatives, in some way you're layering games because you do have to combine at least two kind of games to get a sound Azure derivative design. The first game is Alice and Bob playing Azure derivative as a contract protocol. And second game is Alice, Bob, and the miners playing a contract protocol on top of the blockchain, or like Alice, Bob, and the miners being part of the mining process in itself, to be more precise. So a move on some game might translate as a win on the first game, and it took us like a bit of time, like to like understand like this is better and like build intuition about it. But yeah, one of the open design questions is like, you know, when you're designing contract protocol, ideally you would like to avoid to have any kind of side effect firing back on like the base layer. And for example, like in a way that was correct like minor syntax. And for the people who are like really like game theory, in the Bitcoin web paper itself, you do have like a game theory analysis of the mining process, and it just like formalizing the mining process as a well-known complex problem. So, Asher derivative, they are like contract protocol, and like all Bitcoin 2, they do have security shenanigans and a lot of problems. And when you are designing that kind of stuff, you want to be sure you're not introducing like well-known security risk. I'm not going to dig into each of them, but yeah, especially transaction pinning or like time dilation attacks can be like really key concern for Asher derivatives too. Being realistic, the art of contract protocol is design is like 90s like. In the 90s, people were designing broken cryptographic protocol, like for example SSL, and crypto analysis was an art in progress. Basic security notions were missing, and somehow it's a bit of a situation for Bitcoin second layers. We're making progress, but it's still like very amateurish, I would say. So conclusion part 2. Designing Asher derivative, it's complicated. A design has to get right all the miners tampering actions. A design has to get right all the second layer class vector of attacks. They might not necessarily like apply. For example, there is no, when you're designing Asher derivative, there is no concern with chain jamming. But most of the time, like the kind of security vectors of like affecting DLC or like payment channels can be concern tools for like Asher derivatives. So the status of Asher derivative research right now, we do have been through like 4 or 5 different design over the last year and a half. Like sometimes you try ideas and you see it doesn't work, you tweak it, and try to make it better. And part of the design process has been like, you know, like ensuring you do have an equilibrium, ensuring miner cannot timestamp the contract, ensuring that any sandbox don't have, none of the counterparty has like some kind of a red queen advantage on the other one. Reasonably secure means the percentage of the miner being economically rational. Miners being non-economically rational is a class of adversary hard to design against. So for our current research of Asher derivative, we assume that miners are economically rational. And as long as they are, in practice, you do have again security solutions where you do have a certain point where miner will have like a fee rewards or reward interest to take either one pass of action or another pass of actions. While we design Asher derivative, at some point we realized that information asymmetries between the counterparties is okay, and that's something that in fact the design should allow, like, because otherwise we're removing like the economic interest of the contract in itself, in a sense of Alice or Bob, by using this kind of tool, they're trying to get coverage for risk, for example, energy fluctuation or stuff like that, and they get coverage because the other counterparty is going like to provide them coverage, and that's some things to like let the contract protocol design to be flexible enough and not remove like any source of information asymmetries. And it's kind of like a heuristic choice of the protocol designers with regard to the good, bad, can move. Alice should be able like to use our private knowledge of more miners coming online to maneuver Bob. And in practice, there is no like red queen hypothesis as long as you assume that mining process is decentralized enough. There is no there is no entity in the world with a view about a God's view about what every miner is doing. So that keep making actually interesting in itself. Conclusion of part 3. Yeah, we are like we keep compounding our design. We think we do have some solutions to circumvent the metastability contention issue. And it's a novel solution based on different assumptions under peer review. I hope we are going, it's not dependent on me only, it's dependent also on other researchers, but I hope we have a paper out in the coming months, after the summer, I would say. And yeah, I'm not going to present it because ideas have not been peer reviewed, but the design is like simple and realistic enough to like have an easy implementation of it. And thanks to the co-researcher who have been working with me on it, especially like Noinko and Nadav Cohen, and thanks for Jeremy for like numerous ideas about it, and thanks to the Open Energy project, which has been like spearheading like this research effort. We do have a Telegram group. It's not very active, but we do have one for people who are interested to get involved. And otherwise, thanks to BC Professor's presentation.
Any questions? Just shout them out.
Yeah. Can I go?
Yeah.
So if I understand, you're trying to think of the protocol that could also work on layer 2. Is that understanding right?
That's a good question. I do have a lot of experience with Lightning. Some will say too much, and I'm just trying to keep things simple.
Yeah.
And as soon as you layer things on top of another protocols, like you do have complexity, like summing up. Our practical goal is rather to have like a simple design that we can run on the base layer. Have this running for, I don't know, like 2 or 3 years, being sure it sounds, being sure there's no class of attacks, we have not talked about it, being sure that it's usable enough. And the day we have like this degree of confidence, yes, uplifting it on Lightning channels or Lightning channels. But you know, that's the same idea for DLC. For a while, people have been talking about like uplifting DLC on top of Lightning. I know a few teams who have done it. In practice, it's hard. It's hard, and you just like summing up complexity when you are still at the stage of like validating the fundamentals of things.
Just a quick follow-up, sorry. If you want to watch out for when the paper comes out, which is the best place to follow you?
The Telegram group?
Telegram group.
Yes. It's not super active, otherwise there is a paper. I mean, right now, like, I've been working with Nadav Cohen in the last year on it. He has been less available, so we've been looking for other researchers. We've found them in the last weeks. Yeah, and we're looking just getting the things peer reviewed.
What are the sources of information asymmetry in this case?
You mean like how you would make a bet? Or like...
No, you mentioned that you have to design a game for like to mitigate information asymmetry.
Yes. Yes. So if I understand your question, is like where are like the source of information that you would like people not to use or people to use?
Right.
That fact, like we came to the conclusion that we should let people free of using any informations, in the sense of if you're mining pool and you know that you have new hardware device like coming up online, and that's an information that the market doesn't have, you should be able to use it, because if you design for a decentralized setup like Bitcoin, there is no way you can mitigate against that. And so it's a bit of an heuristic choice, in the sense of there will be like good information asymmetries and bad information asymmetries, but it's very artificial making distinction. That's answering your questions, or?
Yeah.
Yeah. And but we do expect people like to look on like historical blockchains, miner statistics, information markets. When you heard about like a new hydro and power grid getting online, are you going to use it? Information, yes or no? Observing shares or funds can be interesting. Like it can be like a hints. It can be a hint of like new mining hardware showing up online. Yeah.
So hash rate, just to clarify, any hash rate, because we were talking about different types of algorithms, right?
Any hash rates? What? Can you clarify your questions?
SHA-256, script and so on. Like, does your research?
It's only on Bitcoin. We're focused on Bitcoin, but there is. I don't know enough of the other blockchain scripting engine in VM, but there is no. If it works on Bitcoin, I don't see. If you're going to use, like, I would say, a cryptocurrency which are using mining process and code base very similar to Bitcoin. So, for example, Zcash or Dogecoin, I don't see reasons why it wouldn't work. But yeah, it's not the hashing primitive in itself doesn't have an impact on the design, or at least so far we have not been able to establish.
Let's say, Monero.
Yeah.
So I was wondering if your research could be applied to other algorithms. So that was just my.
Yeah. Actually, that's a good question because we have been really focused on Bitcoin. And as we said, we try different design. At first, we think about things with DLC. Then we think about, because in the block headers, you do have like the difficulty being asked. And not all proof of work are necessarily have the same level of difficulty, in the sense of you can have difficulty of 50 being asked for the next difficulty period, and you might have block at 80, block at 70, block at 75, block at 60, and based on that, it's informations, that's there, the protocol. I don't know anyone should being able to use it in practice, but maybe people can come up with design using BVM, stuff like that. There is other tricks, we could use in protocol, but we're trying to make something simple. Yeah. But yeah, those are good questions. Yeah,
I think that's all the time we have.
Okay, thanks.
Hi everyone, good morning. It's an honor to be here. My name is Alexander. I'm a software engineer from Brazil. And today I want to talk with you about the future of Bitcoin. So, let's be honest. Most people in the world still do not understand Bitcoin. And maybe they never will. Most people do not understand monetary policy, inflation expansion, central banking, sound money, hard assets, the history of gold, and even among educated populations, very few truly understand how fiat systems work. But they understand something else. They understand incentives. Human beings respond to incentives fast that they respond to philosophy. This is one of the central ideas of the game theory. If incentives are aligned correctly, behavior changes naturally. And we don't need to convince every human being to become an economist. You only need to build systems where our rational participation becomes beneficial. The modern internet already proved this. People understand internet before understand the infrastructure of the internet. People know how to use internet, but they don't need to understand TCP/IP, for example. And the modern internet already proved this, like people upload content for likes, people spend hours engaged on platforms, people produce value for corporations every day, and what they receive? Mostly dopamine. The platform captures most of the economic value. The users create the attention, the users create the engagement, the users create the network, the users create the data, but the monetary upside goes to shareholders. So the question becomes, what happens when users themselves begin accumulating sound money through participation? To understand why this matters, we need to talk about fiat systems. Most governments today operate on debt-based monetary expansion, and currencies are continuously diluted. Purchasing power declines, saving becomes weaker over time, and society is lowering normalizing permanent inflation. We often hear about the government, oh, inflation is 3%. No, it's not, it's a lie. But ordinary people experience something very different. House inflation, food inflation, education inflation, healthcare inflation, assets inflation. And this creates something psychologically devastating. People stop believing in the future. Because when money loses value continuously, long-term thinking becomes irrational. Why save? Why delay gratification? Why build patiently? The system rewards consumption, debt, leverage, immediate pleasure, and over decades, this changes culture yourself. A future civilization becomes short-term by design. This is not merely an economic issue. It becomes a social issue, a moral issue, a civilizational issue. When money is broken, incentives become broken. Bitcoin changes this equation. For the first time in its modern history, humanity has access to a globally accessible monetary network with fixed supply. No central authority can arbitrarily inflate it, no politician can print more of it, no corporation controls issuance. Bitcoin restores scarcity, and scarcity changes behavior. When people hold an asset that gains purchasing power over time, incentives begin shifting. Saving becomes rational again. Patience becomes rational again. Long-term thinking becomes natural again. Long-time preference becomes rational again. This is why Bitcoin is bigger than technology. Bitcoin is incentive engineering. It restructured human behavior through an economic reality. And historically, civilizations built on harder forms of money tended to produce more savings, strong capital, long-term planning, greater economic stability. Now, I'm not saying Bitcoin magically fixes humanity. It's not that. Human beings will always remain imperfect, sinners, but monetary systems shape behavior more than most people realize. And today, we live in a world where millions of people work hard every year just to maintain the same standard of living. It's the famous red green. That created hopelessness. Bitcoin introduced the possibility that ordinary people can once again participate in a monetary systems that reward productivity of living. But now we encounter the real challenge. If Bitcoin is so powerful, why hasn't the entire world already adopted? Because adoption friction is enormous. Self-custody is difficult. Private keys are intimidating. Volatility is scary. Economics are confusing, and onboarding is complex. And most importantly, most people do not buy assets before they emotionally understand their value. This is why early adopters are usually technologists, investors, ideologists, economists, risk-tolerant individuals. But mass adoption does not happen through early adopters alone. Mass adoption happens when participations become natural. The internet did not conquer the world because people understand TCP/IP. It conquered the world because it's become useful. Bitcoin must eventually reach the same phrase. And I believe in the next major opportunity is this, integrating Bitcoin into systems where users earn it naturally through a digital participation. For ads, for example. Today, attention is one of the most valuable resources of the earth. Social media companies are among the largest corporations in the history because human attention have become monetized. Billions of people already spend enormous portions of their time online. The economy already exists, the incentives already exist, the advertising infrastructure already exists. The only thing missing is the fair value of distribution. Currently, users are not treated as economic participants. They are treated like products. But if users accumulate sats instead, and these transactions is already starting to happen in the real world. In Brazil, companies like BIPA are given for the users credit cards, and when you spend your fiat shitcoin money, you receive cashback in Bitcoin. This is genial. So, people spend weak money and accumulate strong money. The incentives to fiat is spending this shit of coin, but receiving Bitcoin in return is a great solution. Oops. So, and this is important, the friction is almost invisible. Users are not forced to become experts first. The experience itself gradually creates curiosity, alignment, and education. That may be one of the most powerful adoption vectors you have. Not through speculation, not through trending, not through financial engineering, but simply through participation. Imagine an entire generation received their first Bitcoin not for an exchange, but from daily internet activity. Imagine you only watching ads and creating content, participating in communities, contributing to attention, that changes onboarding completely. Because psychologically, earned Bitcoin feels different from purchased Bitcoin. People protect what they earn. And once someone owns even a small amount of Bitcoin, curiosity begins. Then education begins. Then ownerships create alignments. This is one of the most important principles in the game theory. Behavior changes when incentives and ownerships align. I also believe we have living through a very specific historical window. Right now, trust in institutions is very frightening. Young people increasingly feel trapped by inflation, disconnected from traditional finance, unable to build wealth. At the same time, smartphones are everywhere. Digital payments are normalizing. Global internet access continues expanding. And Bitcoin infrastructure is maturing. Lightning network is growing. This is convergence matters because major monetary transactions historically happen when the existing systems loses legitimacy and a super alternative becomes accessible. That is the moment we may be entering, but the window not remain open forever. If Bitcoin remains inaccessible to ordinary people, then centralized systems will absorb the opportunity instead. CBDCs, program of money, all this satanic stuff, the next decade may determine whether digital money increases human freedom or reduces it. And adoption will determine the outcome. There is also a deeper physiological dimension here. Through history, stable money helps preserve the relationship between work and value. And someone spends years building skills, saving capital, and planning for the future. They expect the stored labor will retain meaning. Inflation weakens that relationship, and Bitcoin attempts to restore it. And this is especially important in emerging economies. In countries across Latin America, Africa, parts of Asia, people already understand monetary stability intuitively. In Brazil, for example, our currency is shit. We lose 20% of value each year. They may not use economic terminology, but they understand currency collapse. They understand devaluation. They understand distortions. For many people, Bitcoin is not merely an investment. It's an economic self-defense. and perhaps something even bigger, hope. Hope that productivity can matter again. Hope that long-term effort can matter again. Hope that ordinary individuals can participate in a monetary system that is not continuously manipulated. This is why builders matters, because adoption is not only a protocol problem, it's a humanitarian experience problem. We need better onboarding, better UX, better lighting performance, simple wallets, and incentives, and normal people using normal apps to receive Bitcoin. Is importantly, we need to stop building only for ourselves. Sometimes the Bitcoin ecosystem is only for us, tech people. We assume everyone wants to read monetary theory before participating, but most people adopt systems economically first, rationally after. Again, people use the internet before understanding the internet. Bitcoin may involve this similarity. The builders who help ordinary people interact with Bitcoin naturally, without fear, without friction or ideology barriers, may become some of the most important contributors to global adoption. So, I want to leave you guys with this final idea. The future of Bitcoin may depend less of convincing experts and more to empowering ordinary people. If Bitcoin truly is a superior money, then eventually it must become usable for humanity at scale, not only by developers, investors, conference attenders, hedge funds, and corporations, but normal people. And perhaps the next phase of adoption will emerge from something simple: align incentives so participation itself will become onboarding. And we already began to see early version of this. Bitcoin rewards integrate into consumer payments. Bitcoin native financial instruments, application where interactive Bitcoin without needing to become expert of day one. But because of in a world built on inflation and discretion, people naturally migrate toward systems that reward value, ownership, and human dignity. Thank you.
Questions?
So you mentioned a couple of times Bitcoin rewards for like ads, for example. How do you think it remains a viable business model? Because I think now there's like things like Slice and Repa you mentioned indeed. How will this keep? What's the business model there for these companies, and does it remain viable?
Yeah, like BIPA, you can have a credit card, and you put fiat in this credit card, and when you spend, you receive cash back like 1% in Bitcoin. For me, this is genial. But I was thinking about, let's imagine a social media when you can do a post and watch an ad for doing this post. And the company receive fiat money like dollars for this ad, but they can distribute part of this income for the users in sites. It is possible today. It's a modern business. This is possible. I'm working on things like that, but it's not done yet. But it's an alternative.
Would this be integrated? Is this something you would do on Master, or like what's your always kind of social media?
Yeah, I was not thinking about self-custody for this. It's like most people thinking about that. A normal guy who don't understand not enough Master, do not understand about technology, but what they understand is my fiat money, my pesos, my reais, my dollars loses value along the time. And now I'm receiving a real money, and along the time this money is getting value, not losing it. And when this normal guy realizes it, and others people too, we can scale, we will scale Bitcoin, And I guess this is the better chance of the good future you have. Thank you.
I have a question. So you talked about Brazilian currency devalued like every single year, like every single second, right? Do people actually like do portfolio management, like, you know, when you get paid, you know, you buy like, you know, half of it as a USDT, USDC, or I don't know, you know, Texas gold or something like that. Do you do that? I'm sure you do that.
In Brazil, we have a lot of inflation, and the government lies about it. They say it's like the inflation in Brazil is 5%. Is not. It's 20% by year. And we have cities in Brazil, like Rolante is a small city in Brazil. What 90% of the business accept Bitcoin. You can go to Rolante and after the boom of Bitcoin with Trump, people stop to spend Bitcoin. They only want to receive, not spend it. But the business accepted. It's a reality today. The reason of that is because our currency is shit. It's worse. When a Brazilian receiving dollars, they are, man, I'm a king of the world. I have a strong money. The dollar is here too. Bitcoin is real money.
Okay. Thank you.
You're welcome.
Any other questions?
Thank you very much.
Thank you.
Hi. No economics talk from me. I'm just an engineer. So I'm going to talk about ARC and a new type of protocol that people can use to build wallets. I called the talk Anatomy of an ARC wallet so that you guys would know it was about ARC, but actually it's anatomy of Bitcoin wallets and a new generation of Bitcoin wallets that hopefully will have better user experience. So what I'm building is Bark. It's an implementation of the ARC protocol, but it's actually a Bitcoin wallet SDK. So it has all the features that you would expect from an SDK to build an entire Bitcoin wallet. It has all the existing payment protocols supported. So it has first-class Lightning support. You can send on-chain, and you can make, of course, ARC payments as well. It's fully self-custodial, which means that it has an emergency exit hatch built in so that anytime your ARC server, which you are coordinating with when you use the ARC protocol, is not responding or is misbehaving, you can always, and the SDK will always exit all your VTXOs or all your ARC balance back on chain. It's fully batteries included. It means that it also does all kinds of peripheral stuff. You can edit Lightning invoices, you can create BIP 321 URIs. So we try to do as much as possible for you, so you don't have to worry about all of that stuff, and you can just build wallets and things that need payments. We have various language bindings. Our SDK is fully built in Rust, but we have bindings for these 6 languages. Some of them are a bit rougher around the edges than others, but we definitely value feedback. We have people working on them full time. We're still working on browser WASM support, but it's getting along quite well. So it's already ready for testing if you can live with many rough edges, but that's coming soon. We also have a daemon program. So if you're running on a server and you want some like more hands-off experience, we have a standalone daemon. It exposes an HTTP or REST API, so you can just use whatever client you have to make calls to that. It's an open API spec, so you can create your client in your language. I think we ourselves have a Rust one and a TypeScript one, but you can just generate your own clients. If you run it, you will get an API Explorer also, hosted on one of the pages, and we're working on a web wallet that we want to ship with Bardi so that if you run the daemon, you just also can go to the browser and use an actual front-end wallet. But obviously, it's mainly targeted to people who want to use the API to build whatever they want to do on their server. So now I'm gonna take a look at some of the wallets that people have been building over the last maybe a year almost for some of them using our SDK. And then gonna, in a few occasions, look at how some of that behavior actually looks in our codes when you're using the SDK. The wallets that I'm going to look at, well, I will showcase them in the end. So one of the features that we have is that you just have one off-chain balance that you can use to send both Lightning, Arc, and on-chain. So you can choose to just have one unified balance. Most of the wallets will have this as the default behavior. But we also ship a built-in on-chain wallet. So you can choose to, for example, also represent your balance as a payments balance and a savings balance, or like off-chain balance, on-chain balance. And then we have boarding and offboarding, which are procedures to move money from the on-chain wallet to the off-chain wallet and back, right? But the main thing to remember here is that you can use the off-chain wallet to make on-chain payments. So you don't need to like move to your on-chain wallet to make an on-chain payment. You can do that directly. Currently, we don't support receiving directly to the off-chain wallet. So if you receive from on-chain, you go actually into your on-chain wallet, and then you have to board that if you want the off-chain funds. I think Noah, for example, one of the wallets has an auto board feature. So anything you receive, I don't know if RK has that, but if you receive in your on-chain wallet, it will immediately push it to the off-chain wallet because they don't want to have the on-chain wallet as part of the experience. But if you have a saving wallet, for example, it makes sense to just keep the on-chain funds already there. This is how the boarding and offboarding looks if you use the API. So you can provide your own on-chain wallet. We have one by default that you have, so you can just put our on-chain wallet in there. You can also do boarding using PSBT if you have, for example, a hardware wallet or like your own already existing on-chain wallet, and you would just want to use the Bark SDK for off-chain. You can use PSBT, for example, for that. And then offboarding, you can just pick individual VTXLs that are problematic for some reason and offboard those, or you can just say, I want this amount to be offboarded on-chain to an on-chain address. If you want to just exit the ARC entirely, you can offboard everything. So then receive, we are big fans of the BIP 321 standards, which is the like Bitcoin colon URI thing that used to be BIP 21 and then got upgraded to BIP 321. This enables basically for users to specify multiple different recipient payment methods. So you can support Bitcoin on-chain, Lightning invoices, Bolt 11. You can also support Bolt 12, which we don't support yet, but we're working on, and an ARC address. So we have a very easy, I will already sneak peek that here. We have like a URI builder where you can just say, okay, I want the URI and build, and by default it will basically gather all the payment methods that it can find. Obviously Bolt 11 invoices need an amount, so if you add an amount, it will also like add a Bolt 11 invoice. If you, for example, don't want to use ARC, you can just say ARC false, and then it will just generate this BIP 21 string. I want to go back. So yeah, so how wallets expose that? Most of the wallets will just also enable everything by default. They allow you to copy, paste the invoices and addresses directly if you just want to use one of them. There's a lot of flexibility here. For example, on the left it shows that, well, yeah, I had another screenshot. It shows that like Lightning is not green if you don't put an amount, because you need to put an amount to have the Lightning support. But hopefully, yeah, hopefully the experience that we all want is that you get a QR code that works immediately without having to do any additional. So that's what we're aiming for by using BIP 321. So then on the sending side, it's equivalent. We support BIP 321. You can parse it using our API, and then you can see all the different payment options. So Bark Web is very explicit. It actually calculates the fee for all of the different options, and then it will show you the different options and the fee that you will be charged. So ARC payments inside the ARC are free. But like this was the result of parsing a BIP 321 URI that had all the different options, and it just chose the ARC address out of there. On the other side, that is like just sending to an ARC address because I don't have iOS and I didn't have the right screenshot. But the iOS wallet can also support scanning the BIP 321 URI. And then how does it look? If you use the SDK, you have a simple function that says parse payment request. It can parse anything, so it can parse an on-chain address, a Lightning offer, Bolt 12 as well, and a URI, and all the different stuff. And then you get this struct back that has all the different payment methods, available payment methods, and then you have all the different options that it will allow you to pay to. We have other APIs that allow you to like do fee estimation for all the different options, so you can like choose which one is best for you. So then, moving on from the like default Bitcoin things like balance and receive, there's a few things that are uniquely ARC. So in ARC, in the protocol, we use VTXOs, which are basically ARC equivalents for UTXOs. they're not unspent on the blockchain, but they're virtual, which we call, well, they're like off-chain, and we call them virtual. And the core protocol of ARC requires that these VTXOs have a certain expiry time, which is the main drawback of using the ARC protocol. And the expiry time means that your wallet is responsible for periodically interacting with the ARC server to refresh your VTXOs. And refreshing is basically asking for a new one when your expiry time is getting very close. So wallets have different ways to do this. Most of the wallets will obviously do this all in the background for you, like users never have to click refresh. On the left you can see a wallet who's just indicating like, hey, we're going to do a refresh in this amount of time, just so that you know. The other wallet is saying like, hey, we need to support push notifications so that we can wake up your wallet so that you can do this. So yeah, the wallet needs to be waken up at certain points in time so that it can do refreshes. And obviously on mobile, that's sometimes a little bit hard. You cannot run your wallet all the time in the background, but push notifications and maybe like something like alarm clock wake-ups are things that can be used to make sure your wallet will not forget to do this. Then on the SDK side, all of that is just done for you, as long as you wake up, obviously. So we have, for example, this config, which basically puts the threshold that you want to start refreshing your VTXOs at. By default, on mainnet, we put it at 24 hours. So 24 hours before the expiry of your VTXO, if your wallet is online, it will refresh them. You can, like implementations can change this to be a bit more conservative. And then by default, in the daemon, you will, in the SDK, you will be running some kind of background daemon that will do all this for you, so you don't have to do anything. If you don't do that, you have a function called maintenance, which you call periodically, and it will just then decide, realize that it has to do this and just do the necessary things. We have two types of refreshes. So one is interactive, and then your wallet actually has to stay online for a certain amount of time. BarkD will do, BarkD, the standalone daemon, will do these kinds of refreshes. But for wallets on phones, it's not very recommended because it's very prone to failing. And for that, we have an alternative method, which is delegated refreshes, which means that you basically trust a bunch of co-signers to delete their keys after a certain signing ceremony, and then your VTXOs will be automatically refreshed and you don't have to be online at the moment that the refresh happens. So another uniquely ARC thing, I mean unique, it works differently in ARC than in Lightning. In Lightning, you only have to do exits if your channel partner is somehow gone. In ARC, you have to do it if the server disappears entirely. So in ARC, you have a single server, and as long as the server is happy to serve you, you don't have to do anything. But you have the option to do an emergency exit. We used to call them unilateral exits, but many users didn't really understand what the word unilateral means. So like, it's only for emergency purposes, because like we saw before, if you just want your funds back on-chain, you can use offboarding, which is basically asking the server, hey, give me on-chain UTXOs back. And that's instant, so you don't have to do this like complex process. Because the emergency exit is a time-consuming process, you have various different off-chain Bitcoin transactions that you need to confirm. You need to wait for blocks before you can create a new one. You cannot do them all in one batch because of how mempool rules work. So it's definitely a, as you can see on the left, a danger zone process that we don't recommend most wallets expose to their users as like an easy button, like, oh, exit or get UTXOs. It's only like, something's not working. This is an escape hatch that you have. So then once you trigger it, you can expose it in various ways. For example, in this wallet, it actually warns you like, hey, these are the dangers that you have, and then it will show a progress bar in your notifications so that you know like progress is being made to get your money back. In our SDK, it is all exposed and implemented to do the whole process. Also, if the SDK realizes the server is for a long time not behaving correctly, it will also trigger exits when the expiry window is getting near. And once you trigger an exit, you just have like also a loop where you call progress, and it will just do the necessary stuff, and everything is implemented like that. The last thing I want to talk about is backup. Backup is one of the more complicated things we don't have fully worked out yet. So currently we have an SQLite database. We recommend you just back up your SQLite database once in a while. We're working on full BIP39 recovery, so you can just keep your phrase and recover most of all of your VTXOs. You won't recover your history because we don't have a blockchain, right? So you will get your money back, but you won't see all your previous transactions. At least not. I think we keep things for like a month or two because we have this 1 month expiry window, which is, yeah, so I forgot to mention the expiry for VTXOs that we chose to have as a default one for our server, or as the only one for our server, is 30 days. So the server can just delete all the data that it has after 30 days. It doesn't really need to know about anything that happened before. So when you do a recovery from BIP39, you will just get your VTXOs back, but you won't get your history from more than 30 days ago. We use the regular BIP39 seed phrase. We do our custom derivations for like several different keys that you use, like the in-arc VTXO key. We also have like a mailbox that you use to interact with the server. We all derive the keys from the same seed, so a single seed can get you back up and running, hopefully very soon. Up until then, just sync your SQLite. Yeah, this was it for me. You can find our docs at docs.second.tech. All the language bindings are there. The clients for the REST API are there. The two wallets that you saw the screenshots for are RK. You can find it at rk.cash, and Noah wallet at noahwallet.io. We're working ourselves at a BitCPay server plugin as well, so that you can just single-click get Lightning support in BitCPay. That's getting along very well. You can also find it in our GitLab. And we're working on a web wallet where you saw some screenshots from as well, that we can ship with BarkD. We're also planning to ship to Umbrel, ship to Start9 once we have the web wallet built. And yeah, definitely also happy to contribute to any of the things that we're doing. Yeah, through that link on the top left, you can find also our website and our GitLab. Thank you very much. I think I spoke very fast, which I usually do, so I am happy to take questions. Okay. We have a lot of not a lot. A lot. Okay. Okay, first question will be, how does the ARC protocol work? No, go ahead, go ahead.
Okay, with the recovery, so you have your words, and you need to have like the backup that is only valid 30 days, did I understand that correctly? Like
No, the backup is everything. We recommend you use the backup right now because that has everything and you're fine. But we want to support just using the 39 seeds, so you don't need to back up your file. And we're still working on that. Like right now, if you do it, because I mean you can obviously just create a new wallet with the same seed, you will get most of your VTXOs back. But like the Lightning, some of the Lightning payments that you recently made won't show up, like your receives or change. Well, yeah, it's not 100%. We have a project that we're working on to do that.
But that's still relying on the Bark server to...
Exactly, yeah.
Because you have to ask for your...
Exactly. So we have this notion of a mailbox server, which is basically the server that tells you when things are happened that are relevant for you. We currently just have our own ARC server also be a mailbox server, but it's a separate kind of communication protocol. So in theory, wallets could build their own mailbox services so that the mailbox server kind of talks with the ARC server to get stuff for their users and then sends it to their users so that at least you have an extra party. We didn't do any work for that yet other than just splitting out the APIs. It's something we might be interested in. Definitely also like if someone is building an actual wallet, you can also implement various backup solutions for your users. So I think some of the wallets have maybe iCloud backup, maybe Android, Google Drive backup, stuff like that. So definitely like backing up the SQLite database is also always going to be better because you see all your transactions that you made in the past. You might add notes or something like that. So the full backup is definitely better, but the BIP39 backup is like you don't lose your money in case the server is still there. Yeah. Yeah. And if it's like house burned down and the server is gone, well, that's the worst case scenario. Then, yeah. If that is possible or if that is hard? That is possible. Yes. So that's, well, so the way the board process works is, right, you kind of co-sign a next spending transaction from the output that you created with the server, and then you can just put that output on chain. So you could do it from a Coinbase, yeah. We also have another thing that we currently have working only built in. We didn't expose it yet, but we're definitely wanting to do that, but it will be like 10x better UX with covenants, is that you can just unilaterally create a bunch of VTXOs. Like the thing like you're saying, when you onboard or board, you need to co-sign with the server. That's only because we don't have covenant. So if there was a covenant, you could just create an ARC address, something where you just send to, and then your money is immediately in the ARC. So then for Coinbases, for something like P2Pool v2 or mining pools in general, you could just have a single output that you unilaterally created using just a function without having to talk with the server that just creates a bunch of VTXOs. You can send them to your users and they can just go to the server and say, hey, I have a VTXO that's valid for your ARC, and they can validate that that's true, and then you can just use that VTXO in the ARC. So that would be pretty cool. So we currently have a function where you can actually create a tree like that, but you cannot do it unilaterally. So you go to the server, you say like, hey, I want these 1,000 VTXOs. You will do like some signing with him, and then you get an output, and then you do that. But then also, all these VTXOs are kind of vulnerable to you and the server colluding to do something bad. So with Covenants, it's definitely like a lot better. But we're having some kind of hybrid.
Well, before Covenants, so it should be possible just with an extra round trip. If I want to mine Coinbase output, onboard it to ARC, I'd need the output first, I guess, and then round trip with the ARC server to co-sign the next.
Yes, yes. Yeah, but for the server, there's no risk in just co-signing a lot of them. Like we don't do any validation if that transaction is like valid or whatever. Like the one where the transaction is coming from, right? So any out point with an amount, we will just sign the exit transaction, because for the server it just means like after 30 days I can take the money, basically. So yeah, if you, as a mining pool, every time you do a template, you could just get the ARC exit transaction and then just be ready to include it. Like there's no risk, or the server will not tell you like, hey, you can only do this once or something.
If someone's got a BDK wallet, what would be the logical way of integrating ARC?
That's a very good question, because our on-chain wallet that we built in is just a simple BDK wallet. So when you instantiate the Bark SDK, we have a PR that changed that a little bit. So right now, like if you don't do anything, it will just create its own on-chain wallet as well, which is a BDK wallet. But you can just say, I have my own wallet, and then you just need to wrap it in like a trade in Rust, and then you can just provide that one, and it will. Yeah, so one thing I didn't mention is when you do the exit, you have transaction fees to pay. And so if your on-chain wallet is absolutely empty, you cannot do an emergency exit, because the funds that you will eventually get are kind of time-locked, so they cannot pay for the fees of the exit. Also because package relay is still not a thing, it's just not possible. So yeah, if you want to support unilateral exit or be able to do it, you need to have some on-chain funds. Otherwise you need to tell users like, hey, the server's not here, get some on-chain funds so we can do an exit. It's a bit annoying, but that's just the protocol limitations we have right now. But yeah, BDK wallet is 100% supported. Like you can just bring it, especially BDK's Rust. In our bindings, yeah, we do the same. We create an on-chain wallet. I'm not sure if we have any interop with like existing BDK bindings. If you can bring those into our bindings, I have no idea about that. Yes.
We have a mic now for questions again.
You mentioned you store the transaction history for 30 days. Are you planning any privacy improvements in the future?
Well, I mean, we store what we have to store for 30 days, right? So we have to store all the VTXOs that exist. Also, because of the delegated rounds, some people might come later to like do their actual refresh. So we basically have a policy that we store what we need to store. Since we're like trying to evolve very, very fast, we don't have like a lot of like, hey, delete it immediately. We'll just have like a monthly job that just deletes what we don't need. So like we could be a tiny bit more tight there, but like we definitely have a philosophy of wanting to delete everything as much as we can. Another thing that we don't have implemented yet is like if your VTXO expires, we obviously don't want to just take your money and run with it. We want to just give you a new VTXO. We don't have that properly implemented yet. So for now, if you just come to us with an expired VTXO, we'll just like give you a new one at that moment in time. So all the VTXOs that are expired, but we didn't somehow give a new one for yet, we'll also keep them for a longer time. But yeah, we can, like Lightning payments, we don't have to like keep the invoices at all once they're settled, both on send and receive. We just need to keep all the VTXO information, and we definitely want to like delete as much of that as possible.
Thank you.
You support Lightning. Is that a Lightning inside? Is that a Lightning channel inside of a VTXO?
No, not yet. So the way we do Lightning is it's kind of the same thing as a swap. So the user creates an HTLC in the ARC and then asks the server to forward that HTLC on the Lightning Network, and then it like atomically executes. And then on the receive side, the user says like, hey, I have this invoice that someone's going to settle. The server creates an HTLC for the user in the ARC, and then also like it atomically settles. So the HTLCs are individual VTXOs in Arc. So if you have one VTXO, for example, and you're going to make a lot of Lightning payments, within the month, you're going to have like a really long VTXO chain. After the expiry, obviously, you like refresh, you get a totally new one. So it looks a little bit like ugly if you do a really high volume of payments. So for that reason and for various other reasons, like we're working towards creating virtual channels. So like an actual Lightning channel that is in a VTXO and not in a UTXO. And then you can just do your regular Lightning protocol over the channel. There's a little bit more work involved because then we need to like adapt existing Lightning implementations. We all know Lightning implementations aren't very easy to this, but people that are working in Spiral with LDK are already doing some exploratory work into this, and actually it's getting quite far along. But it will take definitely like, as soon as LDK supports Arc channels, and we have some rudimentary support, it will still take a bit of time before like it's the default. But yeah, that's definitely our goal. Because currently the Lightning receive comes with an additional like security trade-off that we can get rid of if we have the channels inside the Arc. So we definitely like want to get the best possible experience. Obviously, Covenants would also like give us very like both UX and security trade-off improvements. But yeah, we're building with what we have.
Yeah, Covenants solve everything. So I guess in summary, right now the HTLC is a VTXO, and the world you're building to is having the Lightning channel be a VTXO.
Yeah, and then the HTLC will also be a virtual HTLC because it's like whatever. Every HTLC is actually virtual, yeah. Yes.
I've been thinking a lot about the share chain, Jungly. It seems to me that Arc might be a really good use case to trade. So in P2 Pool, there's a second blockchain, the share chain, that you use to create your block template to build your Coinbase payouts. This is another blockchain, and it occurs to me that you could take the entire Arc protocol and flip it backwards and actually trade... CRA, yes. And actually trade share chain, quote-unquote, outputs and like consolidate Coinbase outputs in the ultimate block that gets mined by the P2 pool. And I know this is a crazy idea, but...
Yeah. I'm not sure why, I don't understand like the reverting and the trading.
I don't understand either. What we have talked about is, what me and Steve have talked about is basically, you know, the atomic swaps we want to do for the miners who don't make it to the Coinbase. And we want to do an atomic swap between them, those outputs on the shared chain Coinbase with the Bitcoin, right? And we talked about if we could do it with HTLC with Arc. And I think the last thing you told me was that you need to have a special type of HTLC on your end before we can do that.
To do swaps.
Yeah. So we kind of punting for it for now. He's doing his stuff. I'm building his stuff. Maybe in 3 to 4 months we'll sync again. That's my take on it.
Yeah, I didn't know you were waiting on that, so now we can maybe prioritize that.
No, you still have time, don't worry.
Okay, yeah, so one thing is doing swaps, right? So in Arc, you can just do any policy that a UTXO can have, so you can do like a HTLC, and then you can do a swap. We don't have that right now. We have only special kinds of swap that are between the server and the user, but we can very easily add that. There might be other parties interested in swaps. So yes, we can definitely do swaps, and then it's up to like, because they will not be part of the like core payments wallet probably, but then we need to see how we're gonna expose that. But another thing that you can do is, I mean, as soon as there's covenants, you can just programmatically create a whole bunch of VTXOs, and the only thing you need to know is that, well, that they're Bark VTXOs and the pub key of the server, which is a publicly known pub key. And then basically a peer-to-pool protocol could just say we support Arc payouts, and then users that make shares can just say, this is my server pub key where I won my payout, and then every round a single output is created that just creates all the Arc payouts for all the people in the same Arc. Just the algorithm can just do it. That's pretty cool, I think.
Yeah, super awesome. Go Covenants.
Yes.
You could unilaterally build covenants on the share chain.
Yes, my friend. On my
No, but you don't want share chain Arc, you want Bitcoin Arc, right? I mean, yeah.
Yeah, but it's a proof of use case that you can take.
I mean, there's been some work going on, moving along on Inquisition. So like maybe we can do a testnet, peer-to-pool, and get some Inquisition Arc payouts. But yeah, definitely. And definitely, I understand it's hard to. I mean, we also don't have an implementation yet for the covenant-enabled ARC. I did a proof of concept like a year ago. I'm probably gonna do one the rest of this summer as well, as part of what we're trying to bring to Inquisition and stuff. But I understand from all the projects sent of you, it's really hard to build for something that you don't know when it will come. So, chicken and egg. More questions? Cool. Well, thank you, everyone. I hope you try out some of these wallets. Cheers. Thank you very much. There's no one left the room, right? Can I just say one thing? Hello? Hello? Yeah, so the wallets that you have there right now, they're currently fully working on Signet. We are planning to announce our mainnet server to go live in 2 weeks, TM, but like for real this time. So yeah, we're very excited. Like definitely keep track on Twitter, on both our Twitter and the wallets' individual Twitters. And they'll probably make some noise about that when you can use them on mainnet. Thank you.
All right, so my talk is about getting Bitcoin for printed money. That essentially means getting Bitcoin for fiat, of course, but I will talk about how to get more Bitcoin for your current fiat buying power. The reason why you should care about getting Bitcoin for printed money are guys like this one. This is Michael. Some people like him, some people don't like him, some people watch him for the tabloid value. Whatever your team is, Michael is here and he's here to stay, at least for some time. What Michael and people like him say are things along the way, like sell your grandma to buy Bitcoin. I don't have anything against that. You can do with your grandma as you please. But Michael also says, give me more of your money so I can buy more Bitcoin. And you know that's getting tricky. And he created a lot of financial derivatives for this. And there are like others like him, basically. So the trend of Bitcoin treasury companies, there are currently more than 170 of them. And almost all of them are publicly traded, so they are just basically proxy in people's stockbroker, basically. And they are holding more than 1.25 million of Bitcoin, which is almost 6% of total supply of Bitcoin. However, let's assume that 1.1 million still remains to be mined. The lost coins account to 3 to 4 millions. That makes the available supply 16 to 17 millions. So treasury companies actually hold like 7.5% of that. But there's more. Another 1.3 million of Bitcoin is held by the ETFs. Exchanges are estimated to hold like 2.5 million, and governments of seized assets are holding more than 500,000 Bitcoin. That makes the self-custody wallets holding around only half of the Bitcoin's total supply. So treasury companies are currently holding like 11 to 12% of that. So you can disagree with it, you can argue about it, but that's about all you can do about it. However, us at Invity, which is a company under the Satoshi Labs holding, under the Satoshi Labs umbrella, said no. Us at Invity, we said, let's make Bitcoin available to people and not institutions. On that note, I would like to give a very brief introduction of what Invity is. It's a check app, check platform of Satoshi Labs. It's Bitcoin only. It's very much focusing on just the ease of use. It's MiCA licensed, so EU regulated. Among these circles, that does not really sound for much. But apparently, just some institutions said that our processes are actually good to go. And we are focusing on various Bitcoin products, mostly currently long-term accumulation strategies. And one of those strategies is something we call turbo buy. So what is turbo buy? You can think of it as just your DCA, but on steroids. So it's a Bitcoin accumulation strategy. It has the same principle as dollar cost averaging, but it provides you with extra buying power. That extra buying power is 60% more on top of your own purchases in your DCA. And you get it for paying continuous fee for that 60% extra buying power. That fee currently accounts to 14% annually, but within single digits of days, maximum weeks, that is still BTC Prague, those interests are, so this fee is coming down to 9.9% because we secured cheaper funding. The fee applies only to the extra buying power in your strategy, and it's deducted from every transaction. So you can think of it as you have your own buying power of 100% capacity, you get 60% turbo capital. And how does it really work? How to understand it? So you pay a fee, you are getting 60% more of Bitcoin at today's prices. When number goes up, in the future, you are basically getting more sats at today's value for yesterday's prices. You can settle that plus 60% turbo amount either from the accumulated Bitcoin in the strategy or by just one extra fiat payment. There are some bad words that we actually have to avoid. So it sounds like 1.6 leverage. Unfortunately, we cannot call it a leverage because the big boys in the suits won't allow us to do it. At the same time, we cannot call it a loan. That is a different product legally. We cannot call it a credit, or we cannot call it an option, even though it behaves like an option. What we have to call it is buying power, because all those terms are regulated. We also cannot call it an interest, because interest accounts only on loans or credits, etc. We have to call it fee. And we cannot call it a repayment, when you are basically paying for the extra buying power. We have to call it settlement. Now, once we clear that, it all makes sense. It's just because since Invity went the regulated way, we just have to abide by the language of all the big boys. So where's the catch in that? So what people usually say against that? What are their objections? Why would someone just give me money? Why should I pay a fee this high? I can borrow from a bank and at a lower rate and buy Bitcoin with it. I can collateralize my existing Bitcoin, get a loan, and buy more Bitcoin. Or what if I buy at the top? And of course, not your keys, not your coins. So let's go over all those. Why would someone give me money? So surprisingly, Invity is not handing out money. No one in the world does, actually. What it actually does is connecting demand for stable fiat yield, mostly from institutions and funds, and the demand for faster Bitcoin accumulation. And just those two connect in the app. So 9.9 is still an attractive yield for institutional money who just want to alleviate the risk and have a very stable and predictable income. And 9.9% is still very cheap when compared to average return of Bitcoin, annual one. And why should I pay a fee this high? So the turbo fee is actually inverted when it comes to the logic of interest of standard loan or a mortgage. In standard loan or a mortgage, you pay the highest interest at the beginning of the loan. In this scheme of turbo buy, you are actually paying the highest fee just at the end, just before closure of the strategy and just before you are realizing your profit. We can take a look at the mathematical function. I think that would be easiest if I just show it in here. So this is your buying power. Let's just say it's 100 units of your DCA. And this is, the red curve is the fee as it accumulates over time in months. So you have extra capital that you can buy in the plan, you have your own money that you're contributing as if you would be doing the normal DCA, and you have the increasing fee. Sorry. So you can see that these two curves are crossing here at the mark of 97 months. That's almost 8 years when operating this strategy is actually profitable. And you are basically making a bet that Bitcoin will be more valuable than now, and it needs to happen in almost less than 8 years in order for your strategy to be profitable. I will show you more details on this. So let's assume that the purple line is your total buying power of the Turbo Buy strategy, and the gray line is your normal DCA, as if you would be buying 400 units every day, every month, or whatever frequency you want. Again, we are crossing here. Since I'm a fair guy, I deducted all the possible fees and kept the DCA as if you would be buying absolutely without any friction or without any fee. That's actually 94 months, but still almost 8 years. So this is the point where actually Turbo Buy is getting you less Bitcoin than your normal DCA. So that's why I said you're making a bet that that Bitcoin will be more valuable in 8 years than it is now, for you to realize actually the profit, fiat profit, that is on the extra sats that you accumulated for the provided income, all fees included. Another objection, what people say, is I can collateralize my Bitcoin and then buy more Bitcoin. Of course, you can do that, but you need to have some Bitcoin at the beginning. And the best time to collateralize the Bitcoin and get fiat out of it is not generally the best time where you want to be buying in bulk more. And of course, when you collateralize your Bitcoin, you're liable with all your stack. So let's assume this example that we have a Bitcoiner called Adam. He has 1 Bitcoin. He pawns that 1 Bitcoin. He gets 50,000 of hypothetical fiat units, and he now has them at his disposal. So he can either buy in bulk, but he needs to time the market, so we need to catch the good moment, or he can spread the cash equivalent over time to mitigate the price volatility. But he has to guess for how long that will be since the beginning to spread the cash amount. And well, the longer time frame he sets to be more safe, the more of his money is actually idle, not making any purchases. And of course, he has to pay the interest for the total sum this whole time. Another point of view is that someone is a good friend of the banks and they can get money from a bank. Now, there's a big difference, as I mentioned before, between a standard loan interest and pay-as-you-go fee. So we have another hypothetical Bitcoiner, let's call him Karl. He has a good credit score at the bank, and he just borrows money to be accumulating more Bitcoin. So he gets XY of amount, let's say for a loan for 5 years, for 5% interest, and he has to pay actually like the interest and the principal every month for the duration of that loan. So again, he can buy in bulk as much as Adam, or he has to spread it over time. Now, let's say that he uses the money he got from the bank to buy more Bitcoin, 60% more for ease of comparison. And he also uses that money to pay back the principal and interest of the loan. Again, looking at those curves, he's basically paying off the loan. He has an account balance dropping much faster because he's buying Bitcoin with that balance. And he has a curve of how much he paid, the green line of the loan, and how much fiat he actually invested into Bitcoin. Those two curves are meeting at the month of 28. That means after 28 months, after 2.5 years, Karl is running out of money, and he is making much shorter bet than in the 7.8 years that the pay-as-you-go fee works. Okay, another chart is we can take a look at all the buying power in the purple line. Sorry, these numbers are cumulative. So everything that the Turbo Buy accumulates over time in months, and we can compare it to the gray area, which is like your average DCA, very linear curve. The efficiency actually breaks after 208 months, which is where the turbo buy plan starts eating itself. That means like your own contributions that you would be allocating to Bitcoin. So we can look at it as the efficiency curve of the turbo buy plan like this. It divides the curves into three segments basically. One is the most efficient. That means 7.8 years is actually always beneficial to run it without being in negative compared to the DCA. More than 17 years is actually beneficial if you compare it, when the strategy still accumulates more Bitcoin, but it's eating your own money as if you would be buying DCA. So, as I said before, in other words, when you open the turbo buy plan, you are basically making a bet that within 7.8 years, Bitcoin will be more valuable than today, and you don't have to estimate when it will be, you don't have to estimate when will you start, and you don't have to estimate when will you close. You can do it in real time as the price develops, and you have almost 8 years for that. That's 2 market cycles. Yeah, but of course, what if you buy at the top? You know, that goes with the same point as DCA. So let's say that you are very unlucky and you start at the absolute top of the last bull market. That's 10th of November. So this would be the appreciation in percentages. Of course, you start, you are accumulating, and you are in percentage loss. But in like absolute value, absolute appreciation, the loss is not that high because DCA, standard DCA, accumulates more Bitcoin over time. And if you are patient enough, you are eventually getting in percentages to a surplus. And eventually, even though if you started at the worst possible time, you end up having almost around like 25% more of sats accumulated. This is manifested in fiat appreciation. Different people can have different objectives. Same thing goes if you started just before the double top. On the first top of the double top, the scenario is basically the same. You are at a loss, then you are in a profit for a moment, but then you have to like wait out the bear market, but you end up with still 25% sats more. And in fiat appreciation, again, like we were operating with a hypothetical scenario of investing 100 euros per month. So you end up with around the zone of 3,000 euros extra that otherwise you would not have. And this is net profit. This is like all the fees deducted. So that's just like a game of patience. All right. It's worth mentioning that these simulations were actually made by the least favorable conditions. So all the hypothetical purchases that we ran since 2016 were almost at the top price of the day. All the hypothetical sells were always at the low of the day, and we basically worked with the largest liquidity providers across the market to model cases of liquidation, and there was 0 of them, basically. We modeled them from 2016. That's because before that, the data is very volatile and the exchanges were not that reliable. So since 2016, there was just more homogeneous data all around. And the last point is not your keys, not your coins. Of course, there is like no fancy way around that. Inviti is a custodial app, and the accumulated Bitcoin in the turbo strategy is locked as collateral. However, Inviti does not incentivize in any way users to hold Bitcoin in the app long term. Actually, the strategy is designed mostly to be set up during bear market and concluded in bull market. You get all your extra sets at your hardware wallet, and you are relying on the custodial solution only for the duration of the plan. And logically, the sweet spot is usually around like 1 to 3 years, depending on when you open it. If like this cycle is not your first rodeo, you can basically still sort of rely on the 4-year cycle. Now, having said all that, there were people before who promised people just money out of thin air, let's call it. And I like this mantra, basically. If you don't understand where the yield is coming from, it means that you are the yield, as you probably know. So comparing, let's say, Invity, TurboBuy to projects like Celsius or other unfavorable ones, TurboBuy does not really create money out of thin air. It's not even pretending to do so. It does not promise any yield without explaining where it's coming from. It's just creating an arbitrage between Bitcoiners and traditional investors. And because the traditional investors are either not willing or able to hold Bitcoin, or they're unable to handle its volatility, Bitcoiners can. And the historical appreciation of Bitcoin always outweighed the fee. On that note, we are legally obliged to say that investments in crypto assets are risky, and the previous results are not the guarantee of future results. But summing it up, TurboBuy is a great friend of a Bitcoiner who has a long-term vision for long-term accumulation. And if you feel like trying it, you can try it through the QR code or through the link. We have a 20 euro sign-up bonus for any new users, basically. We also absolutely, it's a KYC solution. I need to state that, like. Sorry? Yeah, exactly. So if you get someone inebriated and take their picture, yeah, it's absolutely KYC, 100% regulated solution. In the umbrella of Satoshi Labs, we try to cover basically the full scope of various needs. So there is obviously Trezor, the hardware wallet. There is Vexel project for peer-to-peer Bitcoin transaction, and there is Invity for the basically regulated path. Yes. So that's it. If you have any kind of questions on the math of it, on the efficiency, feel free to shoot. But otherwise, I'm done. Thank you. It takes a time. It's a very complex product to explain, but maybe similarly to Bitcoin. For someone who have not heard about Bitcoin before, they are just like resisting. But for established Bitcoiners, it takes a time to understand this product, but once they get it, the feedback we are getting is incredibly good from the people already using it, because it's just more sats over time. As I said, like faster accumulation. Yeah, but having said that, it takes a while to actually understand that math, and when we talk to people, it just, you cannot say that in one single sentence, basically, what it is.
Right. And so you mentioned there is some point in time where it kind of flips.
Yes.
Right? And
let me show you.
You said
yeah.
It's a bet on the fact that Bitcoin in 8 years will be higher than today, but it must be higher by enough margin such that you can cover the fees or the interest for the loan, right?
So, yeah, good question. So this curve is actually the pure efficiency. That means how much more Bitcoin you're accumulating, and minus the fee. The fee is already deducted. That's why the curve starts to like break. And after these like 17 plus years, this is where your dollar cost averaging plan gets eaten completely by the fee. So it's absolutely irrational to hold it more than 17 years. But Bitcoin is 17 years old, so it's unlikely for people to do that. Within the first sector, up to these almost 8 years, this is where you are just accumulating more Bitcoin in the TurboBuy after the fee is deducted compared to just doing plain old DCA.
Okay, but how does that work? I eventually need to return the principal, right?
Yes.
And the interest.
Yes.
That implies that if in 8 years the Bitcoin is $1 higher than today, like, am I better off or am I not better off?
Under these conditions, you are better off, let's say this segment A. You are betting that then within this time frame of 7.8 years, Bitcoin will be more valuable than any moment of time when you start, basically. So you start today, you are betting that Bitcoin will be $1 valuable anytime from today until 7.8 years.
But doesn't that sound too good to be true?
It does, that's why no one is.
What I can do today, I can go to a leverage exchange, which is exactly like it's the same thing, right? Like I open a loan, I pay overnight funding on it. It's probably going to cost you more than 10%. It's probably going to cost you 20% per year.
Yeah.
But that implies that if I have that position open for a year and the Bitcoin doesn't move, I'm at zero, but my funding rate ate away from my stack. So now actually I'm worse off. So the Bitcoin has to appreciate more than the funding rate for me to make money.
Yes.
How come is this not easier?
Very good question, because the scenario you are describing is just basically making one transaction. You get a leverage on an exchange and you buy long or short at one single point, and then you just are waiting for your position to be in profit or loss. But this is, let me just refrain to this.
Also, if you kind of like enter into positions, it's like if you were to be entering into positions on a daily or a weekly basis, right? And therefore you always, so at the beginning you start with a very small amount that's borrowed, right? Because it's just this single DCA.
Yes.
And as you DCA more, your debt increases.
Yes.
And therefore your fee increases.
Yes.
But that still implies if like a scenario where Bitcoin will be flatlined for the whole year, that means that yes, this thing applies, right? That if it's flatlined and I just keep buying it 100,000, 100,000, 100,000, if at the end of the year it's still 100,000, I'm losing money here because I need to pay for the interest.
You're not losing money because you're still accumulating more Bitcoin compared to DCA.
Yes.
So it has the dollar cost.
But like the additional Bitcoin I acquire also creates it equals out, right? Because there's a debt I take to buy the Bitcoin, and I buy the Bitcoin, so they are of the same value. So
Yes.
that's zero.
Yes. Yes.
But I have
So.
a fee on top, so the fee eats into my equity.
Yes, exactly. So the fee is, and again, those are. It was maybe a tad confusing. Those are these curves. So this is your own dollar cost averaging. It's dropping because you are paying the fee. 2 minutes, yes. This is the extra buying power from the plan, which is dropping because the fee is increasing. This operates under the scenario that you are sending stable amount of fiat, stable fiat amount on the frequency of weekly, bi-weekly, monthly, whatever. And that's why the efficiency starts to break at these 94 months. So you have compared to the exchange example you mentioned, you have the dollar cost averaging element of it. Well, you can imagine as if like you would be opening long every week on an exchange for a much lower profit, basically. And the interest, we have to call it a fee, we cannot call it an interest, is 10%. And like Bitcoin's fiat returns are on average, I don't know, 40 to 50%. There are good years, there are worse years. We can presume that it will be lowering, maybe like 30 or something on average. But you're basically doing the arbitrage between paying 10% and getting, let's say, 30, 35, 40% every year.
I get that. I just am disputing the fact that, you only need the Bitcoin to be higher than today for this to make sense. I think that's incorrect. I think the Bitcoin needs to be higher at least by the amount of the fee that you pay.
I misspoke. The Bitcoin has to be higher than your average buying price. Sorry, I misspoke. So
it has to be higher by at least 10% that you pay.
Yes.
Over the
Yes.
year.
Yes.
It's not like it just has to be higher in a year. It has to be higher than your average price by, well, it's not 10%. It's just you need to average your interest
again, so far for Bitcoin, very common.
Yeah, sure. It's just,
Very good. I probably have to leave the stage, but very good questions and very good discussion. We can chat more if you want. Okay, so thank you everyone.
Hi everyone, my name is Talib. I work at EdXDev. I'm a researcher, and today we will go over some controversial topics of recent times, Bitcoin layer 2s, and what happened to them. So before we start, some disclaimers. This is not a super duper technical presentation for this stage. I'll use some terminology, but I will explain what I mean. And I'm very opinionated and angry about things. So if I call people like retard, that will happen. Just be careful. It will not change anyone's opinion. You will not like something more or less after this presentation, but at least I will be happy that I called people retard on stage. And the term layer 2 here is not only Lightning or Arc. I use a broad definition, but normally, yes, there's a more different definition of layer 2 that exists. And there are a lot of images I put, and I forgot to put links or credits to it, so I apologize if I stole your meme or tweet or something like that somewhere. It probably happened. So today's agenda over layer 2s. We have a very simple, good agenda. We will talk about the old times, and then we will talk about the hype times, where people were hyped, and then we will go over some chaos and more chaos, and then we will talk over some fun that's happening nowadays. So the goal of layer 2 systems, I suppose, was to use Bitcoin in different ways, either whether you like it or not. And of course, it's without changing it, right? Otherwise, we would be forking. Some examples are making it more private, like Lightning, making it more of a casino, like Meta protocols, I guess, making it faster to use, which is, I guess, true for every layer 2-ish, and making it more fun to use by, again, some images through ordinals, inscriptions, whatever. And all of this should be done ideally while compromising the security as minimum as possible on whatever you're bridging your Bitcoin to. So in the old times, people came up with solutions. Maybe some of you recognize these names more than me because I'm fairly newish. These were tried, happened, and now like gray ones are kind of dead or forgotten, and the green ones are still active, and the yellow one lives in our heart. I hope it will be real one day. Their trust assumptions are fairly different. Like Lightning and RGB is trustless. That means if you're careful enough, your data is always with you and nothing is stolen, but if you should be careful. On the other ones, there are some multi-sigs controlling, which is a bit risky. And again, dry chains, unfortunately, don't exist. Maybe they exist in August, but we'll see. And yeah, these scaling solutions brought up these keywords as well to our lives. So for Bitcoiners, especially, like they get to know many different concepts during these experimentations. But you get the idea. I mean, life was nice, life was cool. Did they make Bitcoin better money, as Knut keeps repeating it? Maybe. I mean, people are using it and people are happy. I guess for them it's better money. But yeah, you get the idea, like how the life was going on. And then, something started to happen on our blockchain. Some images and GIFs and stuff like that started to appear more and more. Unfortunately, there were a lot of hype on putting these things on Bitcoin, and people just started to realize that they can enjoy it. They can just have fun with it. And to be honest, apparently some people also saw it in the past, like, Alex sometimes tweeted, like, there can be a demand on block space for fun stuff or anything. This is also an inscription that you can see on blockchain today. It's available. But yeah, block space were always there, but at some point people realized that they could have fun with it. But they started to have a bit too much fun, to the degree that it made a lot of people angry, because they started to put JPEGs and trade it. They started to put JSONs and make it fungible and started to trade it between each other. They put a lot of them, and they paid a lot of fees, and they created a lot of UTXOs, and they had fun with all of this stuff while life was going on. And they paid, like, they made a lot of things. Like, I cannot, like, ignore it. It's good casino, I guess. Of course, again, many people were angry about it, so people questioned whether they could do something or not. Well, there were discussions back in the days, but no changes were made, so we still have inscriptions, and they continue to live on our good old blockchains. But at the same time, on another part of the world, something else was happening. On the pure shitcoiner world, that many of you call it, on Ethereum world, there were rollups. They had their own layer 2s. And these layer 2s were mostly scaling casinos that drop tokens later on and that feed their sugar daddy investors. And everyone got rich and everyone was happy. So life was good for them. And yeah, everything and everywhere was full of casinos, basically. And there was like, I think, more than 1,000 of them. I just didn't bother to check, but I'm pretty sure. But the common idea of all the layer 2 stuff was, if you were to combine into one slide, people built casinos on Bitcoin through images, and people built casinos on Ethereum through scaling. And in the past, people also built casinos, well, actually scaling solutions, sorry, on Bitcoin. So what if, combining all of these, you could build scaling casinos on Bitcoin and make more layers on top of Bitcoin by publishing more data on top of it? Like all of these ones, but sorry, these ones are actually bad ones because most of them are either dead or scammed people. Let's put more credible ones at least. Or like these ones that publishes data on Bitcoin and then makes more layers and, assumes that they solved Bitcoin. So everyone's trying something, I guess. But these didn't convince people enough. Many people were super skeptical. But something happened. Luckily, there are genius people and there are a lot of nerds in the world that invent some crazy shit, such as BitVM. So one day we woke up and BitVM paper was released. And it was clearly saying us that you can now verify proofs on Bitcoin and you can build better bridges using this. So we had our casinos, as I mentioned. And now we had these cool ideas. So can we make apocalypse true? Can we make more chaos? The answer is yes. On top of our layers that we have built, what if we have combined them with the other ideas or pretended to make layers and fix Bitcoin and then put more buzzwords that no one understands? Can we then make everything much better? Well, yes. I mean, if you have a salad and if you make a proper word salad of every word that exists, like rollup, bridge, layer 2, roadmap, airdrop, BitVM, ZK, EVM, scaling, privacy, saving Bitcoin, whatever, you can get pretty good amount of money. So it's like, unfortunately, I was also a member of this gang. Do I regret? A little bit. Was it good? Yes. But yeah, people raised a lot of money, and people raised money from 3 types of VCs. One of them was good ones, and actually good due diligence ones, but the other 2 was either dumb ones or the liar ones, which is like, if you see buzzwords, just give money, or if you see buzzwords, just combine it with a scammer founder and then just get money. And I stole this chart from a very old archive. Like, these were the number of sum of companies in 2024. If you want to check how they are doing after 2 years, it looks like this. These ones are either dead or I ignore, or like I don't pretend that they exist. So many of them dead actually, and the common theme of all of them was like either EVM or trustlessness, which none of them was, and doing mostly pure fun, stupid marketing. In this one, I realized there's something missing, the best protocol of all time, which is RGB++. But luckily, it also died, so we don't need to think about it at all. But yeah, there was a lot of them. And if it was up to me, I would probably cross a lot more of them, but I just hesitated a bit. Maybe I shouldn't, but anyways. You can eliminate 7, 8 of them still. But, I was too pessimistic, but actually things were not that bad, because we also got like very good ideas out of these layer 2 seasons, like these stuff. Arcs, different arcs. We get Spark, we get Arcade, we get Bark, and we get Cashew, which is not Arc, but still it's, I think, cool. And they were super cool in the sense that, you could exit whenever you want. They were not as perfect as Lightning, but they solved some problems of Lightning, to be honest. And main problem with Spark Bark or Arcade was that there was no privacy feature, so everything was pretty much public, and you could trace it. But again, they solved a lot of pain points, and they're still in development. Well, Cashew is also cool, and I really like it. It's not one-off and trust assumption. That means like you're a bit more vulnerable, but still, it's cool, I would say. There's also Fedimint, which I didn't put the logo of it because I don't like Fedimint. I'm sorry, guys, but I think you're doing a good job. Continue doing it. I don't like the trust assumptions of Fedimint. Whatever. Still, people build super cool stuff. Not everything has to be a shitcoin. Not everything has to be a casino. Like the fact that you don't understand how ARK works doesn't make it bad. You should study and learn how it works. Meanwhile, all this stuff was going on. People were improving different state chain designs. Do you think our casinos or smart people stopped? The answer is of course no. They built better things, such as BitVM2, which is a much better bridge design. And then they built Clementine, which is a bridge based on BitVM2. And then they built BitVM3. And then they built BitVM4 or whatever, or BitVM5. So new ideas to build bridges were dropping every single day. I think some of these are very recent, but still people keep building extremely clever solutions to build actually cool solutions, I would say. So there's still some search. And even better now, because that core is captured and is not giving us covenants, we are making covenants without softworks. So people are attempting to build more stuff every single day. And because core is captured and is not improving Bitcoin to be quantum safe, we are even having quantum safe transactions to save Bitcoin. So every improvement of Geniusity is like helping to some degree, even though it is like a huge complex Rube Goldberg machine. Yeah, we keep inventing things, and people keep inventing things. That's a funny tweet of mine that didn't get any likes, but I liked it a lot in the past. Yeah, we just keep inventing things and hoping that it will fix Bitcoin or make it better. And probably this is how BitVM69 will look like. It's just a random diagram I took. But it just looked like this. And, you know, dear Bitcoin Core, if you give us some opcode, life would be good. But please don't make it BIP54, though. I think it's just, you know, I don't like BIP54. It's just a slope. But anyways, it's of course useful. I'm joking. So we had some alternatives, though. You know, these are not the only things that we had. We improved our layers as well. So what is the current status of our layers that graduated from the past casinos? We have Botanics, which was a very cool spider chain idea. Well, they didn't ship spider chains, unfortunately, but still, it was a cool idea. They're now just a multi-sig sidechain, but still, I like them. But they didn't ship what they claimed to ship. And then there's Bob, which was an Ethereum rollup, which had bullshit marketing and kept claiming that it was Bitcoin rollup. And I took this logo yesterday. It was gold. Apparently, they pivoted to gold. And today morning, they changed it again to old logo. So maybe they're watching my PC. I don't know. But if you keep scrolling their tweets, they have gold like as an idea. They're trying to survive, basically. And then there's Starknet. They're cracked engineers from shitcoin world, whatever. But I don't understand what they're doing here. I think they're kind of following whatever exists as a meta that couldn't make money. And then there's Babylon, which has super cool researchers, and they make vaults, and they try to make it perfect with ZK and BitVM. But they keep marketing as trustless, which it is not. And but they're smart. They used to build a bridge, and they no longer build a. No, they used to build a chain, and they no longer build a chain. So I appreciate them from pivoting because I think that's very smart of them. And then now we have the final two horsemen of the apocalypse. It's Alpen and Citrea. And the Alpen guys, like they're super smart, and they keep doing R&D for the last 10 years. But I don't know what they're doing anymore, and I think like I have a concern that they also don't know what they're doing anymore as well. But I think they will ship sometime. I'm really hopeful of them. And then there's my fellows, Citrea, which shipped actually, but it shipped with some suboptimal conditions that I don't want to talk about, unfortunately. And it has a token now, so I guess the goal is achieved. Maybe. I don't know what's next for them. Probably they will make some products. Actually, I know, but I cannot tell you, so that's also something. And which one was the most successful? Probably Citrea, because they also bribed Bitcoin Core, so I guess it makes sense. But yeah, all the scaling casino landscape now looks like this. Is it too good? No. Is it bad? I think so. But I think there's still some hope to save the world, so I don't mind it. But in terms of building a layer, or layer 2-ish on Bitcoin, there's a spectrum, I would say. There are two types of founders and companies. First one is the one that says, oh, this is so cool, to an idea, which says this because they can dump the token on people and they can enjoy life. And then there's the second type of founder or company which says, oh, this is so cool, because they can build actually something cool on Bitcoin while spending the funding, which later they need to find a business model, but we don't care about this anymore. So, and if you draw this on a line, this is kind of a line you get. I think some random ass sidechains are on the very left, which I don't like at all. And I think ARCs and state chains are very good. I hope that we can make it better as well with some privacy or something. But yeah, this is my, again, initially I said it's super opinionated. So this is how I feel. You feel to disagree. That's fine. And the reason I keep talking about this is very simple. In a very optimal world, that if we had everything or if we were smart enough, these solutions actually could be very good, like as good as maybe Lightning, if there were opportunities to do it. The reason they're not as good as Lightning is because A, we don't have some opcodes, such as opzkp or CTV or TX or hash or template hash or some other 10,000 different alternatives. And B, many teams have skill issues that they cannot even implement something they should have done in their pitch deck. So, but if the world was optimal, actually these solutions, even though seen very inferior, they could be, in terms of trust assumptions, much better. So they're still, I think, worth pursuing. And that's why I appreciate every single team that's trying to ship something without lying to people on the trust assumptions. Yeah, so with all the things, all the idea, maybe we can now save Bitcoin, right, with these solutions. Did they make better money? I don't see Knut here, but maybe we should ask him. I think ARCs make it better money a bit. Maybe rollups will one day, I don't know. Hopefully they can make it better money. But do all of them make Bitcoin better money? Probably no, because most of them are like, very unserious. So how can we stop these unserious people, right? Because they keep scamming people, spamming chain. What can you do about it? Especially if they're Bitcoin Core, how can you stop them? This is a very common question I'm sure every Bitcoiner has in mind on every single day when they wake up and when they go to bed and when they have dinner. How can you stop someone who write Bitcoin Core? So this is a good challenge. Let's try. Yeah, all these, like, how do you stop it? And now let's answer it theoretically, and now we will go over philosophical questions. Option 1, to stop scammers or spammers. Let's make a new Bitcoin client, which actually we need. I seriously defend this. We need more Bitcoin clients. We need more Bitcoin clients. That's it. Like, other than Drama itself, we need more Bitcoin clients. Yeah, but let's ignore that fact. Let's make a Bitcoin client to stop spam. The problem is it does not stop transactions from going into block. So if you make a client named Knots, unfortunately, it won't stop spam. And even though core devs can do this or can do the inverse and put the gun on your head and don't relay JPEGs, they say, some people will still do because there's stuff like Libra Relay exists or some miners exist. So unfortunately, even though it sounds nice, you cannot stop spam with an alternative client. You need to build an alternative client for better things. And, this was the initial attempt to stop it. People tried to build alternative clients and filters, which actually didn't do anything at all, but it showed their ideology, which I respect. And they also kept claiming that they're not going to do any soft forks at all, again and again, every single day. But yeah, and they kept, like, this is a meme I took yesterday on Twitter, like as if Bitcoin Core just forces people to filter or not filter. But actually, it's the other way, kind of like people are free to do whatever they want, and you cannot stop them from relaying the transactions they want. So it's a chicken and mouse game. This way will not work. Whatever. Also that, this was the initial attempt, and we got the claims that it's not going to convert into a BIP 1110 client. But unfortunately now, the default run mode for Bitcoin nodes is BIP1110. So in August, they will fork. But many people don't know it because they just don't read. Okay. Some of you convinced, some of you not. Again, I don't care about it. But we tried option 1 of making an alternative client. Let's try the option 2 to stop spam. Let's fork and block it. And probably this could work. This is actually a nice idea because the initial reaction to Bitcoin nodes was go off, fork. And now they are courageous enough to fork, and now people are bashing on it. You shouldn't. Like, people now try to fix the spam. The problem is, still it does not stop, unfortunately. Even if you fork, even if it's a very courageous attempt, under these circumstances, it probably cannot. There are 2 reasons. And how I know this? Because I'm an ex-spammer. Okay. The jokes aside, I used to work at Citria, now that I can claim it. And am I sorry? No. I think it was a good attempt. But yeah, safe to say, based on some things that I know about Bitcoin and some things people know better than me, it's safe to say that you can pretty much override all the blocking attempts to spam, and you can basically embed the data in multiple different ways. You can even use opt to drop. Basically, put data, remove it, put data, remove it, and then on your own scripts, you can just read blockchain and then check the script and then just assign a value to it and then make more harmful spam types. So BIP1110 does not stop it on a technical level. And if they want, they can update it to stop opt to drop, but probably you can use opt3 drop then or some other opcode as well. Again, unfortunately, I respect, but it does not stop. And there's even more alternative ways. Like, you can embed an image through hashes. You can embed an image through outputs. And then, it works. This one works, by the way. I tried this. And you can embed a Wojak of Luke or mechanic, and you will see it on chain as well if you want, with the proper software. Yeah, I mean, there's no way to stop it. Or even if you activate the fork, they can just go and open codex and then type this and then hit enter. And I'm probably sure it will be able to find it because the fork itself is also wipe coded, unfortunately. So yeah, but I didn't hit enter on this one, but I'm sure there will be ways to do it. Soft fork attempt is a good attempt, but it's hopeless on a theory level. You can always put data. Okay, option 1 was new client. Option 2 was fork. What about option 3? Anyone have any guess? What can we do? Add more usage is possible, which is kind of the true answer. Option 3 is enabling Austrian economics. We should let the markets decide what should happen with spam. We should just observe. If it survives, it survives. If it does not, it does not. But the trivial fact for you is probably this will be the most effective way. You should probably do nothing, and it will die. Because the more attempt you try to block, the more quote tweets you quote tweet a meta protocol and then say oh, I don't want this on Bitcoin, you give free marketing to people you don't like. And they just keep inventing new things. If the discussion didn't came in, probably I wouldn't know about opt to drop, how to spam blockchain at all. And now I do. And now you encourage me to invent new ways to put more data. So it's just, you should try Austrian economics way. You should let the markets decide. The problem with this approach is, as you can guess, markets are retarded. That means they will ignore or they will keep spamming the chain. Well, yes, that's the nature of human being. But I think they will be slowly dying. If you check the inscriptions, for example, they're slowly dying. If you check the runestones, they died, came back, and then they will die again. Okay, maybe in this graph they're not dying, but they will. Don't worry about it. So I think given this is an economics conference, you should think about the option of enabling markets deciding whether spam or when spam should die or not. Because the other 2 attempts didn't work, and this is the best solution you have. But yeah, until they die, you should enjoy the chaos, I believe, I think. Maybe we can talk after, but this is my opinion. Now, I did a lot of jokes, but let's do something more fun. How much time I have? Okay, I have time. Now that I revealed to you that I'm an ex-Citria member, maybe I should talk about my opinions and some confessions of how I feel about things going on. Well, some confessions. I realized that, I was a sinner by this inscriptions mania, so I should come clean. I think Taproot was a mistake. It enabled too much spam. I think transaction availability is actually a feature that many people ignore. I think Satoshi disabled opcodes because CIA added them to capture the network. We should have disabled more, he should have disabled more, but we didn't. Bitcoin Core is captured. I think HTLCs are dangerous because I don't understand how they work. It sounds like a gun name, so we should also get rid of HTLCs sometime, some way. I think pre-images are scam, or maybe spam, because I see them everywhere, and I don't know what they mean. They can be dangerous. I think Peter Todd is Satoshi for inventing Libre Relay, and this is also, in a documentary, it's proved, so he is Satoshi. Or maybe Jameson Lopp, I don't know, but one of them is Satoshi. And I think to fix all of this, we should remove all opcodes and bump the dust limit to 1 BTC. And we should name this as BIP null or BIP 0 on a BIP repository. There is a non-zero chance that they will censor my BIP attempt, but still, maybe I can open it to not BIPs or whatever. But yeah, I actually came up with a draft for BIP 0 as well. So it's this. You know, we will remove every opcode other than opchecksig, and you will be only able to check your sig. Someone suggested me this morning when we were doing a secret meeting, maybe we should only enable Taproot key spans. But again, the first rule is Taproot was a mistake, so I cannot only make it Taproot key span. It's only opchecksig. But yeah, these are my confessions. Okay, don't believe it. Now the real confessions. Real confessions is, when I was at Citria, we were so sad that people realized how we buy Bitcoin Core, because every day our Slack was looking like this. We were opening random channel, we were seeing some stupid tweet, and then we were sharing it, and then someone was just not believing that people could be this retarded, unfortunately. Because in the grand scheme of things, you can always believe in conspiracy theories, but like, I can assure you with my old human being and with all the gods you believe in, I can swear that like we didn't do shit. So you get a bit psyoped a little bit. But yeah, in the random channel, we were mostly busy laughing about tweets. At some point, I stopped working and I was scrolling tweets and I was laughing and kept scrolling. So it was sad times. We were so sad that people realized how we spam op return. Actually, maybe we were more sad that people couldn't read because it wasn't using op return at all. It was mostly inscriptions. There's a website called Citria DA usage. If you check it, like you can see how much data Citria puts, and it's all inscriptions, not op returns. We were so sad that V30 enabled us, but if you ignore the fact that it could work with V25, 26, 27, 28, 29, so it was all functional before that, and it's still functional. Like if you take a Citria node, run V27, actually you shouldn't because there is some vulnerability disclosure, but still if you want. If you run V27 with Citria, it will work because V30 didn't change anything. We were so sad that we got free marketing, but at the same time, I think this is the best thing you can do as shitcoiner. Just keep highlighting what they do and who they are, and just keep typing your conspiracy theories so that everyone knows about them, where 1 year ago no one knew about them. And this way you can make them more known and make them more sad that everyone knows about them now. So, but yeah, free marketing is just super sad to have by some opponents. But yeah, okay, jokes aside, like all of these were hilarious. I couldn't work because everything was fun. Maybe that's why I left or fired, whatever. But yeah, but pretty much everything was marketing and marketing. But it wasn't only Citria marketing. That's something that I want to mention. Because if you step back a bit and check what kind of marketing was going on, maybe you can realize something. Maybe you can realize that fear-mongering is also a kind of marketing that can happen. Maybe you can convince people that Bitcoin is dying, and maybe you have an idea that can save it, which was implicitly, unfortunately, something that I was doing initial days. I was saying Citria is going to save Bitcoin, and then day by day I realized like this is not a problem. But actually this is something that you can do. You can convince people that Bitcoin is dying or something is happening through fear-mongering, right? You can tweet out some bullshit like this, and either you're retarded or malicious entirely, that when V30 is released, there will be CSAM, and then all the cloud providers will shut down computers, and then everyone will chaos, and everyone will run away. If only you don't know how computers work or how humans work, or you don't know anything about it, or if you want to lie to people. And if you look at the hidden lines, you can see that pools and decentralized mining and a war against complete decentralized mining. So you can maybe catch some subtle hints that who is fear-mongering and why. And Mechanic is blocked because he blocked me first. Like, I have no beef with him, but because he blocked me, because I kept correcting him, I also blocked him, so that's why. But yeah, this is a bullshit tweet. Like, it doesn't make any sense at all. It didn't happen as well, as you can guess. Either this was a delusional tweet or lying for marketing of Ocean, because the entire goal of this stuff, in addition to stopping spam with pure intentions, was also keep highlighting that how decentralized mining should be and how you shouldn't let it go happen with Mara, which I think a hilarious statement, given Ocean also does payouts by themselves, but whatever. But yeah, I think the main reason all of this discussion is happening because of marketing, but it's not because of marketing of Citrea, it's because of marketing of some other people, either some clients or some mining programs or whatever. Speaking of marketing, I have some questions that I kept asking to myself, and if they were here, I would also ask them. Like, the reason of this marketing, if it is for Ocean, then sure it works. Not many people know about Ocean, but at what cost? I mean, in the eyes of many credible people, you just keep clowning yourself, and people start to even like hate or ignore you because you just keep publishing nonsense. If it was in the sense of marketing an alternative client, then why do you do it this way? And you know, to be honest, if it wasn't just purely alternative client, I'll probably run it. But now I will never touch it. I don't give a shit. Like, this is just a very retarded way of doing it. If the way and reason you do this marketing is because you don't like the organization of Bitcoin Core, then I think this is super dangerous. And I think this is a super bad way of doing it, to disrupt it. Because you keep accusing people by supporting CSAM to some degree. And I think you should have some shame to these people who work sometimes alongside with you to improve Bitcoin. Like, this is a very, very, very serious statement to the human mind, to the human soul, to all the views that you can have. Like, these accusations are just like, you know, what do you think I am? Who do you think I am? Am I a monster? Are these people are monsters? Is this guy a monster? Like, this is just very pathetic, I would say. And I have to say this again because this is not a game. Like, this is a soft fork attempt. And now probably it will fail because it has no hash rate. But it will cause chain splits. And when the chain splits happen, bad things can happen. You could, like, you know, there could be small double spendings. There could be problems with lightning channels. People can lose money. This is, I think, not a child game that you're doing in both sides. In both the Sol side, that you keep accusing people with CSAM, and on the other side, that you keep making people follow you when they have no idea of what's going on. I think this is very dishonest way of doing things. And I think you should always question how core works and how core organization works and who they fund and how they fund. I think this is fine. And to be honest, like, to the last year, I was also like questioning everything that's happening. I still do sometimes, but at least I'm not retarded or bad enough to make it this way. Like, I can question, but still, this isn't the way. Like, you need alternative clients, you need different power structures maybe. If you believe it's captured, you can try to disrupt it, of course, because we all like Bitcoin, but this isn't the way. And this activation is definitely not the way because it's super, like, harmful to people. You're just going to fork, and you don't listen to anyone else at all. You keep blocking and kicking people. And social media is just a disillusioned chamber as well, because people don't see each other's opinions, or when they see, they just don't understand and don't read. Again, I just feel bad that we keep spending our times with this, and I just feel bad that they're in such a policy to accuse people with these kind of stuff. And yeah, like you might be a famous person with a lot of funds, but there are a lot of people who just does whatever you say, and they don't understand or know because they don't listen, or they don't understand sometimes, and you're just being dishonest to them, to your followers even. I think it's very bad. What I would do if I were the Ocean guys or some other guys, I would find, of course, more clients. I would onboard more people. I would teach them in an honest way without bullshitting. I would just try to disrupt Sailor or other sweet coiners, which I inherently don't like. You can like them, that's fine. I would try to build more cool stuff because, you know, this is probably a harder way, but at least a more probably successful way of doing it rather than attempting a retarded fork. You should always stack and spend sets. You should always show some love to people working with you or working on something. But yeah, and don't even get me started that the fact that you can spam Lightning actually. I'm not going to tell you how, but if you're really serious, then you should also disable Lightning because you can also spam Lightning. This was an idea that happened, that came to us yesterday with a friend. I'm pretty sure if you're courageous enough, you can put all sorts of data on Lightning. I'm not going to tell you how, but you can think about it. And if this is true, then you can also put CSAM on Lightning. That means maybe the way to go is drive chains. I don't know, maybe Lightning was a complete mistake. So you will learn about it like this penguin by going along the way. But yeah, sorry, I went a bit too angry or sad towards the end. What happened to the L2s? Well, nothing happened. The grifts are dying. Welcome to the Austrian economics. And the real ones are continuing to implement things. And they will be even better and make things much better. And hopefully I'm looking forward to what will happen other than BIP 54 and some quantum discussions. But yeah, thank you. Do I have time? Okay. Yeah. You can shout, I think I can hear.
Why do you think they're calling the BIP1 temporary software? How can it be temporary?
I think, yeah, the reason of expiry that I feel like is to make the resistance against it a bit softer and slower, because if you don't market it as temporary, then people can maybe understand your bluff a bit. The main reason I believe is the temporariness is because, you know, people not resist against it too much. And I don't think it's going to be temporary at all, whether it fails or activates. If it activates, probably it will continue to happen. If it does not activate at all, probably I think we will have even more retarded version of this in February or something. I don't think this discussion will end until this retarded marketing drama stops or, you know, something happens.
But they're claiming that they're aiming for 55% support, which means that they are expecting two chains. Two chains cannot merge back together, so even the definition of temporary doesn't make any sense.
Yeah, I mean, that's why they just put it into title and then ignore, and if anyone asks, oh, what will happen? They just say, oh, this is temporary because everywhere is spam, or what if CSAM comes, and what if Bitcoin dies? Well, the fact is that it already exists, and as I showed you with multiple options and multiple ideas, you cannot stop it, so there's no way to stop it. It is just, it doesn't make sense.
So what do you expect will happen after August, after activation?
I think it will fail. I don't think they are bad or malicious enough to try to put CSAM. I think we will have more rounds of retarded discussions, and I think this is the only thing that will happen. I don't think it will activate at all, because it doesn't really seem to have enough hash rate. But if they manage to, I will probably applaud. Like, I will say, well done. Like, no one was expecting this outside of your echo chamber. I think, yeah, it will fail, and then we will have even more headaches of them claiming that Bitcoin is dying. And with more retarded tweets like this, maybe. Where is it? But yeah, Taproot was a mistake. Yeah, like more bullshit like this, maybe.
You mentioned earlier that you weren't that much of a fan of Fedimint, but you seem to be kind of positive on Cashew. Why is that?
I think it's the way things are marketed. You know, Cashew guys seem more open in terms of trust assumptions rather than Fedimint guys. That's the whole reason. And on Cashew side, I'm involved with more people and they seem to try to improve things, such as using SGX, which is not the most ideal solution, but still an attempt. Is it maybe because of me being blindsided about different developments on Fedimint side? Maybe, but I think Fedimint is not really different than a traditional multisig that much, and that's why I don't like it too much. But I think it's still a good solution and good alternative, and we should have more alternatives. It's not that I hate them, it's just that I rank them a bit below Arc and maybe a bit below Cash.
One more question. This is just my gut feeling. When we had 1 megabyte blocks, everything was okay, it seemed. We weren't having these discussions. Then Taproot came. We increased to whatever, 2 to 4 or whatever, 4. And I have this feeling, just from my personal feeling, if it were still 1, we wouldn't have this discussion. Because it's this weird thing where somewhere people have decided that 4 is too much, whatever. I don't know if it's too much or not. And 1 was great because that was the original, whatever.
Yeah.
And I never, in all these discussions, I never see a proposal of just putting it down to 1. Because no, we're having some weird, very complicated stuff, So
Yeah.
what's your opinion on that?
I think, jokingly, I of course said Taproot was a mistake, but there's a lot of things that people are using Taproot for. All the fans, if you drop it down to 1 megabyte, then fees will jump, of course, as the nature of block sizes, which miners can be happy, but the question is, will spammers be incentivized enough to stop spamming, or will just keep spamming it and fees will be high? And the worst side of this is normal people won't be able to transact that frequently, which actually they don't, but still, I don't know, it's a philosophical question. But yeah, I think if I wear my Bcash hat, I think block size should be bigger, but that's a very, perhaps wrong idea that I have. But yeah, what happens if you drop it to 1? We should think.
I would like to react to that quickly. So we're coming up with a lot of solutions, but it's not exactly obvious what the problem is. Is the problem that we have that other people have transactions that we don't like? That just sounds like censorship. Oh yeah, but they're not using the system like we are using. Great, so don't look at it. Bitcoin is Bitcoin. We can say, oh yeah, it's money. Oh yeah, it's a billboard. Oh no, it's, I don't know, a data storage or database or whatever. All of these are just metaphors. The truth is that Bitcoin is what it is today. I don't see why it makes a lot of sense to try to figure out what Bitcoin would look like if we were designing it today, because that's not the reality. If we were to reduce the block size to 1 megabyte, that would be a hard fork. Or it would be some kind of weird combination of this. And it's not exactly obvious what problem we're solving, because currently the problem is we don't have enough monetary transactions. It's not that we have too much spam. If we just increase the monetary transactions, be the change you want to see, then it will simply price out the spammy transactions.
Yeah, I mean, you can draw a lot of models and what could happen. I think it was just a fun philosophical question that came to mind. I think it's easy to draw 10 different scenarios if we attempt to, or do, reduce the block size to 1 megabyte. But at the end of the day, it is what it is, and the war against spam, all these retarded discussions keep us, or making us blocked from thinking about this stuff, because I think we just keep dabbling with these retarded discussions. I don't like it. And again, seriously, I was the first hire of Citrea. I worked there for 3 years. There was goods, there was bads. It was a very ambitious attempt, and we will see how they do after all these dramas. But if there's one thing that I can confidently say, many of the conspiracy theories are just simply not true. All of them, even, not true. Yeah, it's just free marketing for a lot of people, unfortunately. We'll see.
If there are no more questions? Technically, we have time because there's no other talk in this room, but
yeah,
you can also...
I mean, yeah, you can follow me on Twitter, ask me questions if you want.
But if anyone wants to go to the other talk, we should finish here.
You can send pictures of me looking like a retard on Twitter as well. Like, feel free.
Yeah, you had this kind of scale on your presentation where you like marked like different solution, and you have like the ARC and like state chains is the best we have right now, and like zk Labs is like far away. Like you've worked on the basically like zk Labs, so just interesting to hear your opinion why like this is better. Like
So C3 was a ZK rollup with a BitVM bridge, and with an ideal world of ideal opcodes, you can make it as secure and as better, even better than like Lightning probably, because you can verify proofs and you don't have any liquidity problems. You can make it so fucking private, like bunch of stuff. But today we don't have them, and because of this and because of legal restrictions of these companies, there are some governing multisigs behind the doors, and it can stop, it can censor. Because of these kind of stuff, I don't put them at the same degree of ARC, because on ARC, it's still not fully trustless, but like almost all the time you can exit. So that's why I didn't put them as far right. And that's why each one of these have some handicaps, like, you know, something you cannot do, something is not private, something is broken, something needs to have a token to survive or whatever. In the current scape of Bitcoin, I don't think ZK rollups are going to be the most optimal solution. But yeah, we will see about it. The reason is, again, because BitVMs are super complex. ZK systems, even though most of them are used in production, there can be soundness bugs. There are multisigs governing the funds. And it's hard for rollup companies to survive and blah, blah, blah. So these are the reasons I didn't put them as far right as ARCs or state chains, no matter how simple state chains are.
yeah, thank you. Yeah.
Okay, thank you for the talk.
Thank you.
It's really interesting.
Thanks for listening.